momentarily. All right, good morning, everybody. Welcome to the second annual TraderLion Trading Conference. We're super excited to have you guys here. Thank you so much for tuning in on this Saturday. First of all, let me know if you can hear me all right down below in the chat. Just give me a 1 if you can hear me clearly, and if let me know if I need to up my volume or anything like that. We've got an excellent lineup for today. We'll go ahead and show that schedule here momentarily. Here's our lineup for today. We'll get started around 9 o'clock with Pat Walker, and then we've got a great lineup going the rest of the day. A really important thing today is we're happy and excited to be running a donation and fundraiser for St. Jude's Research Children's Hospital throughout this conference. We're keeping this 100% free, but we'd highly encourage you to donate if you find value in this conference. And it's just a great thing that we can do along with being just a great educational experience. With that said, I'll be right back with Pat Walker, and we'll go ahead and get started. Welcome. All right, welcome everybody to the first presentation in the TraderLion annual trading conference. We're super excited to have Patrick Walker, a veteran CAN Slim trader, to kick things off. Couldn't be more excited to have him, start things off for us today. One of my favorite educators with the CAN Slim system. So Patrick, thanks so much for being here and welcome.
Thank you. Thank you all for having me. I have to compliment everybody that's here. And I'm not saying that to praise you. You're committed to learning things. You're committed to getting better. While a lot of people are out horsing around, the people that are in here right now are working hard to get better. And I think that's really important. I'd like to give you just a little bit of background about me. Then we're going to get to the charts, okay? Years ago, I'm from St. Louis, Missouri originally. I've lived in quite a few different places in the United States, taught on the university level, okay? Taught advanced level classes, strategic planning, etc. I love teaching, which was one of the biggest reasons we started Mission Winners, was to educate, not to just give ideas. Anybody can give ideas, but to educate why. As I was telling the gentleman earlier, to know that 2 + 2 = 4 is knowledge. To know why 2 + 2 = 4 is knowledge that's applicable to other situations. So what are we doing? We're sharing knowledge. And I know everybody else that's going to come after me doing this, doing the same thing. Not anybody can give a stock idea, but why? And then you can apply it. Just to let you a little bit know about me, as I said, I taught on the university level. I taught advanced level classes. One of my finals was 24 pages typed. And it wasn't because I was a jerk. It was because I had high expectations. And the same thing's true with Mission Winners. The grade that you get, all right, is a monetary grade. And it's a very important grade. And so it's important to really approach this business in a serious manner. I can't stress that enough. So I have a question for all of you. You don't have to answer, but this is for you. What are your motives? This is for you, okay? This talk isn't about me. This talk is about you. And I really mean that from my heart. What are your motives? Why are you doing this? Why are you interested in investing, okay? To make a lot of money? Okay, fine. But are there other motives there? Is it to support a family? That was one of my motives, to help support a family, to help support my mom. Is it, yeah, let's really get after it. Is it the challenge of doing this? And all those things are viable answers. But I encourage you, I'm asking you, please don't focus on the money. Focus on good trade, and I hate to use the word trade, but I'm going to use it, trade or investing execution. Practice that, really commit to that. I can't stress that enough. For years, I was an IBD meetup co-leader, and I would get up on the stage and I would talk and challenge the people. Why are you doing this? Answer that question and make sure again that it's not about the money. So I got started in this business, and I was there for the crash of, believe it or not, I was there for the big crash in 87, 89, right? I still remember that. It was wicked. I was managing money back then, but I have to give credit, and I'm going to do it right now. I want to give credit to some people that had a profound impact on me back then and then later on. The first one was Martin Zweig, and I had the great pleasure of meeting him and talking with him several different times. And credit where credit's due, listening to Martin Zweig and his input helped me move all of my managed accounts out of the market several weeks, 2 weeks before the crash of 87. The market was showing deterioration. You could see it in the price and volume action of the stocks. So we moved out. Martin Zweig, another guy, Bill O'Neill. I've met Bill O'Neill a couple of times, actually sat down and had lunch with him. Bill O'Neill had a tremendous impact on me. And I'll be very honest, of everybody, if it wasn't for Bill O'Neill, I don't think I'd have done it. But I give credit where credit's due. I really mean that. Another individual that I met, and this isn't name dropping, okay? I'm trying to share just part of my background, and I hope that's why you're here, aspiring to acquire knowledge. Ed Seykota. If you don't know who Ed Seykota is, read the book Market Wizards and read about Ed Seykota and his returns. Ed Seykota is a trend following guy. I'm a trend following guy. When you see the numbers that he's put up, it's staggering. And I remember talking to him at a meeting in San Francisco, and it was interesting. He had on bifocals. And so I'd make a statement. It's just him and I talking. And he'd tilt his head back like this. I'd make a statement on price movement, and he'd go like this. Why do you think that is? I'll ask you that. When you're looking at a chart and you see it doing something, you should ask yourself, why is that happening? Why is that happening? There's a tremendous amount of information in the charts. Learn to read them. Can't stress that enough. Anyway, I wanted to get that out of the way. Market Wizards, a couple of books I recommend that you read. I would recommend that you read How to Make Money in Stocks by Bill O'Neill, okay? I would recommend that you read the books by Mark Minervini. They're very good books, very good books. I stress that, especially his first one, which is called Trade Like a Stock Market Wizard. Good book. And things, it's substantial information. Another book that I would recommend are some of the books by John Boyk. I've got one sitting here on the desk, Monster Stocks. You can say, why are you bringing these things up? To help you get better. Also, finally, I would recommend, and I've got it sitting here, Market Wizards by Jack Schwager. I've met him 2 years ago. It's a wonderful book. But the best part about that book is the interview with Dr. Van Tharp. Dr. Van Tharp is either a psychologist or a psychiatrist, I forget which, and he trains and coaches professional investors on how to get better. And that's probably why you're here. I mean, folks, this isn't about me at all. This is about you, okay? How can you get better? That's why you've committed your time to this. So I encourage you, the book Market Wizards by Jack, and by the way, know this, I don't get anything, I have no relations here with this stuff, okay? I'm not endorsing, it's to help you. But not only read, study the last chapter in that book, Market Wizards, with the interview with Dr. Van Tharp. Psychologists training people, coaching people. Why are they doing this? Mindset. And one of the big things is this, not focusing on the money. You go, what? No. I'm encouraging all of you, don't focus on the money because it will cloud your reasoning and it will cloud your judgment. Focus on good, we're talking stocks. Focus on good stock selection. Focus on good stock investment management. If you can do those things, the money will follow. And you can say, oh, really? No, really. I've been through a lot of high pressured situations in my life my dad died when I was a young guy. And basically, then I had a family of 6 that I was helping to support, and I was helping to support my mom. So yeah, was it pressure? Yes. Why? We lived off our investing profits. I didn't have any wealthy relatives, okay? It was a case of making it happen. Some of you have a similar situation like that in your life. I get messages from my people. Hey, I need help with this. I need help with this. And as I stated before, that's the reason why we started Mission Winners. Now let's talk acronym for a minute. You all know the acronym CANCELING from Bill O'Neill, and it's a great one. And as I stated, Bill O'Neill changed my life. Tell you that right up front. What a nice guy too. I remember one of the times I saw him, he goes, hey there, just a good old boy, great guy. Mission Winners. What does mission stand for? And this is important. This is for you. Markets. The M in Mission Winners. Markets. You've got to have good markets, folks. Don't argue with the markets. Markets, industries, the I. You look at the big picture market, then you narrow it down to the industry group that it's in. And this is going to make sense to you in a minute. Sector, okay? Sector, markets, industry, sector, stocks in the group, the second S. I, institutional support. You've got to have other people besides yourself buying the stock. We can't move the stock, folks. There's got to be more people involved with it. O, outstanding management, outstanding product, outstanding service. They are the best in their field. Focus on the cream of the crop. I'll give you an example. This is what I've said at the IBD meetups for years. Nobody does what Google does as good as Google does it. I'm not endorsing Google. That's not my point. But it's a fact. I'm going to do an internet search. Oh, I'm going to go to Bing. No, you're not. You're going to go to Google. Okay. You're going to do shopping online. Nobody does what Amazon does as good as Amazon does it. You get my point? Over and over, companies like that are the cutting edge in their fields, the best of the best. Focus on those. Outstanding management, outstanding product, outstanding service. And you can say, well, then, Pat, what does the N stand for? And for me, the N is the most important letter in Mission Winners. And this is my psychology background. N, never say never. I will tell you something, team. This up here between your ears is the most important asset that you have. Take good care of it and focus on positive situations. You know what to look for. markets, industry, sector, stock, institutional support, outstanding management, outstanding product, outstanding service. You combine all those things together. Never say never. You know what to look for? Stick with it. Stick with it. I really stress that. And another important point I have to make up, turn off the noise. So what? What do you mean by that? I encourage you, don't inundate yourself with too many entries of ideas, not stock ideas, just constantly surfing, constantly looking. In fact, I'll be very honest, I have a TV in my office, but I don't have on, I'll tell you the truth, I don't have on like Fox TV, and that's not knocking Fox TV, okay? I don't have any of that stuff on during the day, and it's not against Fox, it's not against MSNBC, nothing like that. Turn that off. Don't be ignorant of news, but turn all these things off during the day. There's too much high angst and high anxiety in the news. It always seems like the end of the world, which can lead to negative thought processes, and that's not good. That's important. Another key point I have to make, and this is my psychology background, all right? You have many assets. One of them may be money, right? And hopefully it is. Hopefully it's family, hopefully it's health, hopefully it's faith. All these things are important. Protect the assets and definitely protect your mental health. Don't dwell on the negative, dwell on the positive. Good quote, I never met a wealthy pessimist. There's opportunities out there. Every day there are opportunities out there. Look for them. So let's get down to that. So now you got a little bit about my background and you got a little bit about my motives. Why we started Mission Winners was to help people. And you can say, again, that's all. No, this is fun. I love teaching this stuff. I've been teaching, I used to teach outdoor survival skills at higher elevations and where lives depended on it. I know what it's like to be above the lightning looking down on it. I know what it's like to hold somebody's hand like this so they don't fall off a cliff. And now I'm going to change gears and share something with you, okay? This is part of my background. You go, what the heck does this have to do with stocks? Really not with stocks, but if you get hurt bad, you can't do much. And Richard's probably going, what's he going to go with? Right, Richard? You'll like this, folks. It's called the two-man grip. I'm going to show it to you right here. Take a look at this. You see this? This is the two-man grip. A lot of people hold hands like this or like this. No. If you need to really hold on to somebody because their life depends on it, and I've been there, okay? I've been there up in the mountains. This way. This is the two-man grip. What's it mean? I can let go, but you don't. Or you can let go, but I don't. That's the two-man grip. You can say it has nothing to do with stocks. Well, it has to do with life. And you know what? It indirectly has to do with stocks. The two-man grip. That's part of the reason why you're here, is to get better, knowing that I need to improve various skill sets. Two-man grip. I'll pull you up, you'll pull me up. And that's part of a team. That's one of the bigger reasons why Richard is doing what he's doing, and doing a great job, by the way. It's not about him, okay? If you've noticed, it's not about I'm doing this and I'm doing this. It's no, I'm doing things to help other people. And that is a noble and actually positive trait. So I commend you for what you do, your whole team for what you do. Help other people. Let's talk stocks now for a minute, okay? We're gonna get down to it. You got a little bit about me, what we've got going on. So here's the big question. This cuts right to the chase, folks. You wanna buy stocks that go up in price. Why does a stock go up in price? I'm not saying that to be funny. I'm not saying that to be cute. These are what I used to teach on the stage for IBD meetups every month on a big stage. Why? You can say, well, Pat, this is a company with great earnings. Oh no, they have great sales. They have really good return on equity. Their profit margins are really high. Okay, they have an outstanding product or an outstanding service. They do things better than other people. These are the reasons I'm buying stocks, or why a stock goes up in price. That's all great. But let's pull all the way back, and I'll ask again, why does a stock go up in price? And it's really simple. remember this. It goes up in price because there are more buyers than sellers. And you say, oh, come on. No, let's be pragmatic. And that's what we talk about all the time at Mission Winners. Let's be pragmatic. Why does a stock go up in price? There's more buyers than sellers. We want to find stocks that have that, don't we? So now let's nuts and bolts it. We've talked about psychology. We've talked about what's going on between your ears. And I will say this, and I'm speaking from my heart. If you're ever going through a really rough time, and I've been through that. I remember my best friend diagnosed with cancer and he died. He was dying. I had to quit. I had to quit and be with him. Priorities. Things happen. Do that for yourself. It's very, very important. So let's talk. By the way, I've got 3 hours to talk, right, Richard? You say I got 3? Richard's not saying anything.
Yep. You've got as much as you want, Pat. Love it.
By the way, folks, Richard's a great guy and does a great job, but you got to have fun too. All right. Take this very seriously, but laughter is a good thing. Okay. I mean, I remember I was trading with a buddy of mine and we had a stock and it fell and we were down like $12,000 in, I think, 2 minutes. And we're talking on the phone and I go, Steve, I go, gosh, look at that. And this is all he says. That's not good. And that's it. And we laughed. We laughed. It's not minimizing the loss, but enjoy it. Enjoy the ride. I can't stress that enough. Have fun with this. This is a great thing, folks. What you're doing, most people dream of. And you know what? You're doing it. And you can say, yeah, but I'm not quite successful yet. But you're doing something right now that most people aren't doing. You are getting better. You are trying to get better. You can say, how? Because you're here. While everybody else complains, you're getting better. And that's part of this conference, is making people better. So now let's talk stocks, all right? This is very important. We're going to get down to this nuts and bolts. Why do stocks go up in price? There's more buyers than sellers. You can say, well, that's common sense. You know, that's great. Well, there's a couple things to think about. There's 2 schools of thought when it comes to investing. There's fundamental analysis and there's technical analysis. I'm both. I'm a fundamentalist and I'm a technician. So let's talk fundamentals. And this is really good. I've got articles here. You can't see them, but I've got articles. This article is from 2008. I mean, I've got articles going way back when. But I'd like to read you a paragraph. And feel free, by the way, team, I hope you do. Take notes. Take notes. This is serious stuff. This will make you better. This will make you money. Make you more money faster. And I like this. This is research from Investors Daily, Bill O'Neill and Company. 1 paragraph. In the study of the 600 most successful stocks from 1952 to 2001, by the way, that's a statistical valid sample size, that time frame. From 1952 to 2001, 3 out of 4 of the stocks that made huge price moves had earnings up more than 70% before their breakout. I'm going to say that again. From 1952 to 2001, 3 out of 4 of the stocks that made huge moves. I'm up 10%. I don't give a rip about that. Stocks doubling, tripling, quadrupling in price. Massive moves. 3 out of 4 of them had earnings of 70% or higher before they broke out. There's your edge. Right there. There's your price of admission. You can say, yeah, by gum, I'm going to focus on stocks with good earnings. Okay? This is where it gets good. The 1/4 that did not have earnings up 70% or higher, the 1/4, their earnings the next quarter were up on average 90%. 90%. So what's the moral of the story? I focus on this. I focus on stocks, and here's the recipe for a great cake. You go hold a gun to me and say, okay, cut to the chase, Pat. What do you look for? This is what I look for. I'm giving you the recipe. As far as the fundamentals are concerned in this little realm right here. Stocks that earnings last quarter were up 40% or higher. Focus on those, 40% or higher. Or that's one of my screens. By the way, I was invited to be in the beta test group for the original Daily Grass products online. I was one of the guys. Oh, by the way, yeah, do I have old chart books? You see the date on that? 1989. Yeah, there you go. I got chart books going all the way back. They're great reference tools, okay? Focus on stocks that last quarter's earnings We're up 40% or higher. That's one of my screens on MarketSmith. In fact, I'm going to give you a gift. Here's a screen for you. Focus on stocks in the top 40 or 50 groups. Focus on stocks over $10 or $12 a share. You might want to write this down. Focus on stocks that trade more than 200,000 shares a day. Focus on stocks with a composite rating of 90 or higher. Focus on stocks in the top 40 groups. Focus on stocks with earnings of 40% or higher last quarter, right? Focus on stocks, I think I said this, within 20% of 52-week highs. And the big one, focus on stocks with a composite rating of 90 or higher. That little screen I just gave you, if you follow it stringently and look for clean and simple base breakouts and buy those and manage them properly, that little screen right there will make you $1 million. And I'm not kidding. Because what? Over 10 years? Oh no, in a good market, 1 year. 1 year. Now you're saying, what if you have a $10,000 account? No, I'm going to say if you have like $100,000 to $200,000 account, that screen on. And how can I say that? Because we have VIPs that did. And you can say, with what stock? There were two of them, Tesla and NEO. And I'm going to show you the charts too, okay? So we'll make it worth your while. Focus on stocks that have great earnings. Or flip the coin. Focus on stocks that last quarter's sales for 2 quarters, we'll say, were up on average 40% or higher. I'm very stringent with this. You can say, why? I had to be. You got 4 kids in private Christian schools at the same time? Tuition? Do the math. 2 kids in private Christian schools and 2 kids in college at the same time? Holy cow. The money's flying out the window. You got to make money. So why not stick with the best of the best? So again, focus on stocks with superior earnings or sales growth. All right. Now I've got another article here that I'd like to share with you. This is from May 4th, 2011. Look at that. See this? Isn't that great? Richard's going, man, this guy's crazy with this stuff. This is from May 4th, 2011. Breakouts work best when you follow rules. Okay, breakouts work best when you follow rules. Check this out. From August 2007, by the way, I'm not going to read you a lot of stuff today, okay? Don't worry about that. I don't do that. But this is worth, I hope you're taking notes on this. I really do, man. This changed your life. From August 2007 through October 2007, the market was in a confirmed uptrend. IBD identified breakouts, 39 breakouts. Each offered a valid buy point out of a buy range and had big volume on the breakout. Satisfied, clean and simple base, broke out of a base, and it did it on good volume, right? Here we go. The composite rating was 88 or better in each of the stocks. So now we've got that constraint in there too. 88 or better. You can make it 90, the best of the best. The top performing tier. And this is what you want. This is what we want at Mission Winners. This is what I teach every day, over and over, to drive home the point. And I love this. And what I'm giving you is a recipe for a good cake. And I love cake. Here we go. Reasons cake's good for it. It's got wheat in it, okay? It's roughage. Here we go. The top tier, 10 stocks did about 4 to 10 times better than the NASDAQ's 11.5% gain. How much was the market? Well, it was up about 11% the last couple of months. Oh yeah, how'd you do? We were up 40 to 100%. What do you want? The best. Not being boastful. Stick with the best of the best and turn off the noise. I love this. Here we go. 10 stocks did roughly 4 to 10 times better than the NASDAQ's 11.5% gain. This is the sweet potato pie part. All of these stocks had a composite rating of at least 96. All of them. I'm going to say that again. All of them had a composite rating of at least 96. They did 4 to 10 times better than what the NASDAQ did. Isn't that what you want? So you can say, well, what's the takeaway with that statement, Pat? Focus on stocks with high composite ratings. All right? By the way, please know this. I'm not trying to get you to subscribe to Investors Daily or anything. Market. No. They're great sources. That's not my point, but please don't think that's what I'm trying to do. I'm trying to impart the skill sets and knowledge so that you can apply them. You own them, you know them, and you can use them. You can use them. In fact, I'll be very blunt. You can say, Pat, well, we'll get to it as far as screens are concerned, okay? 8 stocks dwell within the top 30 groups. The other 2 were in groups 41 and 53, all right? The average gain on these stocks, are you ready? The average gain on these stocks, 75%. 10 stocks did roughly, right? 4 to 10 times better than the NASDAQ's 11.5% gain. 4 to 10 times better. I mean, folks, isn't that what you want? And again, say I might miss something, stack the deck in your favor. Don't think you've got to look at every stock in the world. You don't. The best of the best really works. The second tier, 9 stocks did roughly 2 to 3 times better than the NASDAQ's gain, okay? 2 to 3 times better. That's not too bad, is it? Okay? 7 had a composite rating of 97. 97. How's that sound? 7 were in the top 30 industry groups. Here we go. So let's build a cake here. What do you say? Let's make a cake. Focus on stocks. I'm going to give you the recipe here. And I don't even need to look at notes on this stuff. It's up here. Of course, I've taught it every month for years. In fact, I still do, come to think of it. I think I'm doing that now, aren't I? Here we go. Focus on stocks over $10 or $12 a share. Focus on stocks that trade more than 200,000 shares a day. Focus on stocks within 20% of 52-week highs. Focus on stocks in the top 40 industry groups. Focus on stocks, I think I said it, but I'm saying it again, with an accumulation distribution of A or B. Focus on stocks with a composite rating of 90 or higher. Focus on stocks within 20% of 52-week highs. Focus on stocks over the 50-day moving average line. If you take those constraints and use them and stick with them, you will make money. You will. And always, no matter what, limit risk, control risk. Price is good above the line and it's bad below. If you could, here, I'll show you something here real quick. We're going to punch up a chart. How about that, Richard? Would that be exciting?
Sounds great.
Here we go. We'll just do this one. This was a good winner for us. Northrop. I always talk about clean and simple bases. We're going to show you a bunch. You can say, well, that's kind of choppy right here. How about this? Clean and simple base right here. Just going across the tops. It's nothing fancy, okay? And what do you want to see? And I say this a lot. I've said this for years. People talk with their mouths and vote with their pocketbooks. Go where they're voting, right? Isn't that what you want? And how's that confirmed? Good price action combined with volume. They're buying the stock. Look at the bar right here. You want to see something? You see this right here? Good volume on that bar, right? Good, I mean heavy, much heavier than average daily volume. I'm going to do something for you. We're going to look at some charts here, by the way, folks, okay? It's going sideways. Lifts off on good volume. Look, this is average daily volume, folks. Dramatically higher than average daily volume. And it pauses just a little bit above these highs. We say, okay, so we started. Boom. You think we're the only people in the world that saw this? Then everybody says, yeah, this is pretty dang good. Look at the volume on that bar. It exploded. And that, running up, that's good money, folks. That's not, you're not going to sell at the top. But, you know, you're 70, 80 points pretty quick. I don't think that's too bad in about 6 days. Please note this, by the way, they all don't do that. Okay, I'm not conveying that message one bit. Okay, but this was a leading stock in a leading group with great earnings and a great sales and a high composite rating. That's the key, high composite rating. And volume talks. People talk with their mouths and vote with their pocketbooks. They voted. They voted. So you got fundamental analysis and you got technical analysis. We combine both together. So let's do this because we're going to get to questions too. Is that true, Richard? Okay, good.
Yep.
Let's synthesize everything together. First, ask yourself why you're doing this. All right. Don't think about the money. The money will cloud judgment. It really does. Okay. Focus on stocks. And this is really important. Leading stocks in the top 40 groups. Leading stocks and leading groups. All right. Focus on stocks that are within 20% of 52-week highs. They're over $10 or $12 a share. They trade more than 200,000 shares a day. An accumulation distribution of A or B. Composite rating over 90. And they really lean on this. And last quarter's earnings up 40% or higher, or last quarter's sales up 40% or higher. There's two screens for you right there. It's really all you need. In fact, you could say, if you could only have a couple of screens, what would they be? That was it. That was it. I don't need anything else. That's it. The super stocks come up with those screens. They really do. And I need to pause this and say this, please. I'm not trying to get you to sign up with MarketSmith. I don't work for them, okay? I don't get any I don't have anything to do with that, okay? I'm just a guy just like you, who's or gal, whatever, who's trying to figure this out and trying to get better. But those constraints will really help you. Now you can say, Pat, let's systematize this a bit. Is there a way that I could find leading sectors faster? And I'm going to give you a great tactic. We're talking tactics now, okay? Let's nuts and bolts this a bit. You can say, how do I find some leading sectors real time? Here's what you can do. I have a list down here, various tabs. See this tab called ETF? Does that show up, Richard? Or just the chart?
It shows up.
Very good. You see this tab right here called ETF? Oh, by the way, here's the max list, okay? Here's ETF. Here they are. You can say, well, gosh, how can I find out the groups? Here's a bunch of ticker symbols for you, folks. And what you can do is you can sort it during the day. It won't do it today because the market's closed. Thank God. You can sort it by quotes. There's a smile. You can sort it by quote sort a percent. And you can quickly scroll down this list and see where there's strength or where there's weakness. You know, like you can say, oh, biotech. Here's biotech. You know, we'll just do a little study here. Look at the clean and simple tops right here. Look at the volume pickup. And it took off. There's biotech. Cloud computing. In 1 second, what does this tell you? Leave it alone. By the way, this is a great lesson for you. Okay, this is not like hocus pocus. This is the real deal. Are you going to take a look at this chart? I think I'm going to look for some cloud computing stocks. Why? There's nothing there. It's junk. Leave it alone. Here's the beautiful part about that. It's good to know what to concentrate on, but it's also good to know what to avoid. That constantly narrows our universe down on what to look for. The moral of this whole story right here, team, focus on strength. Focus on strength and you will do not much better, okay? Electric vehicles, really not much happening there. Not much happening with this. Academy funds, this is the IBD 50, all right? And what does it tell you? There's not a lot of power in the IBD 50 stocks. That's not criticizing investors daily. It's just saying that the leading stocks aren't doing a lot. And it's showing. Continue onward. What does this say? This is gold miners. I'll stop in just a second. This is gold miners. In 1 second, it tells you, I ain't looking at any gold mining stocks. You know what's really great? We've got a limited amount of money and a limited amount of time. Why don't we use them wisely? Okay. There's things to concentrate on and there's things to just put aside. I'm not going to look at this. No, I don't look at these. Gold. I'm not looking at this. Gold was really good earlier in the year, but right now it's nothing. There's another biotech ETF. Connect the dots. You ready? I showed you one before. You go, oh, that's not too bad. And then here's another one. It's been strong. What does that tell you? Maybe look at some biotech stocks. You see how you systematize things? Online retail is nothing. By the way, what I'm showing you, I share this with the VIPs, admission winners. Every day I screen these and scan them and talk about them. Oil and gas exploration. You see how strong this was? Look at this back here. See this move? And you see that run? You think we were in oil and gas? When the market was crummy, we were heavy in oil and gas and it worked. And then we know when to get out. The point of this is showing you, illustrating to you what to look for and what to stay away from. Home construction was really strong. Stay away from home construction. There's nothing to do with it, okay? Small caps really lagging. Airline stocks. What does this tell you? I ain't buying any airline stocks. You can say, that's power for you. What are we doing? We're narrowing our universe down on what to focus on. Regional banking, dead. I'll stop here. Mid-cap, nothing. Oil services. Here's another energy one. This was really good, and now it's dead. There's nothing to do with it. It tells you automatically, I'm not going to look at any energy stocks. Here's a fact for you. The vast majority of a stock price's movement is related to the industry and the sector that it's in. If it's in a good sector, it increases the potential you're going to make money. Right here saying, I ain't looking at any oil and gas stocks. Isn't that great to know? That eliminates all that. It narrows it down to just the best of the best. That's power for us. That's what we do. There's, oh, well, I'll stop right there, okay? Nothing. And on down the line. And there's QLD. Oh, what is this? This is a higher low setup. Guess what? We're going to talk about that too. How about that? Anyway, systematize. That will really help you. So the M and mission winners, right? The markets. So what do we look for? Now we're going to get down to the specifics. We've got the big picture fundamental. Okay, and then we look at the sectors. Leading groups, leading stocks, and now we talk fundamentals, right? Great earnings and our great sales and a high composite rating, and they're near 52-week highs. I read this years ago. You want to buy a stock that's going to be hitting 52-week highs? Look for stocks near 52-week highs. Duh, buy strength. Buy strength and avoid weakness. And again, you can say, you're wired really tight about all that. There's a reason why, and you know my story. I had to be. There were 6 mouths to feed, okay? Those kids were hungry. My oldest son's 6'8". I had to be good with this stuff, okay? He's a moose, and he ain't fat either. Anyway, they're all big. So that's what we've got going on there, all right? So we've narrowed it down. We focused. We've got the big picture as far as fundamentals. And we even took it a step back beyond that. Why are we doing this? What is your reason? What is your rationale for investing? Concentrate on that. Now you've got a goal. Now we sit there and say, Pat, I know what to look for fundamentally. I'm going to look for stocks with great earnings or, I didn't say both, or great sales with a high composite rating. And they're near 52-week highs, within 20% of 52-week highs. And they have a base pattern that everybody in the world can see. If you focus on those, you will make money. It will help you. And now I need to flip that coin and talk about the negative. Do they work every time? No. Nothing works every time. You said, well, Bill O'Neill does. No, he doesn't. If it did, he wouldn't have a situation saying limiting losses at 7 to 8%. They don't. So a clean and simple base, and this is why I'm so hung up on this. A clean and simple base will give you a clean and simple exit for a much smaller loss. You will be able to control risk much better. You see this right here, BPT? Remember we looked at the energy ETFs doing so well? You see this clean and simple base? This is vanilla. There's nothing fancy. See the volume pick up through the tops? That bar right there. Look at that. People talk with their mouths and vote with their pocketbook. Hey, they voted. They were buying, and it made a nice move. And we bought that. And it was a good run. Then we sold some into strength as it started to drop and locked in the profits. Sold some on the way up, sold some on the way down. But what's the key point here? It's a clean and simple base. If you focus on those, it works. Now I need to stop here and say this. This is important. Why? Why do clean and simple bases work so well? Like a cup and a handle or a simple flat base? Team, we've had hundreds of stocks do this over the years. Why do they do this? Why is it so good? Why do they work? Isn't that what you want to know? Hey, Pat, I want to make money. That's what I'm here by, Joe. Why? Think about it. Everybody sees this. This is not fancy. A fourth grader could see this and say, yeah, it's going sideways. Gosh, I guess, I can see that. I guess if it takes out those tops, cross that line, that flat line with volume, that'd be pretty good. Oh, there you go. I guess I'll buy some. There you go. Not a huge move, but it's 20% on your money in a couple of weeks. That's not bad. That's one of them. Clean and simple basis. Flip the coin though. This is the part I really love. Price is good above the line and it's bad below. So do we have to give it 7 or 8% losses? No. Off the record, Bill O'Neill said he wanted to keep losses much less than 7 or 8%. Okay. This is the beautiful part about what we do. And no day trading here. I don't scalp and I don't look at 5-minute chart. I'm gonna look at a 5-minute chart this year. If I had, I'd be dead. It's too much. See these clean and simple tops? Price is good. It starts to go. If it falls well down below this line, drops below this line, you can sell it. One thing we have learned at Mission Winners, and this is from looking at a million charts through the years, literally, you know what to look for. And I'm sharing it with you. This is a gold mine right here, folks. And I'm going to show you some other examples. It's good above the line and it's bad below. Over and over, it works. It works. Richard, can I drag some charts in here real quick?
Yeah, sounds great.
Okay, here we go. Let's bring some in. By the way, what I'm showing you here are past stocks that we own. These are all past keyless stocks, every one of them. If there's any other I want to look at currently right here. I think that's pretty good right there.
And Pat, it would be great if you could talk about where you place your stop loss as well. After you make a specific buy point, where do you actually place that stop loss, and when would you sell some if it reverses from that clean simple base pattern?
Great question. Let's answer. Richard, thank you. We'll answer that right now. Price is good above the line and it's bad below. If I buy this pushing through this line, by the way, did it have good volume? Yeah, it did. Yes, it did. And we bought it in a crummy market. Folks, in a crummy market, right? This is working. It's good above the line and bad below. Addressing Richard's question, which is a great question. And you know what's awesome? This is why I love Mission Winners and working with Richard on things. It's the real world. What do we do? How do I manage this? What am I supposed to do? Good above the line, bad below. It lifts off. If this starts falling below the line by 30 or 40 cents, okay, I'm going to sell a third or a half my shares. It's that simple. And that's not day trading. It's looking at millions of charts through the years, knowing the biggest problem you have is the sucker goes and you can't get enough shares because everybody sees it. Goes, lifts, takes off. Next day you're tested, okay, came right down to the line, but you're still okay. Stays above the line. Here's the bottom line, folks. Prices, I'll say it again, price is good above the line and it's bad below. By default, and this is what we do, it helps us keep losses extremely small. If it starts to drop below this line, we'll sell a third or half our shares. For an 1% loss, 2%, if it continues falling, we'll sell the rest for a very small loss. One of the things I'm big on, I never want a big loss, ever, ever. By managing them like this, it really helps. But there is a stipulation here. Remember, clean and simple basis that everybody can see helps us keep losses much smaller. That's what we want. And I'll say it again. You experienced this and you've done the fundamental homework. You know what to look for? The best ones, they just go. They just take off. It's a thing of beauty. So anyway, good question. Good question. I thank you for that. It's right here. Clean and simple. Own it. Look at the clean and simple base, folks. Here, I'll do this. By the way, this is a great, again, this is the psychology side of me. Don't, and you can say, yeah, Pat, you are crazy. That's what you mean. Okay, I'll go with you. This is what's really great. Go back and study past winners and do this. Slide it over and train your eyes. Say, oh, that's a clean top. Those are clean base right there. It's above the 200-day. It's above the moving averages. By the way, focus on stocks within 20% of 52-week highs, as I stated. Tremendous increase your probability of working. By the way, these were the numbers we were looking at when we bought this. When we bought this, just a week ago, earnings per share ranked 93, composite rating 97. Focus on stocks with a composite rating of 90 or higher. Relative strength 93. Relative strength was leading the stock in the new high ground. Oh yes, last quarter's earnings were up 540%. Boom, there you go. and sweet potato pie in a crummy market. There you go. That's not a bad start, is it? We've sold some into strength to guarantee profits. We're in good shape. Over and over, it will really, really help you. So let's drag some in here, okay? Just to show you, because I think this is important. Tell me if that shows up, Richard.
Yeah, looks perfect.
Great. And Richard, by the way, again, thank you for inviting me. I'm honored that you asked me, and it's a pleasure working with you on these things. So, and I try to help any way I can. You know me. All right. So thank you, sir. The whole TraderLion team. See the clean and simple base? By the way, this is from 2017, folks. This broke out way back here. Look at this. Actually, it was 2016. But look at the move. See the clean and simple base? You see the volume? This was a keyless stop. Breaks out, heavy volume, and yeah, you know, what are we talking? 20 to the mid 40s? Look at the trend. I'm going to show you several of these. All these were keyless stocks. The key point is this. Look at the base. That's really what I want you to concentrate on. Look at this. And if you really want to do good and better, be better than the average person, put the chart on your system and look at it. Train your eyes and mind on your stock charting platform. There's an edge that'll really help you. And then do this, the real world. Slide the chart back to before it broke out and advance it one day and look at it. Advance it another day and then advance it that third day and look at when it pushes through the pivot and ask yourself, yeah, would I buy that? Does it have good price action? Does it have good volume action? Yes, it does. You've trained your eyes and mind on what to look for. Commit to that. This works. It had to work for me. And you know what? I know this. It has to work for you too. How about this for a beautiful color? Pinduo Duo, PDD. Look at this break right here. Clean and simple, runs up, pulls back, tests the pivot, and then makes the march. But note the clean and simple base. I'm just going to drag some more in here. THC, Tenon Healthcare. Folks, this is from 2018. Clean and simple flat base that everybody in the world saw. Keyless stock. There you go. That's good money. Over and over. If you do this, life will be better. In mode. Clean and simple base. Buy. See the volume coming in here and here, pushing through the tops. And it goes. I mean, you're talking 28 to 58. Now, you're not going to sell at the top, but that's money. I'm going to show you a couple of real world times right here. Here's Netflix. Clean and simple flat base. Right there. Look at the volume. Everybody in the world saw it. People talk with their mouths and vote with their pocketbooks. Hey, they voted. I mean, this, folks, this is a good run. From what do you say? 530 up to almost 700. And please note this, by the way, please do not think this is Pat Walker bragging. That's obnoxious. Nobody wants that. These are things I wish somebody had shown me, and I'm speaking from my heart. They took me aside and said, hey, Pat, listen, man, I know this is really eating you up alive with the family. Focus on this, it'll help you. And that's what I'm trying to do. Going sideways. Look at the volume breakout right there. Roku. Sales were up 51% when we bought it. Great earnings and our great sales and a great run. Goes sideways, loses the shelf right here on volume. Last sale, the rest was sold. We'll do a few more of these. Okay, bear with me. GSX. This goes back even further. It was a clean and simple flat base, pushing through the tops right here. Look at the volume, folks. This was group number 4 when we bought it. Earnings were up 450%. Sales were up 350. Look at that. Composite rating was 99 when we bought it. Not up here, back here. These were the numbers we were looking at. People talk with their mouths and vote with their pocketbooks. They voted. And there it goes. Over and over. I'll do a couple more here. I don't want to inundate too much. Now we're going to switch gears. This is the higher low setup. This is beyond me. I remember when I did this and I had people say, this is just a fad. There's nothing good with it. This is goofy, fake meat. Had great sales. Sales were up 215% when we bought it and it was in a leading group. Higher low setup, folks. This low was higher than this low. Runs up, pulls back, triggers. Right here, it had volume, and we bought it right in here. We'll say we bought it for 80 some odd bucks a share, okay? We didn't sell at the top. Liars sell at the top. But 80 to 240, it's a triple the last time I checked. And our last sale was right there. Simple, over and over. And you can see why. Duo, clean and simple. I'll do a couple more. Datadog. There you go. CyberArk. Clean and simple flat base. When we bought this, folks, this was on the key list. This is back in 2018. When we bought this, earnings were up 92%. Right here. Go back and look, pull it up. You'll see. Yeah. Oh, look at the volume on that bar. Look at the volume. They voted. And that's a nice run. Over and over, it works. All right. Let's see. No, we'll stop with that because I want to show you something else. All right. We're going to exit out of those. We're going to go back to this. Now we're back to the current time.
You've got a pop-up coming up on the right-hand side, exit program.
We don't want that, do we? That would be bad news.
So it's right, yep, right there.
Mine's blocked. Does that say no on the right-hand side? It does, right?
Right where it says confirm exit program question mark, there's a yes and no. Just press the no.
Trying to get to it. There
you go.
Mine was blocked on the edge of my screen. Thank you. You guys are good, I'm telling you. Okay, so let's look at a couple of things right now. Can we do that, Richard? Is that cool with you guys?
Sounds great. Okay.
I want to share another setup with you. All right. I've told you about the clean and simple flat base. And yeah, you know it works. All right. Doesn't work every time, but more times than not, it works. And when it works really well. I want to show you something. This is Neo, and you go, there ain't nothing here. I agree. What's the phrase I use over and over again? Clean and simple flat base. You can say, this is nothing. I agree. Right here. Clean and simple flat base. Look at the volume pickup on that bar. Buy. Clean and simple flat base. Gaps up. Unbelievable volume. Buy more. Clean and simple flat base. Lifts through these tops. Volume pickup right there. Buy more. Buy, buy, buy. Average price, okay, in the lower 20s. And I need to share this with you folks. And again, this is me being the IBD Daily Graphs Market Smith guy for years. I encourage you. Rules of proper pyramiding. I'm going to give you something very, very important. This is CANSTM level 3 and CANSTM level 4. Okay, I've been there. Got the manuals here on my desk on the other side. You want to get to 100 shares. You might want to write this down. In fact, I hope you wrote everything down. Why? I'll be very honest, you're going to be tested on it. Monday, you'll be tested, and Tuesday and Wednesday. How about that? When you're buying and you want to get to 100 shares, rules of proper pyramiding. You buy at the pivot, your first purchase is 50 shares. And I have to give a stipulation. This is really important. And again, this is CANSTM level 3 and 4. You're looking for good stocks in good groups in a good market, breaking out a clean and simple basis with volume. You got to satisfy those constraints. Your goal is to get to 100 shares. Your first purchase would be 50 shares. The price goes up a couple of percent. Your next purchase would be 30 shares. 50 shares, then 30 shares. Price continues going up. Your third purchase would be 20 shares. 50, 30, 20 for a total of 100 shares. That's CANSTM level 3 and 4. Yeah, I know I've got the stuff here too. For buying properly, adding onto a position. Now, what kind of a stock do you want to do this with? You want to do this with a stock that has these traits. It's in the top 40 groups. It has great earnings. and our great sales, a chart pattern a sixth grader could understand. It's breaking out on heavy volume, has a high composite rating, and again, it's a leading stock and a leading group. Focus on those, and those rules of proper pyramiding really help. I'm going to do it again because this is important. Your goal is to get to 100 shares. Your first purchase, you never buy your full position at one time, okay? I really mean that. Your first purchase would be 50 shares. It goes up in price a couple of percent. Your next purchase would be 30 shares, 50 and 30. Continues going up another percent or two. Your third purchase would be 20 shares. That is rules of proper pyramiding, and it works. It's very serious. And I do stress, if it doesn't go up in price, don't buy more. Think about this. What's the beauty of that? This is what's awesome. You don't have full exposure. It's not like, oh my God, what happened to me? No, you only started with a half a position. Never start with a full position. Also, monitor, control risk. When the market's sloppy like this is today, okay? There's the spiders, the S&P. When the market's like this, you're not going to see this in any chart book. You're not going to hear Bill O'Neill say, now you see this pattern right here, this is where you want to go fully invested. You're not going to see that. No. There's a ton of overhead. It's choppy. Control risk by going smaller. There's a day to really push it and get fully margined, which I will tell you this. In a good market, I can get fully margined in a day. Okay? Day. Just plowing. Or two, depending on if the opportunities are there. But when the market's sloppy, go less. Control risk. And you can respond back to me right now. Yeah, but I won't make as much money, Pat. Come on, don't feed me that. And my response is, in a sloppier market, which this is, you won't lose as much money either. We've got to control money. We've got to manage it. There's two types of capital in the market. There's financial capital, and there's emotional or psychological capital. We must protect both of them. And how can we? By good investing rules and tactics combined with discipline. I really mean that. Everything I'm telling you, team, I'm speaking from my heart. That's a fact. Okay? So can we talk here in a minute, Rich, about a higher low setup? Is that possible? Do I have enough time, or how am I for time?
Yep, we're just at an hour. You've got plenty of time to cover that. And I definitely got a ton of great questions as well, but yeah, go for it.
Okay, thank you. Thank you and again, gentlemen, thanks for putting this together. This is what's great. You're helping people. And that's noble. So well done. So I'm going to show you something here, folks. One of our favorite setups is the higher low setup. My favorite setup is a clean and simple flat base. I love them. I live for them. I'll take them over anything else. But are there a couple other patterns that you can use? Yes. This is the higher low setup. And I'll do it first here on QLD. The NASDAQ 100. This low is higher than this low. Notice this. You have lower lows all the way down here. This low is lower than this low. This low is lower than this low. This low is lower than this low. And then it rallies up, and then it falls and hits another low. And then it rallies up and it falls. Oh, this low is higher than this low. This is a more advanced investing tactic, but it does work. It shows, using the big market first, this is showing that there is a reversal, that for the first time, it's illustrating some strength in the markets and stocks. This low is higher than this low. We watched it. We picked it up right here, taking out the previous bar's highs, and it's working. It's not a huge gain, but it's a start. This low is higher than this low. I'll show you another one here. This low is higher than this low. Notice all the way down, you've got lower lows, okay? Lower low, lower low. I mean, this low is lower than this low. This low is lower than this low. It goes up, it drops. Oh my God, it's the end of the world. There's a valuable lesson here, and I got to drink some water. Hang on. From a psychological perspective, what is this showing? This low is higher than this low. The selling pressure is dropping off. This low is higher than this low. This is the real world, by the way. This is a setup we use a lot. And I love it. And it works. Lift it, and it's marching. So you buy it, and this is the best part. Controlled risk. If it starts to fall, where would you sell? If it takes out the lows of this bar for a very small loss. There you go. Do you buy a lot of shares on this setup? No, but it works. This is a point I want to bring up. A lot of people, and I've seen it again, one of my degrees is in psychology. This stuff going up here can really muddy up. Oh man, the market's bad. You know, there ain't nothing. I mean, you look at this. Here's the spiders again. There's nothing going on. This is ridiculous. I quit. I'm not going to look at any charts. This is stupid. Always look. It doesn't mean you have to be buying, but you're always prepared, just in case. Those that said, there's nothing happening here, I'm not going to do anything, they missed this. And this is a good start. It's not a huge start, but it's a start. They missed this, and it's a start. These were all on the list. They missed this. This low is higher than this low. And look at that move. Dang near 200 point right here from taking out the previous bar's high, right there. There you go, a higher low setup. I'll show you another one. Tesla. This low is higher than this low, right? Good volume on that bar. Look at the volume pickup. Takes it off and it marches. By the way, do I like the higher low setup? You tell me. Back here, this low was higher than this low. And look at that run. They all don't do this, but this is the real world. You want to be successful, you need to have discipline. You have to have a couple of entry tactics that are viable, that work, okay? And own them. And I'm sharing this with you. This was huge. You could say, you got any others that you could show us just to drive home the point? Watch this. You can say, well, that's a lower low, Pat. You wouldn't do that. You're correct. We didn't do it. But look at this low here. This low is higher than this low. And right here, this was on the key list. And look at the volume pickup on this bar. I'll slide this over so that we avoid any psychological bias. Say, oh, okay, I see that. That's a higher low. I guess if it starts to go up, that'd be good, you know? Oh, gee whiz, look at that. It did it, and it did it on volume. Gosh, I'll be darned. Look at that. I guess some people saw that higher low setup right here, okay? They all don't work this good, but that is a nice run. That is a really nice run. Do we like the higher low setup? Oh, it's dropping. It's below the 50-day. This is awful. It's the end of the world. Yeah, okay, so it's going up. I don't know. You know, I lift it up. It's going to stop at the 50-day. I see. I told you it's falling. Yeah, look at it. It's falling on increasing volume. Okay, well, that's just an inside bar. Okay, well, that's a higher low. I can see it, but I don't know. We'll have to watch and see what happens. Yeah, so it closed up a little bit on a slight pickup in volume. I don't know, but yeah, but it's a higher low, but I'm not sure. Oh, gosh, I guess other people saw what we see. Team, this is the real world. We owned this. This was on the key list. I was in Memphis when this at a wedding. Okay, all the way in Memphis. Lift it off right here. Entries right in here. Now I'm not going to lie and say we sold it up here at the top, but right there, folks, that's 100 points on a $200 some odd investment. Dang near 50%. It's a higher low setup. So let's cut to the chase on all this. We know why we're doing this, right? From a psychological perspective. We also know why we're doing it from a fundamental perspective. We have going to master a couple of chart patterns. Now, the higher low pattern is more advanced, okay? Can't stress that enough. It's riskier. But what pattern is the best? A clean and simple, flat base breakout works great. Stick with that. Look for volume through that top. Buy there. Volume, price action combined with volume action is the confirming variable. And again, here's advanced micro devices. You go, this thing looks off. By the way, that was a lower low. We didn't do that, did we? Look at the clean and simple flat base right here with a volume pickup, and then the clean and simple flat base right here, pushing through here with another volume pickup. Boom, boom. And that is a nice run. Walking up the ADMA. So I need to tell you this. This is the 200-day simple. This is the 50-day simple. This is the 21-day exponential, and this is the 8-period exponential. And one of the VIPs, who's my brother from another mother, and I know he's smiling right now out in California, there's about 2 years of hard work on that 8-period exponential moving average that we did at this turn of the century. But there it is, over and over, clean and simple base right here, and it works. Over and over, you will see the patterns recur. I don't know if there was another one on this one or not. Oh yeah, there we go. Look at this, folks. I love this stuff. This is as good as ice cream. See this flat base going sideways? Yeah, I saw that smile, Richard. I saw that, buddy. You like that ice cream. There you go. Hey, folks, ice cream is good for you. It's got calcium. It's good for the bones. There you go. Beer, hops, malt, and barley. 3 grains. It's just like Raisin Bran. Okay, here we go. I hope the kids aren't around. Okay, see the nice base right here? Look at the volume pickup. Now, this is another very important tactic that we teach. Don't look at all your charts after the fact. Look at them before the fact to train your eyes and mind on what to see. And you can say, okay, I see some tops here. Boy, there was good volume on that bar, Pat. Rallied up, but it did it and dropped, but it did on less volume than it went up on. There was good volume on that up bar too there, Pat. And it's just a clean, flat base that everybody can see. It was in a good group and it had great earnings or sales. I guess if it takes out this line, that would be good. People talk with their mouths and vote with their pocketbooks. They voted right here. Look at that. By the way, folks, this is from 2020. Okay, this is from dang near a year ago, 2 years ago. The patterns repeat over and over because they're a reflection of human emotions, and human emotions don't change. They're the same as they've been forever. And people bought. Tested, and then you get the march. Sells into strength. Sells into strength help. So I want to talk a little bit about that. Selling some into strength. I don't want to get too deep with this, but there's something you need to know. There was a rule called the uptick rule that was put in place with the Securities and Exchange Act of 1933 and 34. There were bear raids by people like Jesse Livermore, where you could sell short a stock and just drive it down in price. And they literally caused stocks, they were called bear raids. They called stocks to plummet, all right? Well, the security, and it really precipitated and accelerated during the crash of 1929, okay? No, I wasn't there for it. Okay, so let's stop there. But it really accelerated the decline in the crash of 1929. Yeah, I'm a student of the markets, all right? And it's fun. Well, the SEC got together and said, we need to stop this because these stocks can't keep dropping like that. So they put in the SEC Act of 1934. And what did that say? In order to sell short a stock, you have to have an uptick. You want to sell short advanced micro devices at 79.35. There needs to be a sell. There needs to be a buy. Somebody has to buy it, and it has to go up in price before your sell short order is triggered. It's called an uptick. It has to be bought. They eliminated the uptick rule in 2008 again. And what does that mean? And I'm not saying this to scare you, but just things to be aware of. Knowledge is power. I learned that from a good buddy of mine, Paul, who's probably listening. Paul down in Texas. Anyway, they eliminated the uptick rule. And what does that mean? You can sell short a stock, and you don't need an uptick. So you can drive it down in price. I'm not trying to be negative. I'm not trying to scare you. It's just something to be aware of. That's all. So I want to synthesize everything, though, one last time. You know why you're doing this from a psychological perspective and a personal perspective, okay? You've got your goals and priorities set right. You know what to look for fundamentally. Stocks in leading groups with great earnings and are great sales, a high composite rating, a good accumulation distribution rating of A or B. It's within 20% of 52-week highs, no low price stocks. It's got a chart pattern that everybody in the world can see, right? Like that. Everybody in the world sees this, folks. It ain't nothing fancy. A fourth grader could draw it with a crayon, okay? I hope fourth graders don't use crayons anymore, do they? I don't know. Anyway, and if they don't, let them use it on your monitor for dang sure, okay? You buy it, pushing through the moving averages, or in this instance is through clean and simple tops. You're looking for volume confirmation on the daily and the hourly or 30-minute that your triggers to buy. No volume, no buy. Continues, you can add to it. You sell some into strength that I discussed, okay? And how do you sell into strength? I'm gonna hammer this hard. You buy it, you own 100 shares. The stock goes up and starts to fade. Don't look at the 5-minute and 10-minute charts, okay? The stock's running up and it starts to fade, and you get a bar like this, okay? It gaps up, it runs up, and it starts to reverse, and it's closing near the lows. Sell some, sell 20%. That's all, no more. Let it work. Now, here's what you can do, though. You see where it drops here, and then it starts to lift again, bouncing off the ADMA. If you really want to get fancy, and we do this, you could buy some shares back, all right? But if it keeps dropping, you sell more. And own this concept. Own this. Never, I'm being really stringent here, folks, never let a good profit turn into a loss. If you bought this right here and it ran all the way up to here, it is a sin to take this down to where you're losing money. Never let a good profit turn into a loss. Another key point, never average down. You were wrong. Do not make yourself more wrong. It won't work. So we've talked about things from a psychological perspective. We've talked about stocks from a fundamental perspective on what to look for. Remember, a clean and simple entry and a good trend pays. Write it for all it's worth. Another phrase that's heard a lot is this phrase. Say it again, you'll never go broke taking a profit. If your losses are bigger than your profits, you'll go broke. That is why it is compulsory. I really mean this. By the way, I have to tell you this. Everything I'm saying, I wish somebody would have said to me when I was getting started. I wish somebody would have said, hey, come on, Pat, what are you doing, man? You're undermining your tactics. You're hurting your family. Why are you selling all of it? Wouldn't you be ticked to buy this and it goes up and you sell it and then it pulls back and it keeps on running and you can't find a way to get back in? And I know this for a fact. Darn near every person listening to me goes, yeah, God, I know how that is. Yeah, I hate that. It's awful. It's awful. So what do? You sell some into strength. You sell 20%. You're guaranteed a profit. If the rest of your shares comes back to your cost, you could sell the rest for break even and you still made money, right? That's good. Less stress leads to clear decision making. And then you have the rules and tactics of letting it work and walk up the 21-day moving average or the 50-day moving average or the 8 EMA and let it work. Let it work. And after you have a really good profit, this is another thing that I'll do. And I've talked to people at Mission Winners too. Take it off your front page. Don't even look at it. Have price alerts set, okay? Not stops, just alerts. Have it set. Maybe look at it once or twice a day. Other than that, just let it go. Really, you're not getting sloppy. You're letting the stock work for you. More money is made by letting the stock work for you than all the decision making that we do in our lifetime in relation to stocks. Let them work. So I know I covered a lot, and I know I went relatively quickly, but I had a lot of material that I wanted to cover. And I will say this, team, and I'm speaking from my heart. I take this very seriously, not just for myself, but I will also tell you this. And some of you know me really, really well. I never want to hurt anybody, okay? What I shared with you, I hope helps you. And yes, I've been involved in some very serious situations with people that were contemplating suicide. Not Mission Winners, folks, nothing like this, nothing related to the stock market. But there's times you got to be there for people and do things to help them. Not related to stocks, it's related to life. So enrich other people's lives. The last point I want to make on this, take care of yourself. Richard's probably going, what is he doing now? No, I'm speaking from my heart. Take care of yourself. Work hard at this, but get away from it. Go out and exercise. Go run, go walk. It's good for your head and it's good for your heart. Take care of yourselves. I really mean that a lot. It's important. Develop good relationships. Have quality. Work with other people. If you do, pray. Prayer is a good thing. Do things like this, but I do stress. I had an advanced psychology class. and this is the last thing I'll say, and the teacher was brilliant. It was a very intense class. His specialty was treating rapists. And man, did he get down to some serious conversations. But I'll never forget, he was a doctor, and he said, I want you all to do something, and I'll share this with you. Take a look at your hand. Move it. Look at the joints. Notice it. Really study it. And then he paused. And I was in my 20s, so I was very impressionable, but I think it's still a profound thought. He said, I want you all to look at your hand closely. And then he paused and he said, take good care of it because you're going to be buried with it. And you say, what a downer. No, the whole point of this talk is help people make money, help them speed up the learning curve, help them to become profitable more faster, right? Taking care of yourself. Take care of yourself financially, but take care of yourself psychologically, mentally, and physically. Really important stuff, because if you're sick, none of this matters. Take good care of yourself. You'll have more energy. I'm grateful, I got energy, I'm going. Do that, and that'll really help you. I know it's not related to stocks, but indirectly it is, because it's related to who you are and what's going on up here and physically. Anyway, I hope that didn't offend anybody. Richard, I hope that was all right to say.
Yeah.
But it's the total package, folks. It's the
Perfect.
total package. And yeah, I'll be honest, I've had scares in my life. I've been operated on for some serious things. It's life. So, okay, Richard, let's do some questions, man, because I'm talked out for right now.
Yeah, sounds good. And Pat, thank you so much for that presentation. And for everybody watching, let me know your questions in the chat right now. And I've got some notes right here as well. First of all, Pat, I'd love to ask you, before that clean and simple base pattern completes, what do you look for to potentially, put it on that list for the next day? What do you look for in terms of the actual setup? And also, what are you looking for on the hourly chart to see that volume surge to indicate that, okay, volume's coming in, other people are buying it. Let me go ahead and enter right through that line.
Awesome. Great. By the way, team, that's a great question. By the way, I use the word team because that's what I call everybody mission winners. And you're all part of a team too. Hey, you know what? We're a team right here. We're working together. What do I look for? And again, I need to share this with you too. Don't be afraid to ask questions. I will never criticize. Man, that's a stupid question. I ain't going to do that. You don't kill the human spirit. This is hard enough. We got to help each other. We got to push each other and pull each other. Got to keep going. Here's what I look for. I'm looking at the daily chart. It's approaching the pivot price. I'll take it to the hourly chart and I will look. This is too far back to go to the hourly. I will look for a volume surge, volume picking up as it's approaching or hitting the pivot. And I will look for a volume surge on the hourly or the 30-minute or maybe even the 10-minute chart if it's near the beginning of the day. Look for that volume surge. People talk with their mouths and vote with their pocketbooks. Look for where that volume is coming into it. And you'll see it surging. You'll go, my gum, they're buying this stock right through that pivot. I'm buying it. You can see it, and you can see it beforehand. You can see volume coming into it as it's approaching the pivot. And you're not day trading. It has to make sense on the day chart, folks, or you don't even look at it. But if you see that volume surge coming in on the hourly, 30-minute, or 10, you're good. Now I have to share this with you too. And this is important. I share this with the mission winners folks all the time. You look at it, it's approaching the pivot, and you look at it on the daily, of course, first, and you can look at weekly. But what else do you do? And by the way, it's important to look at weekly charts on these setups too. You take it to the hourly, and you see volume coming into it. You don't need to look at the 30-minute or 10. It satisfies the requirement. It's good. It's a heavy volume on the hourly. That's a go. No reason to look at 30-minute and 10. If there isn't a lot of volume on the hourly, then you look at the 30-minute or 10 up closer to see, yeah, there's some volume coming into that. And it's it's a great tactic. It's relevant to what we do. People talk with their mouths and vote with their pocketbooks. We're looking to where they're voting. And if they ain't voting, I'm not voting either. I'm not going to do it. Why? Because other people might see it, but they're not buying it. And let's be pragmatic. It's going to take more than you or me to move the stock. It's going to take a bunch of people buying it, which is why we love clean and simple. So take the daily, hourly. If it's heavy volume, it's a go. It's a go. There you go. Anyway,
Yep.
Good question. Thank you. Whoever
Yep.
asked, thank you.
No problem. And we've got about 9 minutes left, so I want to get a few questions in, Pat.
Go.
Yeah, first of all, once you've got a position, say you bought this AMD breakout right here, and you've maybe sold 20% to strength, how are you using your moving averages to try to follow the rest of the trend and exit as the stock starts breaking down?
Great question. I love it. This is the 8-period exponential moving average. This is the 21-day, and this is the 50-day. As long as this beast is trending up the ADMA, I'll stay with it. I'll stay with it. Now, when I see a bar like this, where it's very extended in price, it gaps up, runs up and reverses down on a pickup in volume, that can be a flag right there to say, I'm going to sell a little bit. Okay, I'll sell a little bit into that strength. But what will I do if the next day it drops down below the 8-day? Okay, and volume's coming up, I'll sell a little bit more. Sell another 20%. Don't sell all of it. Might keep going, but sell some. Rallies up, goes here. Look at this bar right here, folks. Watch this. This is great. I love this. Is fun. See this bar right here? See, that's a good bar, right? I'll make this bigger for you to help you. Okay. And then it does this. Look at this bar. It gaps up, it runs up, and reverses down on a pickup in volume. Now, it found support at the ADMA, but we got to be careful with that. We got to watch this. Boom! The next day it gaps up and it loses the 8. You think we're the only people in the world that saw this? Other people saw this and said, I better be careful. The next day, gaps up a hair and loses the 8. Fairly heavy bond. That could be a sell. Sell some more. Don't sell all of it. Let it trend as long as possible. That's a trigger that works. And it's not fancy. It's conceptually simple and correct. Good.
Perfect. And there was a question about basically what position sizes you use on a typical basis, and basically in terms of how many stocks at once you'll hold in your portfolio. And also, I'd also ask, do the market conditions change kind of your max position size?
Great question. Yes, when when the market conditions change, my position size changes with it. I'm always adapting to what's going on. Good investing is not one size fits all. In a good market, we'll say your goal is to get to 100 shares, all right? This is Cansom level 3 or 4, and the market's good. Your first purchase is 50 shares, price goes up. Your next purchase is 30 shares, price continues going up. Your next purchase is 20 shares. 50, 30, 20 for a share, for a total of 100 shares. When the market's sloppier, choppier, like this, when the market's acting a little sloppier and choppier, I'll do less shares. I'm always controlling risk. There's a time to really push it, and there's a time not to. And by doing less shares, it helps us control risk. And you can say, yeah, but Pat, if it runs here, you won't make as much money. And I said, it's below all the moving averages. Basically, it's a riskier setup. I'm going to control risk. There's a time that I will really push it. When's the times to really push it? When it's just trending nice, okay? That's just great stuff. And when it's like, look at this. When it's not, you have to do less shares. And know this, just because the market's open for business doesn't mean we need to do business. Do less shares or don't do anything at all and wait for your setup. That's one of the biggest problems I have with social media. It's, oh, I got to do this. I got to do this. No, you don't. Focus on what works for you and do those. And when the market's sloppier, it's below a falling 50-day, do less shares. That will help you. And you can say, again, I won't make as much money. And my response is, and you won't lose as much of it because of this sloppy action. That helps you. Control risk. Manage risk. When it's above the moving averages and trending nicely, you can go bigger. You can go bigger. That will really help. That will keep you in the game forever.
Perfect.
So, good.
And how many positions would you say are in your portfolio at any given time?
Great question. Cansom level 3 or 4, most number of positions you should really ever have is 8 to 10. Okay. And by the way, with those 8 to 10, you can go on margin. Okay. In a good market. In a sloppier market, fewer positions. In a bad market, no positions. Or maybe the inverse, QID or SDS, the inverse ETFs. Other than that, you sit tight and you wait. People say, I've got to be doing something. This is one of the biggest myths on Wall Street. And one of the biggest things I see on social media, you always got to be doing something. No, there's times just to sit and wait. It protects financial capital, but it also protects emotional, psychological capital. Here's why, because if you fight with this market, you fight with crud like this, and you keep trying to buy and you get chewed up, all of a sudden you go, this is not good. I'll keep it clean. This is not good. I'm quitting or I'm messed up. I can't do anything. I got the freeze. Dr. Van Thorpe talks about the book in about it in Market Wizards, the last chapter. Avoid the freeze, control risk, know when to go in, know when to stop, know when to go smaller. There's times like right here, you see this? This isn't a time to go big. No way. You're not going to see this in any chart book saying, you wouldn't hear Bill O'Neill say, I see this setup right here. This is where you go fully margin. You're not going to say that. No, and he is a great guy. I'll say it again. Bill O'Neill changed my life. Tell you that right now. What a kind soul. Anyway, time to go big and a time to go smaller. Control that risk. When will it happen? When we turn and start trending more on good volume and you see more quality stocks breaking out a good basis with good volume. That'll help you. That's confirmation. It's like, hey, they're buying this sucker. They're buying it. There's hardly any stocks doing that right now. So go smaller and control the risk. That will help you. Good.
I think we have maybe room for 2 more questions. So first of all, there's a few people who asked, what's too extended past that buy point for you to buy? 2%, 5% past that line? And also, I want to ask you, do you care about how much the stock has run up in the past few days before it reaches that horizontal line? For instance, if it's come pretty far in just those few days, do you wait for some type of consolidation pullback before you look to buy through that breakout?
Good question. Too extended is I want to buy. First part is great. By the way, I compliment all of you. These are great questions. I want to buy near the pivot. I don't want to wait till I'm going to wait till it's up here. No, I want to. If it's pushing through this line, clean and simple base, and it's doing it on good volume, and you take it down early in the morning, you take it down to the hourly or 30-minute, and you see good volume. Hey, I'm buying. That's it. How do I start? Pyramiding, as I said. Your goal is to get to 100 shares. You start with 50. It starts to go up. You buy 30 more. It continues going up. You buy 20 more. That'll help you. That'll work. Clean and simple here, but it's got to have volume coming into it on less time frames. What was the second part of that question, Richard? I want to get it right.
Basically, in the case that a stock has run pretty hard before it's trying to push through that line, do you take that into account at all, or do you buy it anyway if it's already come 10% in the past 3 days up to that line? Do you wait for some type of pullback before you look to enter?
Great question. I will wait, or I will be very cautious and buy less shares. Let's just do this one right here, okay? I mean, this isn't a breakout, but we'll use it. Clean and simple top, and it's lifted off here, and it did it on good volume across those tops, right? It's made a huge move to get there. Mm-hmm. It expended a tremendous amount of buying power from people to get up to this point. Normally what happens, folks, they had to buy it here, all the way through here, and here, and here, and here. It's expending a lot of people's money to extend it. Wait for it to, I won't chase these that are this extended, okay? Wait for it to pull back a little bit and settle down and look for a better entry. I will not buy stocks that had it. I'm going to be blunt. I don't buy stocks that had to make a huge move to get to the pivot, to the breakout. I don't buy them. It's too risky. The chance of failure and pullback is too high. You'll increase your odds if you wait. Like right here, compare and contrast it to right here. See this base right here? Did it have to move a lot to get to that pivot? No, not a bit. Had to move what, 20 cents? This isn't bad at all. Didn't have to make this big run. That right there. This is much safer. There you go.
Perfect. And last question, I think that we've got time for. How do you handle gap ups when it's right at that pivot? So it basically, it's gapping up in pre-market right at that pivot. Do you wait for some type of intraday consolidation, or will you just manage risk and buy it anyway right at that level?
Great question. It's gapping up right at the open, and it's at the pivot price. I will watch it closely. If volume is really good right at the open, okay, I will watch it on a 10-minute chart. If it's strong price action with good volume, I will buy small shares the first 10 minutes, assuming it's not some massive gap up, okay? It's gapping up 30 points. No, I don't want to mess with it. But here's a great real-world tactic. It's a clean and simple base. It's gapping up through the pivot. How can I control risk? What can I do? Number one, it's a clean and simple base, and it's got great earnings or sales and a high composite rating. It's a leading stock in a leading group. Those constraints are satisfied. Okay, I really mean that. It gaps up. You could buy it, but buy less shares. Buy less shares. Control risk. And then watch it on the 10-minute chart. Don't go to 5. Watch it on the 10-minute chart and see how it acts. If it really starts to drop below the lows of that first bar, be very careful. You possibly have to sell at least a third or a half of your shares. The best ones, just push away. It's gapped up huge. Watch it on the 10-minute chart. Look at the price action on that 10-minute chart and look at it combined with volume confirmation. If that first 10-minute bar is like this, the first 10-minute bar is like this, there's the range of, we'll call it $2, and it closes right here, and then it starts to lift up and volume's good, you could buy some. And what would be your stop on this first 10-minute bar? If it takes out the lows of this bar, you'll need to sell at least a third or half your shares to protect yourself. Also remember, speaking of protection, because it did do a big gap up from the previous bar, okay, here's 2 price bars. Buy less shares. Many people think, oh God, I can make a lot of money. I can make a lot of money. We have to control risk too. And monitoring share size keeps you in the game forever. And overall, be very careful buying big gap ups. Very careful. I rarely buy them. I'll wait.
Perfect.
Good.
Perfect, Pat. Well, I think that's unfortunately all we've got time for, but thank you so much for your time. Thank you all for the interaction in the chat. Some great questions were asked. And shout out to Alex for just donating $200 to St. Jude's. Thank you so much. And if you're enjoying the stream, we're keeping this completely free, but if you are finding value in this, please go ahead and donate just a few dollars to the fundraiser. We'd really appreciate it. And with that, Pat, thank you once again. And next up, we've got Brian Shannon, one of my favorite traders to listen to. So stick around for that. We'll be coming up at around 10:45. So Pat, thanks again for coming on and being our first speaker of the conference. Really excited to have you on.
Thank you, Richard, for asking me. I'm honored. I hope what I shared helps everybody. I appreciate it. You're doing a great job. All of you, keep going. Have a positive mental mindset with this. It'll help you. Thank you all and take care of yourselves. Good job. Thank you. And thank you, Richard.
Yeah, thank you. We'll be right back. If you're enjoying the stream, go ahead and leave a like and subscribe to the channel. And we'll be right back with Brian Shannon at 10:45. See you there. All right, everybody, welcome back to the TraderLion conference. We're super excited to have our second speaker, Brian Shannon, the CEO of Alpha Trends, one of my favorite traders to talk to, and someone who I've learned an incredible amount from. So, Brian, thank you so much for being a part of this once again, and welcome.
Hey, thanks, Richard. Thanks for putting this on. We've got a great group of speakers here this weekend and next weekend, and I think there's going to be a lot of common threads, obviously, because you've chosen people who are successful in their fields. And one thing I want to talk about today is really kind of time frame. I think that my time frame tends to be a little bit shorter than a lot of people, and that is working well in this market environment in particular. So let's share the screen and get started. I've got a brief PowerPoint here, and it's it's not, believe it or not, about the anchored volume weighted average price. I'm going to save some of that good stuff for when that book comes out here later in the year, which is a true thing that's actually happening.
Looking forward to it.
So lessons of the bear market. Is it over, and should we care? So I try to make it a little bit interesting of a title, I guess, kind of a clickbait type of title. That we're still in the throes of a decline. That's we're seeing we've seen several bounces. I've put up a chart of the S&P 500 that showed 4 bounces that were, I think, 8%, 11%, 10%, and 9%, something like that. So, but the sum of the declines is still greater than the sum of the rallies. And that's the way it is, of course, in a downtrend. That's in fact the definition of the downtrend: lower highs and lower lows. So is the bear market over? That's anyone's guess. Truthfully, I'm not here to answer that question. I honestly don't care. It's not my job to try to pick the bottom and say that was the end of the market decline. The way I look at it is anytime we have declined down to a significant level, like we have, let's say, in the S&P 500 at the key volume weighted average price, then we take a look at that level on shorter term time frames and see what's happening under the surface. As the market starts to firm up a little bit, and we're going to talk a lot about the 5-day moving average, and that 5-day moving average starts to flatten out, then I start to see, I'm starting to see in my charts prior to that there's more long setups, and then the market starts to firm up a little bit, and then the market makes a higher high above a rising 5-day moving average. To me, that's when I'm bullish. So I'm wearing 2 different hats, and we always have to. If you're a trader, you have to say, here's the time frame that I'm trading. The trend that I'm trading right now is a swing trade time frame, but I know we're still within the confines of an overall bear market. And maybe this is the low, but it's not my job to try to pick the low. Instead, I'm looking at it and saying, I'm going to buy some stocks. If these stocks continue to go higher and I don't get stopped out of them, then I'll continue to hold them. My job is to listen to the message of the market and listen to the message of the market on multiple time frames. So again, it's recognize that big picture. And as Patrick was pointing out, and a lot, as I like to say as well, when we're in a downtrend overall, if we see a strong stock, we still want to trade that strong stock, but maybe with lesser shares, maybe a little bit tighter stock, just reduce risk overall. Most of the stocks that I've been trading have been, what I consider a B, half risk unit, basically, is what I'm willing to risk in this environment for longs. I've had some good longs, I've had some good shorts, but it's really been a choppy year. It's easy to look at the market and go, look at, these beautiful declines. We're down 70, 80, 90% in some of these previous winners: Roku, PayPal, Zoom, Peloton. Your list is as long as my leg. And both of them put together probably. But the point is, looking at those stocks and downtrends, it's easy to say, wouldn't it have been great to just short up there and still be short? And I shorted a lot of those stocks at much higher prices, but I've also covered them. And, the short side is just so much more difficult to hold for me. And, I hear a lot of other people say the same thing. In fact, Stan Druckenmiller said, it's more difficult to trade on the short side. And, he's the guy who broke the Bank of England. So here we have, a difficult market environment. And for most people, if you can just survive in this market, not give up all your money, and for when it is healthier again, then you're going to be in a much better position to capitalize because you have your capital available, and your mental psychology is ready. So for me, this market's been a grind. I'm up on the year. I've been up pretty much all year. It's not up significant, but it's up, and it's been, as I say, a grind. So the point is, whether we've made a low or not really doesn't matter to me as a trader. People, prior to the market entering a downtrend, people would ask me, Brian, what are you going to do when you go to a bear market? What's going to change? And my answer was always, honestly, nothing. Nothing's going to change. I'm going to continue to listen to the message of the market. I'm going to look for trend alignment on multiple time frames. So if we're in a downtrend and then we see the rally, the short-term rally that peters out and starts to decline again, then I'm going to get short. But I'm not going to fight the near-term trend. So we always hear people say, short the rip. Well, we're in the middle of one of these rips right now, but we don't know if this rip is going to stall out at 7%, 10%, 20%, or it's just going to keep going. So as you know, Richard, you were there in Las Vegas. The title of my talk there was Don't Buy the Dip, Don't Buy the Breakout, Don't Short the Rip, and Don't Short the Breakdown. So what do you do, right? And we'll talk about that as well. It's about looking inside underneath the surface at shorter term timeframes, basically taking your daily chart and your weekly chart and taking them on a higher resolution by looking at it basically under a microscope. So if we're looking at a 65-minute time frame, there's 6 equal candles per day. So it's basically taking the daily time frame and putting it under a 6 times magnification. If we look at a 30-minute time frame, well, there's 13 30-minute candles per day. So we're looking at it 13 times resolution, etc. So the key that, I know who I am in the market, and I've just identified that. I'm a swing trader. I look for trends that will last. I'll do some day trading if that's what the market gives me. But my goal is that I want to buy a stock, and if I'm right in it, to let the market tell me to continue to hold it. It's up to the market whether I can swing trade it. It's up to the market whether I can hold it for a longer period of time. I don't look at a stock and say, I'm going to hold this for X days or X percent. It's, I have an idea of what I think the stock should do, is capable of doing. But as always, risk management is job number one. So who are you in the markets? There's so much noise out there, and people will say that's the bottom, and the loudest mouths out there will really kind of throw you off your game at times by being loud and showing their confidence. I even to this day, Richard, I find myself sometimes I just have to turn certain people off because I look at what they're saying and the passion with which they say it, the conviction with what they say about a stock. And I start to go, what does this person know? And I look at the chart and I go, this is a piece of shit. What are they talking about? I got to just tune this crap out and just really listen to the message of the market. We want to be aware, to me, fundamentals and technicals are kind of the same thing. And here's what I mean by that, in that they're just a reason to look at the stock. The fundamentals, to me, I want to know all the things that William O'Neill taught us, the things that I learned, 30 years ago. I want to know if the company's selling more stuff, whatever that stuff is. It's good to see the revenues are increasing. I want to see more earnings, that they're making more money selling that stuff, whatever it is, but not because I care about the company. I mean, it's nice, good, we're voting for the company. I don't view myself as, hey, I'm partners with this company. I know what I am. I'm a trader. I'm taking advantage of price movement. But when it comes to fundamentals, I know that there are big institutions that are going to commit, tens of millions of shares, hundreds of millions of dollars, billions of dollars to a single stock. And those guys, if I can figure out what they base their decisions on, higher revenues, higher earnings, better margins, and that sort of thing. If I understand what makes them tick, that, fundamentally, then I know that if I see a stock with a good chart, that I've got this institutional base that's most likely going to be there to buy the dips. But if they're not there to buy the dips and the stock falls apart, it tells me something's changed that they know about, and I'm no longer interested. So it's just the same as a pullback to a 50-day moving average, to an anchored VWAP, to a Fibonacci level. Those are levels of interest. That's why I call them levels of interest. They're not support until they bounce from there. So we look at them and say, here's a level of interest. Why do I care about this 50-day moving average? It's not because there's any magic to the 50-day moving average. I've spoken, several times about we really should be looking at a 63-day moving average because there's 252 trading days in a year, 63 per quarter. And the market, we have a big event every 3 months, every 63 market days, which is earnings. Instead, for whatever reason, the 50-day moving average has been popularized and, self-reinforced because we have all these people who look at it, who make decisions around there. So I want to look at it and say, hey, we're pulling back to the 50-day moving average. I'm not going to buy because we're at the 50-day moving average. I'm going to look at it and say, what happens at the 50-day moving average? Well, a lot of times big institutions that have a lot of shares will support their stock there. They don't want to see it fall apart. So on the way from 20 to 30, they might have sold, 500,000 of their 5 million shares. As it pulls back to the 50-day moving average at $26 per share, maybe they're going to stick in a bid for 200,000 shares just to support the stock so that 4.5 million shares don't fall apart. And they know that if they put their bids in there, well, what's going to happen? It's going to make the short sellers think, hey, there's a big bidder in here. I shouldn't be shorting. In fact, maybe I should start to cover some of my shorts. And then other people on the sidelines, like myself, who see this action occur on a shorter term time frame. I look to that 50-day moving average and I look at a shorter term time frame and I see it moving back and forth for the last couple of days. I see the 5-day moving average flattening out and I say, here's a potential candidate for trend alignment. Now I'm interested in this stock. Oh yeah, plus they have great revenues and earnings and all the reasons that people are interested in stocks. It's about, a lot of people spend too much time, looking for a cup and handle or a head and shoulders instead of saying, what does a cup and handle represent? It represents a stock that pulled back, it rallied to a level of resistance that it hit, it pulled back again, but this time the buyers were more aggressive. Instead of pulling back to 20, it pulled back to 25. The buyers didn't wait for a pullback all the way to 25 before they stuck in their bids and said, I want this stock here and now, I'm willing to pay up for it. So they're becoming more aggressive price-wise. And then if we've got an 8-week cup and a 3-week handle and it bangs up against that level where that, let's say it's 30 at that peak where it fell back from previously, well, what do we see? We see more repeated tests of that supply. And as we see, any time a level of support or resistance is tested more frequently, the more likely it is to fail to hold. So in the case of what's been resistance at 30, we came up once, we were rejected, we pulled back to 25, came up and hit it, we were rejected, pulled back this time to 27, and then came up to that 30, and we're working through that supply at $30 per share. So maybe there was 1 million shares off of the first time. The second hit, there was 700,000 left, and on the third hit, there were 200,000 left, and that quickly gets chewed through. Then the shorts start to cover, longs come in on the sidelines, etc. So it's just all about trying to understand what's the psychology of what's happening, not just being a monkey who can look at patterns. That's one of the things I dislike about technical analysis is kind of the patterns, and in particular, candlestick formations, the 3 crows, this and that. It's good to know what they represent, but just, memorization of here's what this candle formation is, instead of looking at those candles on a shorter term time frame and watching the supply and demand, watching that battle underneath the surface and try to see where do we have evidence that the buyers emerge victorious or that the sellers are able to defend price action that's not able to break out, and then we see a failed move and the stock breaks down quickly. That's what's most important about technical analysis that people don't get. But they just look at textbooks and say, okay, I just have to remember these 5 patterns. That's great. I want to see bigger volume. But what does bigger volume represent? The big volume doesn't really occur until turning points. Volume expands in the direction of the trend, peaks at turning points, and diminishes on the pullbacks. So a lot of times, people who wait for the volume on a breakout, they're going to be late because they're looking at the stock breaking out and they don't trust it because the volume's not there yet. And you've got to learn to trust price action. So again, that's who I am in the markets. if you're an investor, you probably got no business listening to me. Some people will try to argue with me and say, yeah, but interest rates and this and you know what the Boris Johnson's doing over. Give me a break. I mean, it's just got nothing to do with what I do in the market, and it's somewhat of a lazy approach as well because I don't have to listen to all that stuff. But it's that's what the cynic might say, but for me, it's the realistic is that stuff simply doesn't matter to making money in the market. What they say on CNBC, they're all well intended over there. They're not trying to harm people, but it's got nothing to do with. I don't have it on. Why would I listen to CNBC during the day? I might as well have the gardening channel on. It's just as useful to me because it's not about trading in my time frame. So know your time frame. That's one of the most important things people can get. Other bigger mistakes are what I see most of the time happening is people chasing things and they're reactive. They wait for that volume. They wait and that volume will come on Friday in Roku as it hits the year-to-date volume weighted average price after a 40% rally. So people start to get excited after the move instead of anticipating where the momentum might come in. And I've shared this chart on Twitter, 100 times. I came up with it. I think I first printed it out in 2008 when I did my book, and it's kind of an expansion of Stan Weinstein's work, of course, and Wyckoff before him. This stuff has been around forever. It's based on the economic cycle, and I'm not going to go through the whole thing. By the way, if anyone wants a copy of this, or if you want to get an email once a week to my weekly video, just go to alphatrends.net and there's a sign up box there and you can get a high resolution copy of this market poster sent to you. I also put a full color copy 11 by 17 in each book that you buy on Amazon. But if you understand market structure, it tells us how the money flows through the market, and it gives us the objective look at it. What a lot of people do, sometimes is say, we're clearly in a stage 4 decline for the overall market right now. Are we here at this point? Are we here? Are we there? I can only tell you, once we're well past. The point is we're in a stage 4 decline. Some people get a little hung up on, are we in stage 4.2, Brian, or do you think it's stage 4.3? I don't know. We're in a decline. It really doesn't matter. The point is I'm not looking to make a decision about now is time to start buying stocks. If they're in a stage 4 decline, just don't try to buy these stocks over and over again. We've seen these stocks, what was the one on Friday? Upstart, I think, that, again, hit, another gap lower after being down 70, 80, 90%. PayPal over and over and over again. People have been telling me it's a great company, it's down too much and all that. I don't care. It's down. They can they go too far to the upside, they go too far to the downside. If they don't scare you out in this stage 1, they will typically wear you out in stage 1. Stage 4, they don't scare you out. Stage 1. So what is stage 1? So stage 4, we're in, and these are on that poster. I've just kind of put them here so people can look at them. In a stage 4 decline, late decline, we still have downward momentum. We can see rallies and declines come quickly, but violent short squeeze rallies occur. And then as the accumulation occurs, what we see is we start to see those longer term moving averages, they're still in decline. They need to flatten out and give us time to look at the market and say, where do the buyers really gain control? We're going to see rallies, but those rallies are going to fail. Most rallies with a declining 200-day moving average will fail. It doesn't mean there aren't some great rallies in these stage 1 stocks that will fake a lot of people out, that'll go 50%, 60%. But they're still in stage 4 declines, and they're more likely going to dribble back down. So we use moving averages as a simple reference point. I like to use a simple moving average. Richard uses a 21 EMA and a 15 SMA. Use whatever makes sense to you. One thing I'm not here to do today is to tell anyone what they should do. I'm here to open your eyes to a couple of things that work for me. And if it makes sense to you, great. If it doesn't, and you want to argue with me, I'm just going to block you because I don't care. I know what works for me, and I'm not here to convince anyone of anything other than, learn to be objective about the way you look at the market. Have an open mind. But a moving average is simply a reference point, something to compare price to. It's, it's mathematic, it's time-based, it's somewhat subjective because it's time-based, but the market, like history, is an agreed upon collection of lies. The truth in the market is an agreed upon collection of, I don't know, not lies, but reference points. And we've agreed to use a 50-day moving average as a reference point. For whatever reason, nobody sat around and voted on it. It's just become the default. So moving averages don't lead the market. There's no such thing in my mind as a leading indicator. Nothing leads price. Price is the absolute truth. The VWAP doesn't lead price, it follows it. Fibonacci doesn't lead price. MACD doesn't lead price. It can give us, ideas about when the momentum might be waning, but nothing leads price action. If it was, then someone would find it and just use it to make money all the time, but it doesn't exist basically. Is that for me? Okay, no. So the way that they work, they tend to act as support in an uptrend, and they tend to act as resistance in a downtrend. As I mentioned, it's the psychology of why they tend to act as support or resistance that's more important than just saying, hey, it's a 50-day moving average, I'm going to buy it. That is that's the first grade level understanding of the 50-day moving average. Understanding the graduate school is saying, what are the shorts doing? What are the shorts who are positioned from a higher price doing? Well, they're likely looking at this and saying, hey, it's down to the 50-day moving average. We shorted it as it was 2 deviations higher. Now we're going to start to nibble on some. We're not going to try to be too aggressive about buying it because we don't want to spook the market or tip our hand with those buyers here. We want to cover as many shares as possible. What about uneducated shorts who are looking at it and saying, hey, it broke below the 50-day moving average. It closed 1 day below it, but the trend of the 50-day moving average is higher. And you get those uneducated people who say, hey, it's below the 50-day moving average, I'm going to short the stock. But they don't look at the trend of the 50-day moving average, and they don't look back to March 28th when with the data that we're replacing in that 50-day moving average right now. And on Tuesday, they don't look at the data from March 29th. And on Wednesday, they don't look at, so I move a bar forward each day to say, here's the data we were getting rid of 50 days ago. What can potentially make that change? If we get rid of this week's worth of data over the next week, that 50-day moving average will flatten out. So it's about anticipation rather than reactive all the time. When prices move back and forth above and below moving averages, it represents indecision. And moving average crossovers are the worst type of indecision. It's telling us, some people think that moving average crossovers are a reason to buy or sell. To me, they're a reason to avoid. It's saying that this, the short-term trend crossed down through the longer-term uptrend. So we've got time frame trend confusion here. That means stay away from it. So when the market is, crossing back and forth above and below these moving averages, it says, just leave it alone. Wait, anticipate. Try to figure out if you have to trade this stock, if it's Apple or if it's Netflix or whatever, try to anticipate, when does the direction of that moving average start to flatten out and turn higher again? What would be the scenarios that cause that to happen? Is there anything in the economic calendar that's going to, come as a shock? Is it the jobs number? Is it the CPI number next week? How do I manage risk around those? There's no one-dimensional way of looking at the market. One thing I've been I liked recently is, people have been asking me, they always ask me, so Brian, what's the most important time frame to look at? And my answer is all of them. It's truly about multiple time frame analysis. How does this short-term picture interact with and build upon the intermediate term trend, which interacts and builds on that longer-term trend? The sum of the short-term trends is the long-term trend, so the short-term trend leads the long-term trend. But the point is, it's how they work together. It's like asking what's the most important ingredient in a chocolate chip cookie. Well, a chocolate chip cookie wouldn't be a chocolate chip cookie if you didn't have chocolate chips. So it must be that. So if you just say, okay, that's all I need is chocolate chips for the best chocolate chip cookie ever. And if you had that, all you would have is a pile of chocolate chips. You still need the dough, whatever makes the dough, the flour, the water, the egg, whatever else, the salt goes into them. They all have to work together. There is no one most important ingredient in any recipe. And it's the same as the true in the market. There's no one most important time frame. There's no one most important moving average. It's a dance. It's how they all flow together to give us the idea of how they flow together and how we can anticipate. So this is the S&P 500 from 1999 to 2012. So we've got 13 years. And a lot of people on this call probably, weren't trading then. I was trading back, through all of this. And, we've got some simple things on here. I've got a 20, 30, and 40-week moving average. The 40-week moving average is the bold one. That's, the 40-week, there's 5 days in a week, generally speaking. Sometimes we have 4, due to holidays and that. But generally, there's 40 weeks times 5 is a 200-day moving average. So when we look at a 40-week moving average, we're basically looking at the 200-day moving average. It's not perfect, but it's darn close enough. In 2000, we peaked at 156 in the SPY and dropped over the next 2.5 years to 77, a decline of 50%. Look at these rallies in here. And I've got a chart somewhere I've posted that shows what these rallies are. But these are massive rallies. I mean, this one here is from 100 to 130, a 30% rally. That's a bull market, right? 20% is a bull market. But it's within the context of still right up to that declining 40-week moving average. Rallies with a declining 40-week moving average are generally going to fail. And even here, when we were above the 200-day 40-week moving average, the direction of that 40-week moving average was still lower, and then it failed. So over here, we started to see in mid 03 that the 40-week moving average started to flatten out. So all the people that tried to buy the dip all the way down endlessly got chopped up. If instead if you're an investor, instead you just waited for it to make a higher high above a flat to rising 40-week moving average, you would have avoided all that nonsense and purchased right here at 80, $90, let's call it. And then again, a rising 200-day moving average. It flattened out here, and then we broke support. So, if you bought here at 88, maybe you got out at 138, up 50 points. It sure as hell's better than being a buy and hold investor and seeing it turn into a loser of 12% 8 years later. So but the point I'm trying to make here is these concepts, whether it's the 40-week moving average, the 200-day, the 50-day, even the 20-day, the 5-day, or whatever, it's the same on every single time frame. If instead you decided, hey, I'm going to sell short when it makes a lower low below the declining 200-day moving average, like shorting right here, and then you would cover over here, shorting right over here, and cover over here, or buy here. And, it got a little choppy in there, but here's where we are today. Does this look like the beginning of a new uptrend? Absolutely not. That thick black line, that's the 40-week moving average. We still have a very clear pattern here, lower highs and lower lows. We've got a declining 10-week, that's the 50-day, 20-week, 30-week, and 40-week. So that's a 100-day moving average, 150 and 200. This market is going to take some time to heal. We don't have an accommodative Fed. Maybe that's going to change. Who knows? Who cares? We don't have to know what the Fed's going to do. As the Fed has been clear, they're way behind what the market has done. I did a chart on that on Twitter this week. The market was way ahead of the Fed, and they'll be way ahead of the Fed when the market starts to rally. And the market is a discounting mechanism. It looks forward 6 to 9 months. The Fed doesn't do as good a job as that. They're scared of the here and now. They're scared that if they do something that's preemptive, that they might actually see, because they're not stupid, they might see what the bond market's seeing, but they can't do it for political reasons because, hey, well, why did you raise interest rates? The economy's good, or unemployment's this, inflation's not there yet. It's only 5.2%. Instead, now we're at 8%, and that's when they decide to start to move. So again, the moving average psychology, I think I've covered that. Why it acts as support and resistance is what we really want to know. Richard, what time frame do you think this is right here?
I'd say maybe a 65-minute time frame.
It's got a 50 period moving average,
So
and
yeah, a 15-minute time frame.
it could be. The point is, it could be a weekly chart.
Yeah.
It could be a 30-minute chart. No one would know the difference until I do that. This was the S&P 500 on Friday, yesterday. This is a 1-minute chart. Each one of these candles represents 1 minute. Tell me how the analysis on here is any different than any other time frame. That's the beauty of technical analysis. It's the fractal nature. Fractal means basically, that same patterns are going to repeat on different time frames. You only have to understand technical analysis on one time frame and then be able to switch down to shorter term time frames. If we look at the direction of the 50-minute moving average, so the 50 period, the period that we're looking at is 1 minute on each one of these candles. If we bought when it made a higher high above the flat to rising 50 period moving average, we bought at 387.25. If we got stopped out as it made a lower low, maybe we got stopped out right here at 389.25. So that's a nice 2-point rally. What if we shorted when it made a lower low below the flat to declining 50 period moving average? We would have shorted it at 389 and then cover right here as it makes a higher high at 388.75. And then what if we buy again as it makes a higher high above the flat to rising 50 period moving average at 388, and then we get stopped out at 389.25. It doesn't matter what time frame you're looking at. The concepts are exactly the same. The cyclical flow. I'm not making this up. I didn't go cherry pick. I've been using the S&P 500. I said, let me look at the S&P 500 on a 1-minute chart. I'm going to put that on there. Whatever it is what we get. And this, we just can't make this stuff. There is order to the market. What about the bonds? Should we care about the bond and what the Fed is saying, or is it just better to look at this chart instead? This is the TLT, the 10-year notes. Back in 2019, they started to rally. They made a higher high above the flat to rising 40-week moving average. They continued to find buyers on that pullback there in late 2019. Then it broke below it and made a lower low. So right there, you want to enter, exit your long. So if you're an investor, you bought here at 125 to exit at 160, and then avoid all this nonsense that came. As it started out, maybe you purchased right here. That's a higher high above the flat to rising 40-week moving average. Does anything work all the time? No, of course not. That's why we have our stop. When it comes to stops, the way I look at it is one, I'll look at the weekly and say, here's where I'm entering. Here's the thesis for my trade, but I'll look to shorter term time frames. And my stop, if I was in here, probably would have been under this candle right here, this big white candle, the breakout candle. And as it failed, as it broke below that, it said that failed. I don't want to be long anymore. The pattern of higher highs and higher lows that looked like it was emerging doesn't exist. So why would I want to be long? So I take my small loss and move on. And I say, hey, it's making a lower low now, but below the flat to declining. So now I'll short these bonds and stay short until such time that the market tells me. Or maybe you start managing it on shorter term time frames. There's no perfect way to trade any of these things. The only perfect way is what people know after the fact. We have potential levels of support and resistance. We have areas of interest. So what I want to talk about a little bit is the 5-day moving average. If you follow me on Twitter, you saw this week, I talk about this all the time and use the S&P as an example mainly, but it's what I do with stocks on an individual basis as well. I just, the S&P is consistent, so I talk about it every day. And I think that's there's a little bit, I'm not really an S&P trader. Sometimes I trade the SPY and maybe some of the leverage stuff, but I look at it as a consistent way of showing analysis. That it's there to see each and every day so we can see the concepts. The concepts of what I was pointing out earlier in the week, we're starting to turn sideways, but the 5-day moving average is flattening. And then on Wednesday, we're turning, the 5-day moving average is starting to flatten out. And if we get rid of this data from last Thursday tomorrow, and the stock is in this area, it'll be above the 5-day moving average will start to turn higher. So I'm anticipating what makes it so that the market could potentially turn. So we have to identify what a market day is. A market, the market is open from 9:30 a.m. to 4 p.m. Eastern. Of course, I'm talking about U.S. equities. That's what I trade. That's all I trade. I don't trade any ADRs, any foreign markets, Forex. I do a little bit of Bitcoin trading, but that's a different beast. And I'm really kind of off that for a while now anyways. But the market's open 6.5 hours a day. And that's important because if we look at charts, we want to look at consistent. We want to look at apples. We don't want to look at 6 apples and 1 orange, meaning if I look at an hourly time frame, I don't want to look at, that first 9:30 to 10 is considered 1 full candle on an hourly time frame, but it's only 30 minutes of data. So any moving average I have put on there, any VWAP, anything says that first half hour is twice as important as each of the following candles. So what we need to do is say, let's break this down so we can make more sense of it. 6.5 hours is 390 minutes per day. So if I'm looking at 5 days, I want to know the average of the last 5 days. I want to know the average of the last 1,950 minutes. The 390 times 5 is 1,950. So if I'm looking at intraday timeframes, I don't want to look at any time frame other than these. So if I look at 195 period, that means there's 2 equal candles per day. 130 minute, there's 3 equal candles per day. 130 times 3 is 390. A 78 minute sounds goofy, but if you do 78 times 5, it equals 1,950 minutes, etc. over and over again. So we want them equally divided. So I don't want to look at a 4-minute time frame. I don't want to look at an 8-minute time frame. I don't want to look at a 60-minute time frame. I want to look at a 65-minute because there's 13 of those over 5 days. Or if I look at a 30-minute, there are 30 minute, there's 13 times 5, 65 of those. So the way to look at a 5-day moving average, and I'll show you this on the chart as well, we want to look at the average of the last 1,950 minutes. If we look at a 5-day, if we're looking at a daily chart, constructed daily candles, and we're looking at it at 10 o'clock in the morning, what do we see? Well, we see a 5-day moving average is actually the last 4 days plus 30 minutes of today. It's not 5 days until the end of the day. So I want to look at time frames where I can say, here's where the true 5 rolling days are. Any point in there captures 5 full days. So on a 10-minute time on a 195-minute time frame, where I have 2 equal candles per day, over 5 days, there's going to be 10 of those because there's 2 candles per day. 5 days, it's 10. So over to a 10-minute time frame, 195 period moving average is the 5-day moving average, because 195 times 10 is 1,950. 15 times 130, 26 times 75. They all equal 1,950. That's how you do the conversion. This is the S&P 500 through mid-morning yesterday on the SPY. And these are ones, these are trades and things that I was pointing out on Twitter that, we're in a downtrend, but, if you're looking for bounces, you anticipate as the 5-day moving average starts to flatten out, you anticipate that it's going to make a higher high above that flatulizing 5-day moving average. And then you participate as it enters there and you set your stop. So the next day it gaps up, the stop will go under here. As it makes a higher high, raise your stop under here, boom, you're out. So basically a break-even trade. It pulls back and you avoid this big decline from 406 down to 382. It then creates this little inverted head and shoulders pattern. But what is an inverted head and shoulders pattern? It's simply just a transition of sellers in control with lower highs and lower lows to buyers in control. Now we have a higher low, and if we break this, we have a higher high. So at that point, as it starts to flatten out, we participate right here. I remember this was Federal Reserve minutes that day. and it had a beautiful rally from 397 to to 416. And if you start to put numbers on these, what would you see? This would be a stage one accumulation right in here, stage two uptrend, stage three distribution, stage four decline, stage one accumulation, stage two uptrend, stage three distribution, stage four decline, over and over again. So when we're looking at these, we either want to short, if we're long, worst case was an exit over here. Realistically, an exit underneath this higher low, but this would be a place to sell short and ride this trend down and maybe get stopped out on this candle right here. Didn't get you out at the bottom, but that's not the goal. Only liars get in at the out at the bottom of their shorts and in to their longs. So right now we're on a buy because the 5-day moving average is higher. That we have to realize, though, that's within the context of a much bigger downtrend. What's your time frame? This is a swing trade. I'm giving the bias to the long side right now, but it's with less confidence. So here's a 5-day moving average on the daily time frame. Again, there's that math. Here's how it looks, and I'll just go forward so we have them all four together here. So this is the same. I put this together a while ago. There's no reason to change it. But what it does is allows us to say, here's where, when we look at a 65-minute time frame, a 30-minute time frame, or 15, that 5-day moving average is going to be in the same spot on all these time frames, and it's going to show the same slope to it. So it becomes a true reference point as we move across time frames. One mistake that people do a lot is they say, Brian, I put a 5 on my 65-minute time frame and it doesn't look anything like yours. It's because they put a 5 period on. They didn't adjust it to a 30 period moving average. So I always have to put this in here because we're still in a decline. Don't buy the dip. Buy strength after the dip. NVIDIA, everyone loves this stock. Everyone's been trying to, not everyone, but a lot of people are still trying to buy the dip in this stock. But here's 26 through 2020. It was a monster stock. And then it dropped 57%. And people were trying to buy all the way down, just like they're doing right now. It's down too much. It's a good company. Their earnings are going to be this. They're selling Bitcoin miners. There's this new gaming system coming up, and they're going to have this chipset for Web 4.865 and all the bullshit we hear. The point is, it's in the downtrend. It's below these longer term moving averages. We're going to see big rallies. This was a huge rally from 30 to 48. But guess what? It was still had a declining 40-week moving average. So it was destined to fail. It took 9 months. If they didn't scare you out, it took 9 months of sideways action for that 40-week moving average to flatten out right in here. And then as it makes that higher high, why not just make life more sane and buy on the way up? Let let the institutions battle it out and create all this nonsense here, and then ride that wave as it starts to break. You ride it all the way in till it starts to say no more. This is NVIDIA today. What if we had a similar type of action? So, from that 2019 buy right here, okay, if you bought right there, it rallied 686%. And now we're below all these key moving averages. This is where we were midday yesterday. And I just drew this in and said, hey, what if we rally up to this, the 40-week moving average? This is about the slope that it's taking. What if we rally from 140 to 190? A lot of people say, hey, that's it. I'm the genius. I picked the low. But what's more likely is, it bounced from the 14th floor. It rallies. It bounces up to the 8th floor. It comes back down, bounces to the 4th floor. But why not buy it in 6 to 9 months after we've we've wrung the towel out and we know who's in control? The buyers are back in control. Now you can buy it in your investment account. Now you can buy it in your 401k. Some people hide and say, hey, well, it's in my IRA. I'm in it for the long term. That's your IRA. That's your retirement. Are you fucking kidding me? That's your most important account. You can't let things just slide in there. You have to manage that money more aggressively than any other money. That's how you're going to retire. And you don't have to worry about taxes in those accounts. Occidental, you don't have to worry about tax consequences of buying and selling that. Anyways, let's talk about a stock that has been a recent winner. Occidental Petroleum. It was a Complete piece of garbage through 2018, 2019, and 2020. You didn't have to buy the dip. You didn't have to buy that big gap down. Oh, it's a value. Good, great. If you're truly in it for the long term, you bought it at 14, but you were down, 30% a year later. Psychologically, you felt like a loser. I know you did. I would have felt like a loser. You felt like, well, what's wrong with my process? What's wrong with this company? Why not wait for that 40-week moving average to flatten out and say the buyers, the institutions are in control now. We've wrung the supply out. Let's buy it let's buy it twice as high. Let's not buy it at 10, let's buy it at 20. And now we've got the wind at our back and we're still in this giant uptrend. So, where does that leave Netflix? Here's just another example with Netflix. Netflix dropped 81% in 2011 and 2012. It took over a year for it to flatten out and show a higher high above a flat to rising 40-week moving average. And when it did, it went on to have a huge rally. Here's where we are today. What's the hurry? We're down from 720 and we're at 187. What is that percentage like? 75%? If this 40-week moving average is going to flatten out, it's going to take some time. Forget about Netflix. It's yesterday's news. So just some general rules about moving averages. We're going to take a look at a bunch of stocks. Trade in the direction of the primary trend, whatever the moving average is for the time frame that you're involved. Forget about what other people are doing. People are saying, well, I see this. When people on Twitter say, well, Brian, this, the longer term is it? I don't care. Let's, leave me alone. I'm doing my trade on my time frame. Have blinders on. Mute people, block people. It's all noise. You don't owe anyone anything on Twitter. You have to protect your personal mindset above anything else because there's so much noise out there. But you want to look at it and say, where are we? Are we in stage 1 or stage 3? Well, it's crossing back and forth above, below moving average. Is it stage 1 or stage 3? I don't know. If it breaks higher, then it's stage 1. If it's stage 3, then we'll know because it breaks down to a stage 4 low. But if it's just moving back and forth above and below them, who cares? Just leave it alone. Anyways, they're a great reference point. The two most important questions you can ask before you get involved in a stock is, one, where has it come from? Has it expended a lot of energy? I heard Patrick talking about that a little bit about, buying stocks that are extended. Learn to anticipate. Don't wait for the breakout when it just rallied 10% in the last week. I bought that stock 10% ago, and I'm absolutely guaranteed going to sell some to you on the breakout. And there's institutions doing it as well. There's a reason people complain, hey, breakouts don't work anymore. Well, of course they don't work because people bought in advance of the breakout. And when the uneducated later money gets to it, they're going to say, hey, now the uneducated obvious crowd is getting involved. I'll sell them a piece of mine. So then, that's where it's come from. What's reasonable? The stock was up 10% in the last week and we're in an overall downtrend. Is it reasonable to think it's going to go another 10%? Not really. I mean, it's anything's possible in the market. We have to think about what's reasonable. Is it reasonable that it's going to go another 10%? If so, have a really tight stop. But where does it have the potential to go? What's the potential reward? So here's my stuff. You guys probably already follow me on Twitter. My book is on Amazon, etc. So again, if you're interested in my weekly free email, it just has my YouTube video, and I'll be making updates about my new book in there as well as I get more information about the publishing date and that. So just go to alphatrends.net and we can talk and I'll give updates there. So I guess I can talk about some stocks and some of the names that I'm looking at. So for instance, I'm in CELH, and Richard wanted to talk, I know, about getting involved. Patrick was talking about scaling into stocks and buying 30%, initially 40% initially, adding 30%, and then adding that last 20% as you have confirmation. I tend to do things opposite that. My time frame again is different. My screen is frozen. This would probably just take a minute to unfreeze. I don't know what's going on with that. But the way I like, what I think my advantage in the market is that I'm very good at the timing. So when I see a stock like CELH, I've been looking at this one like a lot of people have. It finally got back above the volume weighted average price from that peak right there. It was having trouble with this declining 200-day moving average. It rallied up again, found buyers at the rising 20-day moving average in there. So it was on my list as a buy. I bought it Tuesday morning of this week, right in here. And the very first thing I go in full size. I feel like my advantage is I'm either right or I'm wrong. And if I'm wrong, my stop is under here. Well, actually, initially it was under here. So I'm going to have a tight stop. Why is my stop under there? Because that's the most recent relevant higher low prior to this higher high that it's making. So if it comes down and breaks the higher low, my definition of emerging trend no longer exists. I don't want to own it. So I buy a full size position. And then when it rallies quickly, I sold some at daily R2 that day. That gave me a $3 gain on the first third. And you can look at it and say, wow, Brian, you gave your stock away. And you could argue that's true. Or you could say, but that's part of my process. If the stock had failed, and we have hindsight to say, oh yeah, that was dumb of me to sell there. We don't know what's going to happen. I truly believe when I say risk management is job number one, it's not just a cute little phrase. It's what I believe, and it's how I implement it every single one of my trades. If I was wrong here, it's not going to be a big loser because I'm going to get out right here before it does something like this. I'm not going to, start reading 10Ks, 10Qs, insider transactions, and go down to CVS, make sure it's still fully stocked or whatever. I'm interested in the supply and demand of the stock. And as it rallies quickly and it breaks this high and hits daily R2, I'm going to sell my first third because I've gone in with a full position. And oftentimes a full position means I'm a little uncomfortable with my full position. I want to pay for my risk as quickly as possible. So if I can take $3 per share off, and that lowers my cost basis by $1 on the overall position, right? If I take the $3 off on 1/3. And then as the stock rallies, then I raise my stop to break even. Now I can't lose in this trade. Even if it goes negative, I'm not going to allow it to turn into a loser. And instead it rallied. I got stopped out of the third right here for a gain of $8.10. And my current stop on the balance is right here. Maybe, what I think is most likely to occur with CELH, and I already drew it in there, is something like this. This is what I think is most likely going to occur. So why don't I just sell that final third right here, right now, if I think that's going to happen? Because the market doesn't care what I think. It might end up just doing this. I want to hold that last third because if I can get 5 more points out of it, that's fantastic. But if it does what I think it will do, something along the lines of this, and then it might even take a couple days for that 5-day moving average to, undergo a little bit deeper profit taking. And then again, it's always about anticipation. It's not about what, it's like what Wayne Gretzky used to say. It's not where the puck is, it's where the puck is going. So here's the 5-day moving average. I start to get interested in it right in here because that 5-day moving average is flattening out. And then I see a higher low. I love to see that higher low because now I don't have to put my stop under here. I can put my stop under here or under here. And this is where we have a stage 2 on the short term. So here's a stage 2. This could be stage 3, stage 4, stage 1. This is the beginning of stage 2. And guess what the volume is going to look like there? It's going to be real low. And then the volume is going to go like this and increase as the confidence does. It's lonely buying there a lot of times because the volume isn't there yet. So this is what I think is most likely going to happen. But I've learned the market doesn't care what I think. So I'm just going to hold my stop down here at 73.96. Is that my 74.96 rather? And if I get stopped out, that's great. It's up from my cost of 66.15. It's a great trade. I don't need to get out at the high. I've got 1/3. Bulls and bears make money, they say, and pigs get slaughtered. Greedy pigs get slaughtered, but disciplined pigs get rich. Be a disciplined pig. And that's what I'm trying to do, is be as piggy as possible And, I'm anticipating all potential scenarios, but if this happens, well, that's going to take a week or so. And then maybe on, the 15th or the 18th of this month, it's a buy again. But I'll avoid this pullback. There's no reason to be involved in it while it's pulling back. I don't need to go look at the, earnings reports and channel checks and that sort of thing. That's not my time frame. That's not my goal. That's not who I am in the market. Let's talk about, I got involved in Amgen on Friday. It's kind of, it's Amgen, it's not really a great trading stock. You can see how choppy it is. So you always be aware of the personality of the stock. Look how choppy it is. But, biotechs are strong. This one is coming out of a pretty tight consolidation. It's easy to manage risk here. That was the initial stop. Now my stop is under here. I've raised my stop from 144. I'm sorry. My original stop was 244.20. Now my stop is 246.20. That's the most recent relevant high or low. So I've already cut my risk by 2 points, and the stock hasn't done it. I haven't taken a third off, but I've already reduced my risk because the definition of trend, higher highs and higher lows. We had the higher high, and now this is the most recent relevant higher low for my time. AMN is one I'm looking at for Monday. Here's a daily chart. You can see that it broke this resistance. It had a pretty big rally, which sometimes, where has it come from? It came from 85 to 110, but it blasted through what should have been, what most people would have looked to be resistance. Instead, it leapfrogged right above it, and now it's holding beautifully above that level and consolidating with now again a rising 5-day moving average. So I'm looking to buy this one above here, and my stop is actually going to go right here. I'm not going to wait for this stop. This is my level, and if it comes down and breaks that first, the risk reward has changed, so I'll have to reevaluate it. But that's the way I look at some of these. Baiynd Gaming is one that still looks like it's destined to hit the COVID anchored volume weighted average price. It's below a declining 20, 30, 20, 50, 100, 200-day moving average. Look at the weekly time frame. That looks like a big stage 3 distribution, a beautiful stage 2 uptrend. Bigger the top, the bigger the drop. It looks like it's got an appointment down here with this COVID volume weighted average price and the 200-week exponential moving average. That becomes a potential level of where it will go. So now we have to look at it and say the 20-day moving average has been holding it back. This prior support was tested. It held as resistance. That's one piece of evidence. The 20-day moving average held there as well. And then it held again this week as it rallied. What was the volume on the rally relative, the volume on the rally, it was expanding, but relative to the average daily volume of 1.3 million shares, it was well below it. Let's look at a 30-minute time frame. Where are we? And now we start to add some anchored volume weighted average price levels. This was an important level, that gap. The average person from that gap is now losing money. From this low, they're losing money. From that high, they're losing money. From this gap lower. It's telling us from all of these points, the average long participant is really positioned somewhere around this area up to here. So what does that tell me? What do I do with that information? It tells me that, one, if it gets back above there, I certainly don't want to be short anymore. So what does that tell me? It tells me to stop. If it gets above 50 and a half or whatever Friday's high was, I don't want to be short this thing anymore because maybe it's going to squeeze and then it's going to drop later. Shorts are difficult like that. So let's go down to a 15-minute time frame. Here's, again, if it breaks below here, this is what I'm looking for. If it breaks below here, then I want to short it with a stop, worst case above Friday's high. So those are the ways that I anticipate and, look to get involved. ABBV. This one is probably a couple days early. You can see that 50-day moving average is still declining. Where were we 50 days ago? We were right here. So that means on Tuesday and Wednesday, when we replace, we get rid of this data Tuesday morning, that 50-day moving average, if the stock is right here, that 50-day moving average is going to start to look like this because we're getting rid of this data and replacing it with this data. The stock can just go sideways on Wednesday, and the 50-day moving average will begin to rise. A lot of institutions look at what's the direction of the 50-day moving average. So I'll stop talking here. I just wanted to kind of tie some of those things together a little bit and open it up just for questions about any stocks at all, VWAP, whatever anyone wants to talk about, or you, Richard.
Yeah, fantastic. And as I'll be asking a few questions first of all, but then if you have any questions, anybody watching, leave them down below in the chat and we'll get those answered as well. To start things off, Brian, I'd love to hear you talk about how you set your position sizing and whether that's based on, how far above are we from that relevant higher low where you place your stop loss.
I like to do it on, based on the R multiple concept. So, just let's say your risk is $1,000 per trade on your A setups. That is your best setups. I'm going to risk $1,000. The way I like to look at it is I want as many shares as possible in that stock. So if I am, for instance, looking to get long AMN, I want to look at it on this 15-minute time frame. What I really want to see happen is I want to see it do this. I want to see it come up to that level. I'd rather it takes a day and a half to do so, and it tightens up really nice and then breaks higher. Because if it does that, it tells me that instead of having my stop down here, and let's just call that 2 points. I'm just for reference point.
Yeah.
And if I'm risking $1,000, if my stop is 2 points away, that means I can only do 500 shares. But if it tightens up like this and my stop is 50 cents away, that means I can do 2,000 shares. So I can do 4 times as many shares and still have the same amount of risk in terms of dollars. But now my profit margin is so much, my profit potential is so much bigger in this trade. So I always really love to see, I love to see a stock that kind of rallies up, has a little shakeout maybe, traps people, then creates the higher low. And then that tells me that they got the weak holders out over here. They probably suck some short sellers in. Those guys are going to look to cover. The weak longs are going to look to get back involved. And guess what? The longs who held through that are saying, no, you're not going to get it that easily from me. You can come buy it this afternoon at 117 from me. That's why we see from failed moves often from fast moves. So it's all about the tightness of the stop. And I'd love to find as tight a stop as possible. And sometimes the stops are a little bit too tight. So I might end up actually staggering my stop, where I think, that's just a little bit too tight. I've got to give it a little bit more wiggle room than that 36 cents. So maybe I'll put half my stop here and half my stop there. And instead of doing 2,000 shares, I can do 1,500 shares.
Perfect. And what are kind of your routines for finding ideas and also overall general market analysis? You put out a great video every single weekend discussing that, but what do you kind of do every single day and every single weekend to prepare for the next week and find good ideas that match your trading style?
Yeah, my weekend process is watch list. I have these personal watch lists, and I have this master watch list, which right now has 1,000 stocks on it. I'm not interested in those 1,000 stocks, but I might look at it, somewhere, a screen that looks something like this. So let me go back and find that watch list. And I'll just go through alphabetically, and I simply do this. And I look at not just these 4 times. So the time frames that I have on my large screen, I have a weekly time frame, a daily, a 65-minute, a 30-minute, 15-minute, and a 5-minute time frame. And I'm looking at them all simultaneously. So I can see, where are we in relation to the COVID VWAP, last year's volume weighted average price, this year's. On the daily, I've got the 20-day and the 50-day moving average. I've got the 5-day moving average over here. And just looking through these and just going down and, coming up and creating little lists like this, putting little checks next to them, putting it onto my notebook that these become the trades. And when I go through all these stocks, it might sound tedious, but it's work that I enjoy. I can get through that list of 1,000 in 2.5 hours. Less if I'm really focused, but I have a problem with focus. So it's usually about 4 hours. anyways, what I see when I look at that and I get my list, I start to see, hey, well, look at that. And 3 weeks ago, I might have been looking at it going, there's another biotech stock. There's another biotech stock. Look at that. The banks look weak. Why is it? And I'm not going to trade all these names. It's never my intent. And that's not my universe of stocks I'm going to trade. Most of those stocks I will never, ever trade. But they give me an overall look at the market. So I'm listening to the market. There's nothing wrong with scans. Scans can be a great tool. But for me, my advantage is that I've been doing it long enough. I can get through this large universe of stocks. And at the end of it, I start to find takeaways. Mm-hmm. There's more stocks that are starting to, they're in that late stage 4, early stage 1. We're seeing these garbage names, starting to bounce, and people are getting excited about them. But there's still, where are we really in a stock like Roku? Are we in an uptrend here? Or Roblox, are we in an uptrend? Does this look like a stage 4 uptrend when you look at the weekly time frame? Or is it a stock that's in a downtrend that's most likely going to do something like this? And maybe it rallies, up to the 40-week moving average, but more likely to do this. And then in a 6-9 months, then it can sustain a larger advance. But for now, accept it for what it is. So it allows me to see what's working so I can anticipate what is most likely for the market, rather than going to the market and say, okay, here's my shopping list. I like stocks that pull back to a 20-day moving average on half the volume they traded of the prior 3 days. Nothing wrong with those. You can find some great names in those. I created a scanner once, but I shut the scanner down. I had a full, 3 time frame scanner. It's called the Alpha Scanner. And it was a great product. But I never used it so I couldn't, it failed as a business because I couldn't promote it because I wasn't using it. Because I could go in there and say, show me the stage 1 accumulation on a weekly time frame, stage 1, 1, 1, 2, and 1, 3, and 2, 1, and show me on a daily 1, 3, 2, 1. And then on a shorter term time frame, I could say, show me the stage 4, 3, 1, 1, 1, 2. So I've got these longer term bases that are just starting to break out, but they've pulled back on the short term time frame. And that's kind of what I'm doing in my mind when I go look at these, multiple time frames, is I'm saying, how do they all come together? This is still a broken piece of garbage, RCII. These are, it's going to take time for Redfin to heal on this weekly time frame.
Yeah, perfect. And I also wanted to hear a little bit more, if you could go into a little bit more detail about your position management once you actually already have, a position established. What do you do? When do you kind of take profits? I know you like to take it off in thirds. So when do you take those profits, as well as how do you manage your stop loss and move it up to the next relevant higher low?
Right. So again, with CELH, I can use this example. Buy it as it starts to show that strength. On day 1, if I have strong momentum, I use daily R2, which is the floor trader pivot. So here's what I keep it on 1 time frame here, and that's and I didn't get a chance. I didn't sell some in Amgen. I would have here at daily R2 on Friday. It didn't get there, but that's my first third off, and my first third off is to help me reduce my position size so I have less risk. It's not about making $1.40 on a $250 stock. It's about taking some of my risk off, paying for some of my risk, and putting myself in a position of strength as best I can from that real, the most uncertainty we have in a trade is when we first enter it, because we don't know what's going to happen. So if I can remove some of that uncertainty by taking a little bit of risk off, then that's what I want to do. Going back to CELH, what I then do is raise my stop underneath the most recent relevant higher lows. Mm-hmm. So in here, and these were actual levels, and it was under here that I had gotten stopped out of a third. So you can see where that was violated. At that point, I was stopped out for a gain of $8.10. So I took a third off first day at $69.10. Another gain here, and my final third we showed a low of 75 on Thursday and Friday. My stop is 4 pennies below that at $74.96. So what I'm trying to do, Richard, is to use the definition of trend. I had my stop under, on this day, I had my stop under here. As at the end of that day, I said, I'm going to raise it a little bit underneath this level. It held on Friday, so I'm keeping it there. And if I get stopped out, that's that. That's the definition of trend that I'm most interested in. So for now, on this 10-minute time frame, for instance, you could look at it and say, we have the potential that this high now has a lower high. And if this low is broken, well, then is my definition of trend still existing on my final third? No, it's not. So I want to step to the sidelines. And then again, if that were to happen, I'm not done with the stock, I hope. I hope it does this. And that 5-day moving average comes around like this again. And I'm buying here with a stop under there, third off. And then if it starts to do this, I'll raise it, at this point, I'll raise it under here. As it breaks a new high, I'll raise it under there. As it breaks here, and then I might get stopped out underneath that low right there. So it's definition of trend.
Perfect. And
long or short.
Yeah, that's perfect. And coming back to kind of your process finding ideas, are there any kind of mandatory criteria for you? Like, for instance, previously you said you never, fight the trend of the 5-day moving average. And I was also wondering if there's kind of any liquidity, average number of shares traded that you look for as well when you're looking for ideas.
Yeah, my personal is a 20-day average of at least 500,000 shares.
Mm-hmm.
A lot of places will use, I think the Market Smith, their average daily volume is 50 days. What I find on the 50-day one is, I'll find a lot of stocks that meet the 500,000 shares on a 20-day average, but they might have just started getting going recently. And we traded, 1 million shares, 1.8 million, and then 800, 700 as it pulls back. But because the denominator of 50 is so large, it's not responding and hasn't shown that it's 500,000 yet. It's still at 386,000. So I use a 20-day moving average, which I've just created on TC2000 here, and you can see I've got that up here on every one of my charts. Mm-hmm. So the 20-day average of CELH is 1.1. On SWR, it's 793,000. BAH 1.1. So that's my personal criteria.
Perfect. And there's a really good question from Simon that I'll bring up on the screen here. Have you shortened the swing time due to increased volatility? So do you adapt kind of your style and how long you hold stocks based on the volatility of the market?
Yeah, I mean, I'm much more, I'm less tolerant of wider stops. And I've been a lot quicker that if the stock doesn't make it all the way to daily R2, I might take some off that day because I don't want to hold the full position because we've got these headlines that, can gap the market each and every day. So I will reduce exposure at the end of the day for subjective reasons. If I feel I'm too heavy based on the market and, if we've rallied 3 days, it wouldn't surprise me to see a gap down type of thing. So I just always want to, I play a super strong defense. I'm extremely risk averse. That's counterintuitive to most people who hear what I do. When people say, oh, I'm a short-term trader. Wow, you must like risk. No, I can hate risk. I do everything I can in my power to control it. That's why I'm a swing trader. That's why I'm a short-term trader, because I can't withstand these 20, 40%, drawdowns. Like your Zoom you're telling me about that's down 80%. You're the risk taker, not me. I'm controlling risk. That's why I gravitate towards this time frame, because I'm risk averse.
Perfect. And there were a few questions earlier about where you place your anchored VWAPs. I know that's a subject you've talked about a lot, and you're writing a book, which I'm sure will be excellent on that subject, but maybe a quick review, that'd be awesome.
Sure. I mean, the basic things, you can see I've got a couple on here that if you look at the daily charts that I post on Twitter that I have, actually, it's this screen right here. So here's 3 different time frames, and this will just give you a little bit of an idea. So on the upper, I have a weekly chart of the SPY, then I have a monthly chart of the Q, and this is supposed to be IWM, and a monthly chart of the Russell 2000. Now, I have the weekly chart of the SPY because this is the longer term one that I'm interested in. And actually, I need to, for some reason, get deleted off. I'm supposed to have a green one right here from the 2018 low, because that's the next one of interest on the downside for me. So I'm aware again of where are we in the overall bigger picture. So on the weekly time frame, we're right at the volume weighted average price from COVID. That was prior support. Now it's battling it as potential resistance again. On the Qs, we're at the 2018 volume weighted average price and 2016 volume weighted average price from the Russell. So I'm aware of the big longer term levels. That blue line up there is the 2021 VWAP from the beginning of the year. That's been important, and still it's unusual to leave it on this long, this far into the year, but it still has been relevant. The pink one is the year-to-date volume weighted average price, and then you can, once you start looking at that data, you drop down to the daily time frame below it, and you can see here I have them labeled. So on the Qs, that pink one that's on the SPY, the Q, and the Russell, that's the year-to-date volume weighted average price. The blue one, that low in February was an important low. So, and it had been resistance in all of these markets. So I've kept that one on. The March 29th high has been important. And it's pretty interesting when you look at that March 29th volume weighted average price. I can show you a handful of stocks, including ARC, that are right at that right now. So important highs and lows. So the low from June right here, the June high VWAP, the most recent low, that's in orange. And then we go down to the shorter term time frame here. This blue is the week to date volume weighted average price, and the pink is from that prior low. So that kind of answers it. But the real answer is, from important swing highs and lows, from anything that changes perception. So I remember that this gap right here was the Federal Reserve. And you can see that when they made their comments, that had been important, and it was kind of a fulcrum point here for even this move higher. So I like to go back and look at different ones on different time frames. So I'm not, so here on this daily, there's that 2018 volume weighted average price on the Russell. There's the COVID volume weighted average price, and you can see how it had been support, then a battleground, and then resistance. Going to, again, like ARC, here's that volume weighted average price from the March 29th high. So, from key swing highs and swing lows, from gaps, from earnings reports. Some people will say, they do it from the biggest volume bar. And to me, unless there was a big movement on that bar, it's not really as relevant. I like to say from a certain move. So if I'm looking at ARC, I might look at a 65-minute time frame and say, what about from that gap right there? Well, that was pretty much close to that 29th VWAP as well. So from highs, lows, important swings, different inflection points, that sort of thing.
Perfect. And you've definitely touched on a few of these, but in terms of kind of what you see on Twitter and people who you teach, what are some common mistakes that you see many kind of beginning traders out there making, and what can they do to rectify those?
Number one, chasing stocks. It blows my mind how often people ask me about Roblox, on Friday. They weren't asking me about Roblox down in here. In here, I would have said, listen, it's neutral at best, is what I would have told you. And I'd say, hey, now we're getting a bounce in a downtrend. Be aware the volume weighted average price from January 1st has been sold several times. I wouldn't be surprised to see sellers there again. But again, where has it come from? When you look at Roblox, we had this rally from 24 to 44. It nearly doubled in an overall downtrend. It's time to take profits and move on. This stock, it would be highly unusual for it to continue to rally higher. What's more likely is maybe it traps some people up in there and then kind of does this and maybe makes a new low and then just kind of bleeds out and everyone stops talking about it again for a while, similar to Zoom, until some crazy lady comes in and says it's going 10 times higher. in the next 2 years, things like that. So it's, I think I lost my train of thought, but I think that answered the question as well.
Yeah, basically common mistakes that you see a lot of traders making. Yeah.
Again, so to answer those are, where has it come from? If it's been up a lot recently, and where does it have the potential to go? Where there might be resistance. In other words, where is there the potential for supply to be strong enough to become resistance? That's a level of interest. If you look at it and say, hey, it looks like clear sailing for a while, then maybe there's still an opportunity to get involved in that stock with a strong momentum. Maybe you can still buy Roblox if you buy it above this high right here with a stop under there. What's your time frame? We're thinking of, and here you can see it's pinching between the 1 and 2 day volume weighted average price. That wasn't a setup. I had no idea. But it found buyers. So maybe you were looking at this on Friday and said, hey, it's at the 2 day volume weighted average price. I'm going to buy as it breaks above here with an eye towards today's volume weighted average price as a day trade. Again, these times, it doesn't matter. This could be a chart with monthly candles, or in this case, it's 2-minute candles. It makes no difference. And that's something that people really need to understand and understand market structure. What is a bounce in a primary downtrend versus, what's a stock in an uptrend that can sustain an uptrend? When you look at a stock like ALKS, which I don't know what that was, look at the weekly chart. That is looking like it has the potential to sustain a move, maybe up to here, maybe up to these levels. Do you like cups and handles? As it's above all the key moving averages, it's above all the key volume weighted average price levels. Here's a stock where buyers are in control. Buy stocks in uptrends. That's smart points, though. Don't just chase them after they've made a move. Don't be the guy who buys, on, let's say it breaks out next Wednesday. Don't buy that breakout. That's just stupid. It came from 26.5 to 23. Let it break out, pull back, shake the uneducated people out, and then as it rallies back up, buy it right here with a stop under there. So where does it come from? Where does it have the potential to go? Don't chase. Understand market structure. Know your time frame. Tune out the noise. Once you're in a position and you're losing money and you start looking at headlines, you should hit the sell button instead of looking for headlines to justify your position. That's something, I've made every one of these mistakes myself. I didn't get here 30 years later by doing everything correct.
Perfect. And there was a question previously about, do you use mental stops and watch how the volume is when the stock's coming to the level where your stop is, or do you put in hard stops with your broker?
Only price paid. Volume's got nothing to do with it. I don't wait for volume. If you're waiting for volume, you're going to be reactive again. You want to be the first one there. When it hits that price, I've likened it to, the lifeboats on the Titanic. Women and children aside, me first, I'm jumping in. I wouldn't do this, by the way, but I'm just saying you have to be that mindset in the market. It's about me. I want to get out before this ship goes down. I want to be safe with a blanket on the sidelines going, wow, I'm glad I didn't wait for volume because only price pays. I don't care what the volume is. Volume follows the trend. Look at the volume on any stock. Volume expands in the direction of the trend and diminishes with the consolidations. That's just the way it always is. It doesn't matter. It's not so important for the markets. There's just always go up on lighter volume. That's just the way it is. The volume diminishes, but on the heavier volume does occur on these downtrends. But all the rallies in the markets over the years, the volume generally looks like this: diminishing volume with a few spikes here and there. It's more important on individual stocks. Buying PRVA, where as it breaks to a stage 2 uptrend after it got above the volume weighted average price from the IPO. This is when I bought on Tuesday and put it on Twitter right here. And that was, a perfect one right there. And I sold something of this. I didn't even look I know there must have been news. I didn't look to see what the news was, but who cares what the news is? I'm not in it to read news. I'm here to make money.
Right. And I figured you'd be an excellent person to ask this question. What is your favorite trading quote and why?
Oh, you guys know me. I've got a million of them. I'll put that little sheet together. I'll tweet that out after.
Yeah, perfect.
I guess only price pays, because one, I think I invented it, and even if I didn't, it doesn't matter. But it really just kind of ties together everything that, forget about what the Federal Reserve says. Forget about these takeovers, in Twitter, in Robinhood, and forget about what the CEO of DKNG says, that, oh, you're going to regret this if you're shorting your stock. I'm going to make your life miserable. Okay, cool. And whenever the CEO starts defending his company against shorts, it's time to short that company, is the way it's always been. But tune out the noise as much as you can, which, volume is noise to a degree. Don't wait for the volume. Base your price action. You're in this for price. If the price hits your level, take action. If it's a good plan and others see what you're seeing, congratulate yourself and say, hey, look, I'm a visionary. I'm here before everyone else. This feels good. Now watch them all come. And when it breaks out, I'm going to feed to them. When it breaks out on heavy volume, after it's rallied 8% in the last 3 days, when I bought it, as it broke above that low consolidation in the shorter term time frame. So only price pays encompasses really just tune out the noise, tune out the analysts, the CNBC, and a lot of Twitter, and myself included. I mean, if my time frame is different than yours, don't argue with me. Just move on. It's not for you. I'm going to block you if you argue anyway. But it's just, stay focused on what you do. And if you don't know, this is why you're here today. Find stuff from this seminar that I'm doing, from what Patrick did, what Denise is going to say next. She's awesome about market psychology, and all the other great speakers lined up. Take little pieces out of there and create your own method of dealing in the market. My style is unique to me, but it's also pieces of what I learned from Stan Weinstein, what I learned from Bill O'Neill, and what I learned from hundreds of people on Twitter and the different books that I've read over the years. Be your own person in the market, but have it emphasized in good trading concepts, understanding of what the market is.
Perfect, Brian. I think that's a great place to leave it there.
Okay.
Thanks so much for your time, and for everybody watching, thanks so much for your excellent questions. And it's now time for lunch, so we'll be back, I believe, at about 1 o'clock for Denise Shull. So make sure you guys tune in for that, and so we'll see you guys there. Take care. All right, welcome back, everybody. It's my pleasure to introduce our next speaker, Denise Shull, who is the founder and CEO of the Rethink Group. She's also a performance strategy and decision advisor, as well as being the author of Market Mind Games. Denise, thank you so much for being here. I'm really looking forward to this, and welcome.
Thank you so much for having me.
Of course. And to kick things off, I'd love to hear a little bit more about your background and, your vast career up to this point, because it's definitely an interesting path. So I'd love to hear you talk about that a little bit.
How did this happen? How did I get here? So I started out selling computers for IBM and thinking I was going to like climb the corporate ladder, and I was slated to go for a leave of absence and go to Stanford Business School. I thought to myself, if I wake up when I'm 40 and like my objective in life is to sell mainframe computers, I'll have to slit my wrist. So like we need plan B. So I actually went to Aspen, Colorado, skiing for the winter, and like figured out how I could get into graduate school in psychology, which ended up being this program. University of Chicago has this master's degree that you can kind of like design your own gig. So I did that and did what's now called neuropsychoanalysis, which is basically how does the human brain have an unconscious, right? And how do we have like unconscious motivations that cause us to behave in some patterned way? Well, so then I was trying to figure out whether I wanted to get my PhD or not. And I was dating somebody who was a floor trader at the SIBO. And we were literally walking down the South Street, turned left on Jackson, and he ran into a guy who said, "We're starting an upstairs trading firm and you should come." And somehow I got swept up in that, and ditched the PhD. And then I traded there. I traded at Schoenfeld. I was invited to New York to run a trading desk for a place called Sharp Capital, which is, if anyone was around New York in the late 90s, they know Sharp Capital's got a story. And then a small academic institution in modern psychoanalysis wanted to publish my master's thesis. And I said, it's got to be updated. And when I updated it, Antonio Damasio, and this is central to my presentation, was showing that we cannot make decisions without emotion. And I was like, well, darn, that changes like everything I've ever read about trading psychology. And then I was telling someone about it and they asked me to write an article, which shocked me. And then it just took on a life of its own. And this was 2003-04. And I think it did because people relate to what I've learned about decision making. And so that's led to, some insane things of being able to coach, hedge fund managers with billions of dollars and Olympic athletes, and building a team of previous coaching clients and portfolio managers who now coach for me. And just being able to try to teach people what the science says about a market decision, which is what I hope to, give you the Cliff Notes version of today.
Fantastic. Really looking forward to it. Yeah, let's get into it.
Let's see. Where are we on the share my screen piece? Give me a second, like the Zoom.
Yeah, so
you can see like the slides, right? They're just not in slideshow mode.
Exactly.
Okay, let me put it in slideshow mode. And
there we go.
Go. Yeah, let me get you guys over in the corner so somehow. All right, everybody, thanks for being here. This is really metacognition, which is like thinking about how we think. I am a person who is driven by why. Like, if I understand why, I feel like I can figure anything out, right? If I understand how something works, I can work with it. So at the end, we're going to talk about actual tactics. But I'm going to start out giving you the big picture, like the principles, so that hopefully, you can start to integrate this for yourselves. So the secret to a better mental game is noticing. And this is a quote from Daniel Goleman, who wrote Emotional Intelligence. The range of what we think and do is limited by what we fail to notice. And I'm just going to say, I think there was a lot of failing to notice. I still think there's a lot of failing to notice what happens as we make a trading decision. Like we've been suppressing it or denying it or shoving it aside, like instead of admitting like what it really is. And because we fail to notice that, we fail to notice, which is, I think, the case in a lot of trading psychology and trading, mental game advice. There's little we can do. So we're sort of stuck with doing the same thing over and over again and being frustrated and like saying, plan the trade the plan, and then wondering why we can't trade the plan, and then beating ourselves up and then losing confidence. How failing to notice shapes our thoughts and deeds. So this is about helping everyone to notice. So I'm going to give you a bunch of science quotes. I will tell you right now, it's meant to basically convince you that you make all decisions based on the expectation of a future feeling. And if you take nothing else away from this, take that. What future feeling do I think I'm going to get? So like you're looking at a trade, you think it's a good trade. Like you think that you're going to take the trade based on the fact that you think it's a good trade. No, you're going to take the trade based on the fact that what happens to you if it turns out to be a good trade. You feel happy, you feel good, because you made money, because you got it right. Like, and understanding that nuance opens up like a whole world of how you deal with yourself and your interaction with the markets, which, oh, by the way, are a game unlike any other game on the planet. So, entirely new set of constructs. This is long, but it basically is like, forget the whole control your emotions thing. First of all, an emotion never lost a dime. What you have to control is your actions. How you control your actions is, if you read this quote, through understanding your actually more intense feelings and analyzing them. Basically, the people who were able to distinguish among their current feelings achieved higher decision-making performance. And oh, by the way, these people were investors. They weren't traders, but they were making market decisions. And a market decision, by the way, whether it's an investment decision or a trading decision, from a brain point of view, it's the same thing. Like the factors are the same. Obviously time frames, they change your analytical factors, but the process that your brain goes through to assess like uncertainty and what's going to happen to you is the same, whether you do it 100 times a day or 3 times a year. So these are all the things that people, well, not all, but these are some of the things that people use for emotion. And it's just some of the science that shows they don't work. Suppression is the big one, like just sort of pretend you don't have it, shove it down. Like, well, Jennifer Lerner of Harvard shows the problem with suppression is it actually makes the emotion more intense, like the exact opposite of what you want. Saturating the decision maker with facts, like it doesn't work. We all know, like in our personal lives, like, you have some disagreement with someone and, you can give them 1,000 facts, it doesn't change their mind, right? Because you're not dealing with how they feel. Using reappraisal, meaning like, that's a little bit like positive thinking, but, taking some situation and using your cognition to change your perspective on it. What she means by bottoms up is like, if the thing is important to you, like a trade's always important to you, like people do get to the point where they have confidence in themselves and confidence in themselves overall, that any one trade is less important. And that's where we all want to get. But that's a long road. It's a tick by tick assault on our ego, unless we either show up with an emotional makeup that prevents that, or we do the work to create the emotional makeup that prevents that. So in any event, so just to give you all some background to, for credibility. And so in the year 2000, there were 50 academic papers written on emotion. In the year 2005, there were 500. In the year 2010, there were 5,000. So the problem is most of the advice about trading decisions, or frankly, any kind of decisions, human performance, psychology in general, was created before 2010, before there was this much research around what emotion is, how it really works. Just to give you a graphic, here's some funding, graphs of how it's changed. Emotion content in memory, in perception. And if you look down here in perception, and this is the year 2000, and this is the year 2016. So like trading is a perception thing, right? Like, how do you perceive what's going on? Over here in decision making, like since the year 2000. So basically, most people don't know that the research has changed. And I think of it as like it's a flat earth, round earth thing. When everyone in the world thought the world was flat, it was really hard for people to realize, no, it's not. But for the people who realized the world was round, it like started to open up a whole new world, right? Well, that's the same about emotion and decision making. Like, if you can accept this, and I know some number of you listening are like, she must be, because like you're defended. You've been taught to be defended, and you're basically afraid of your emotions. It's understandable, but I'm telling you, if you can get a little less afraid and work with them in an organized way, you literally will make more money, and your life will be better too, by the way. Just throw that in. Research has demonstrated the explanatory power of emotions and feelings. Emotions shape decision, being the content and depth of thought. By the way, like, this is the problem, just to make it clear, like, this is the problem with our tribalism, with our extreme politics, like with confirmation bias, with we see what we want to see, we hear what we want to see. It's because we have a feeling about the issue. And then we only see the data that agrees with our feeling. And if we see data that doesn't agree with our feeling, it's threatening, so we can't deal with it. So if everyone were to realize that their feelings are really shaping their thought, like, everyone actually would be better off. But forgive me for digressing. Cognitive control, which is the thing that we always say, plan the trade, trade the plan. Well, what is it? That's cognitive control, right? That's using your intellect, your thinking, to control your behavior. It's dependent on emotion. Emotions are responsible for guiding and controlling our behavior. I mean, this is like, every slide I'm giving you is a different scientist. It's a different study. This one always gets me. Emotion determines how we perceive our world, organize our memory, and make important decisions. And again, given the way the psyche works, which its fundamental job is to keep us safe, basically every trading decision is an important decision. Unless we have become a good enough trader that we don't mind, literally don't mind, like, it doesn't bother us to have a bad trader lose money, or to be wrong, really to be wrong. So, you hear this thing about intuition being like intuition, like intuition gets a bad name. So what I want to point out is that, like, intuition is what? It's a sense of your body. It's a sense of, you just get a sense of something, right? Well, feelings and emotions exist on a spectrum. So there's like the mild, calm sense of something, which is physical. That's intuition. Then there's like a feeling that's a little bit more intense. Like, a feeling will grab your attention. I feel worried. I feel concerned. I feel annoyed. Like, and then there's an emotion, which is a greater degree of intensity. So in that spectrum of intensity, what it means is each greater level has more information in it. And the trick is to find the information and sort it out from the impulse. And we'll talk about this more later, but it seems germane right at the moment. So that you can figure out which feelings are about the market, your intuitive feelings about the market, which, by the way, are a result of your education and experience. Like, in academia, it's called visceral or felt intelligence. It's a real thing. You develop it as you educate yourself and as you gain experience. And if you think about it, anything that you know how to do, anything that you have some expertise in, it started out as like this cognitive, intellectual, in your head, step-by-step thing. I don't care. Swing a golf club, ride a bicycle, ski, do math, trade. It starts out as do this, do this, do. And as you gain experience, it goes from your head, it goes into your body. And you can do it faster, and you can recognize what to do in a situation. Like, you just immediately know. I mean, all the things all of us adults know versus our kids know. Why? Like, all this, we have, reams and reams and reams of knowledge in our body, so that we get a sense, like, we look at something, we go, we know what to do, in a way a child doesn't, because they haven't developed this visceral intelligence, which is intuition. And there's something called interoception. Interoception means you perceive your internals. So it means like you can, feel your stomach growling. Ideally, you can feel your heartbeat. I'll tell you. So there's a study with 18 traders in London. Those who were better able to feel their heart rate just sitting, like if we were doing a workshop, we'd sit for 5 minutes and see how we could do this. Got out of losers earlier, but could immediately take another trade. Like they weren't, so agitated by that. They also didn't just hold on to things because they'd been in it. And literally, this was just feeling what's going on inside their body. Now, the connection is the better you are at feeling what's going on inside your body, the more likely you're going to be able to understand your feelings and emotions, the more intense states as information, the more you're going to be able to sort through the physical subjective experience and find the information about the market and separate it from the information about your own ego needs. Interoceptive trip over your tongue there, Denise. The interoceptive ability of traders predicted their relative profitability and how long they survived in markets. So, by the way, what this means, everybody, is spend time seeing if you can feel your heartbeat. Spend time, just sit in a chair and try to feel your feet on the floor. Is your neck stiff? Just as many basic physical sensations as you can. It's like the baseline practice to ultimately knowing what you're feeling, why you're feeling it, and the feeling you're predicting, which is the message I want to leave with you all today. System 1 is not a correct explanation of expert intuition. Yeah, there's a very famous person who's won a Nobel Prize in behavioral finance and talks about System 1 and System 2, and basically, he may not be completely correct. Let me just put it that way. Intuition is not some sort of mystical chemical reaction, but a neurologically based behavior that evolved to ensure we can respond quickly. Here's the killer one for traders. Intuitive reasoning contributes to performance in hard, fast-paced probability tasks. How many people say no? That's not true. And I can tell you, by the way, most of my personal clients are hedge fund managers. I don't coach the big famous names that but I coach the people who work for them. And one example, a guy that came into managing a new fund within a big established fund, global macro, but he's very quant. His master's degree is in theoretical math or something. He spent months and months with his plan and his strategy. But we were working together at that time, and then he started actually managing money. I mean, he traded for some famous people that you all know right before he got this job. He's down in 9 months of working with me. His quant stuff is all context, and then I help him figure out what he's really feeling, what his real intuition is, and then he uses me to test. He will tell me a thesis about a market and trade. He trades pretty short. He does a lot of tactical trading, as he calls it. He'll be yesterday he was giving me this story about Russia and Ukraine and Europe, and he's like, am I do I really mean this, or am I trying to look smart? He looks to me to help him sort through which feelings are about the market and which feelings are about himself. So this was a crazy study done at Stanford where they took all the brain scans related to risk decisions and probability. And they showed, and this is the most important point of this presentation, that the very first thing that happened when you looked at a probability distribution is you were predicting whether you would feel safe or not. You were predicting whether you would be anxious or not. So if you looked at a normal distribution, they could see the brain working in the areas of the brain that had to do with feelings about safety. And that's a little bit too generic, but that's basically the point. And then they showed a skewed distribution, and the areas of the brain, like the blood flow, would be more in the areas associated with anxiety. Now, this is a decade ago. This was before it was a given that we're predicting future emotion. Most of the psychologists don't know this yet, most even of the neuroscientists don't know this yet, but this was like groundbreaking work at Stanford that's been capitalized on there and a little bit on the East Coast. But I can also tell you, every time I help a client understand the emotion they're predicting, they make a better decision. Because what's happening is you're getting conscious of the thing that's actually driving you. What most people are trying to do, because they've been taught to do, is override that feeling, like with whatever their cognitive, analytical process is. And they try to shove the feeling aside and like focus on the process. But like the feeling is that the feeling that drops out of the process is the thing that matters. So if you deal with the feeling that drops out of the process, you have more ability to, get in the trade earlier, if that's the right thing, whatever your thing is, stay in it longer, get bigger, get out of it earlier. Like the information, the intuition is in that feeling. The expertise is in that feeling. And so, but everybody's been taught to like try to override it with their thinking. And then the other thing that happens, it drives me insane. And in a certain sort of way, the reason I do what I do is for this. I can't stand that people suffer so much, particularly in trading, from being given the wrong advice. Because what happens is then everybody beats themselves up. Oh, something wrong with me. I can't trade my plan. Oh, I did that thing again. Like, and they feel guilty and feel bad about themselves, and they don't really talk about it because it's embarrassing, right? And so there's like all this ridiculous suffering because just basically people have been told the earth is flat. Sorry, I get a little bit animated. So I've said this before, but this is the thing. Every decision in life, but we're talking about trading today. Every trading decision is based on the expectation of a future emotion. Primarily, like at its very bottom line, am I going to feel good or bad? Meaning, am I going to be safe or not? Is it going to be okay or not? Now, that gets nuanced, and there's personality and personal history factors, which we'll touch on a little bit. But the skill everyone should say they want to have is the ability to sort out their predictions about future emotions. Now, it's a skill. And people have different levels of consciousness, subconscious or unconscious, and different levels, frankly, of defense mechanisms, like how much they use their intellect to not know how they feel, for example. So it's a different process, but the goal is the same for everyone. You guys are over this. I guess it doesn't really matter. This is also a book everyone should read, and this is not my book, and I can't move you. So 7.5 Lessons About the Brain, Lisa Feldman Barrett. What that is saying is the very latest edge of neuroscience says you're predicting the words that are going to come out of my mouth before I even say them. That you're predicting what's going to happen with light and smell and sense and touch. And I will tell you, if you don't believe this and you want to test it, have, a good friend, a spouse, whatever, hand you a cup of either really hot water or really cold water in some sort of cup or glass that you can't distinguish should it be hot or cold. And see how long it takes you to know if it's hot or cold. It's not instantaneous. Because you don't, you're being given a cup of water and you don't know what temperature it is, it takes you an extra second or two to realize what temperature it is. If it's a stimulus response system, which is what we have all been taught in Psych 101, it wouldn't take so long to know whether it's hot or cold. But when you pour your coffee and you pick up the cup, it's going to be hot, right? You pour yourself a cup of ice water, it's going to be cold. What's going to happen to your fingers. This is true for everything. The brain is continually projecting itself forward in time. These prediction signals are assembled from past experience that are similar to present conditions. Now, in trading, we might sometimes talk about deliberate practice, right? Like spending a period of time. I will give an exercise to independent traders that says, watch the screen, walk away from it, and see if in 5 minutes, what's your prediction of where the S&Ps are. Come back and see if you're right. like to help people realize that actually they do have this unconscious pattern recognition and they have a sense of it, even if they haven't seen it in the last 5 minutes. I did get that exercise from Hubert Centers, by the way, since yesterday I was complaining about people copying me. But it's true. Like, I can figure where I was going, like why I said that. Give me a second here. Well, the bottom line is, deliberate practice, that was it. Like the point of deliberate practice, we think it's to have intellectual experience with something. And it is like to learn to feel our way through. But the point is that what drops out of that is a belief and a feeling that you can do something. And it's that belief and feeling that you can derive from deliberate practice. And this is what athletes are doing all the time, right? Yes, they're moving their body in the ways they need to, so that their body's used to doing that and trained for doing that. Like that's like analogous to our analytical process, like however we're analyzing the market. But the real value of it is then when they have to do it, they feel like they can do it. They believe in themselves. So if you don't, your past experiences, like your prediction from past experiences, you're going to say, I don't know how to do this. It's too much. And so you do this deliberate practice to ameliorate that, basically. Okay, so predictions stem from a context of beliefs, which, if you think about it, if you believe something, you have a feeling about it. It's right or wrong, right? Which come from education experience and the resulting subconscious expectation of future feelings. And this is where I'm again pointing out, people have different access, like, to these expectations of future feelings. But just because you can't access it doesn't mean it's not there. Like, basically, I don't have this slide, but Brian Newton of Stanford, who was president of the Society for Neuroeconomics, who's an incredibly well-respected scientist, says, if you're not predicting a future feeling, you're dead. So that's pretty definitive. How are we doing on time? Oh, we're good. So I want to switch gears here a little bit. That's what your brain's doing. Let's talk about the market. It is a mental problem unlike any other problem. And people don't appreciate this as much as they should. There is just nothing like it. For one, it seems like sports. People will use sports analogies. They will use mental toughness, etc. For those of you who don't know, this is both our client and our coach, Lindsay Jacobellis, who won 2 gold medals this year. This is her winning a gold medal after 16 years and 5 Olympics. But like, you can't make anything happen in markets. In sports, like, Lindsay's job was to make it happen. Lindsay's job was to come over that finish line first, and she did. And that's true with any sport. You can't do that. But people forget that. It sort of feels like you can, right? You can make your entry and exit happen, but you can't. At best, it's sailing or surfing where you're reacting to the environment. But from a brain point of view, like, your brain's dealing with the problem of a trade different than Lindsay's brain is dealing with the problem of get down first, because she's got absolute factors driven by physics. And we have, anybody can fat finger sell like 1 million S&Ps in the next second, right? Like, it's not all going to suddenly start raining on the course after, there's not something that's going to happen. And your brain knows it. Even if you intellectually rationalized, your brain detects the level of uncertainty that it's dealing with on a subconscious way. There was a study, I think it was also done, when it was done at Stanford. Well, actually, it was Stanford and Duke. And they showed that when your brain detects the uncertainty, any kind of uncertainty, but particularly market uncertainty, its inclination is to try to keep you safe by doing something to make it certain. This is why you don't follow your trading plan, by the way, because your brain wants you to be able to predict future safety. And a thing that's necessary for future safety is certainty, not uncertainty, right? Like, you need to know, your brain's going to think you're safer if you know what's coming at you. When you make a decision, it momentarily makes it certain. So your brain is compelled to keep you safe. It does that through trying to create certainty. And while you're sitting there unable to make a decision or waiting for the market to do whatever, you're having all these predictions about your future safety. But if you decide, if you now get out of the trade early or get into the trade early, for a second, that agitation about am I safe or not goes away. And that literally is the fundamental mental problem of markets, because there is no precise meaning. I mean, Lindsay knows, you know, if she starts to tip her board too far, she's going down, she's not safe. Maybe not what she wants, but it's clear. And the game never ends. I mean, you know, if you're a professional athlete or any kind of athlete, you know, it ends, you can regroup, you can start over, you can make a new plan, like never ends, never ends. I mean, you know, my professional hedge fund clients get a bit of a reprieve from, you know, December 31st to January 3rd or whatever, but most of them carry positions, so they don't even really get like, okay, you know, it's a different problem for the brain. Nighty and uncertainty, for those of you who don't know, this is the University of Chicago thing. But Frank Knight identified this. There's like risk, which is like dice or chess. And there's uncertainty, which is like markets. Like there's no dice or chess. There's no absolute meaning. Even poker. I mean, poker's the closest thing from a mental point of view, since you win by like predicting what other people are going to do, which is, by the way, exactly what you're doing in the markets. But there's still an absolute meaning to the cards. Like, there's not really an absolute meaning to any price, right? Like, it's all contextually driven. Like, what is, I think I have this on a later slide, but what does S&P 4000 mean now? Okay, now it means, maybe we are going to rally from here. 3 months ago, it meant, you know, we're selling off. Like, any price only means anything in context, which, by the way, is another sort of principle for people to remember. Like, I'm predicting a future feeling and nothing has any absolute meaning. Like, what's it meaning in contextually? This is basically what I was just saying. It's relentlessly ambiguous. So what literally happens is we create what are actually subjective probabilities. We take what we learn about how the market works and what tools we've learned to analyze price action. And we create what we believe is a probability, but it's based on a lens. So my lens is going to be different than yours, Richard. It's going to be different than like my most fundamental hedge fund manager. They're not absolute probabilities. They are probabilities we believe. They're not irrelevant. But it's good to understand, in contrast to a lot of trading education, where you get the feeling that there's kind of an algebra problem embedded in there, and there is some actual answer. Now, notice I said you get the feeling. Everyone knows it's not an algebra problem. There is no, 2x equals y or whatever, but minor algebra problem. But you feel like there should be. You feel like you're looking for this, like, you're not. And your job is to learn a lens to view the game of markets, the price action through, that you believe, that makes sense to you, and then stick with it. So I'm going to go back to the beginning of my trading career. The office I was first in, electronic trading group, just had a mishmash of former floor traders. Some, like, there was a stat arb trader, there was a scalper, there was a momentum guy, there was a guy who traded utilities only, 10,000 up on either side, and just waited for days for orders to get hit. None of that made sense to me, because I started watching the prices, and I would notice, like, all the drug stocks would move together, or all the banks would move together, and sometimes they would move a lot. Like, one of the times they first moved a lot was I'd been watching them for like a year, and then it was September of whatever year that was, 94, 95, must have been 95. And all of a sudden, all the chip stocks started like trading up, and I'd never seen anything like that. So I shorted Micron. Like, from 65 to 95. And the owner of the firm called me up and said, "You have the most guts I've ever seen." And I'm like, yeah, guts or stupidity. I did actually ultimately make money on that trade. But my point is, I couldn't figure out what the lens was, because I had all these different people around me. And then I finally got some sense of, like, I think what I like and what makes sense to me is momentum. And so I went to Schoenfeld, that was trading intraday momentum. Now, my point here is, everyone has some method of analyzing price action. Out of that, they don't, well, maybe you know it or not, but you have some subjective probability, your belief about what the probabilities are. That exists as a feeling. And you get better, not by changing. Like what happens is you get nervous about it or think it's not the right way. And so you react to the nervousness by changing your system, by trying to go learn some other thing or add some other indicator. That's not the answer. Like the answer is to deal with the feelings of anxiety around the fact that you're not safe in whatever system you have. Okay, so here's your cheat sheet. You all exist in this, I call it a matrix. So you have like your expertise, whatever your system is, that drops out for you some level of confidence or conviction. If you're a hedge fund person, it's conviction. If you're a trader, it's confidence, generally speaking. When I work with my clients, we fill in these dashes so that they have a spectrum of confidence or conviction. You know, 7 might be panic, or 7 might be overconfident, and 1 might be panic. And then underneath it are things like fear of missing out and fear of future regret and your personal feelings. So think of yourselves like embedded into this chart and learn to ask yourself, what do I expect to feel? As a regular matter, of course. You're about to make a trade, what do you expect to feel? You're sitting to wait for the trade, what do you expect to feel? Now, you're going to get a bunch of feelings and you're not going to know what to do with them. It's a process of learning how to sort through those. So you can ask yourself, what do I really think? Emphasis on I and really. Because what you're trying to do here is like, forget what everybody else says. Forget even for the moment, when you ask yourself this question, you can sort of forget about the uncertainty. Like you're just trying to get to your intuition. What is your unconscious pattern recognition, which is the sum total of your education experience? What's it telling you? That's what you're trying to get to. And then you're saying, okay, how much do I believe that thing I think? What am I feeling? Y's in red, because ultimately the Y is the path to averting whatever that pattern is that everyone has. Their sort of, foibles, if you will, of market behavior, that thing they do, get in too early, out too early, get too big, get just, not get big enough, etc. Now, ultimately answering what am I feeling and why accurately is hard, but it can be done. And it's like anything, you make big leaps at the beginning just by intending to do it and trying to do it, from trying to not have the feelings. So there is in that triangle or pyramid supporting your level of confidence, like a personal, repetitive, fractal thing. The psychoanalysts have known that, we learn things about ourselves growing up, and then we expect to get what we got. And that influences how we interact with people, how we, pick spouses, and how we interact with spouses, and how we interact with authority. What I figured out, not intending to figure it out, but way back in 2004 or 5, is that the market acts as an authority figure, and we react to it in like whatever our personality-driven way is. So this is beyond the scope of today, but I do talk about it and send you through exercises in my book, Market Mind Games. But that triangle starts with like fear of missing out, future regret, need to be right. And when you get to kind of a need to be right stage, then your own personal stuff is kind of merging into the market decision. So you can ask yourself, like, is the feeling I have, is it about the issue, the market, which Jennifer Lerner of Harvard calls that integral feelings. I call them informational. Generally, they end up as intuition. Or is it about something else? Like I want to make $500 today. I want to make $15,000 this month is not about the market, by the way. I want to break even, whatever. I said to say, what feeling am I predicting? So here I'm saying, ask yourself what you want is like the next level. Use awareness of your desires to help you. Because if you know what you want and you're honest with yourself, your chances of picking the action that gets you more of what you want go up. But there's all kinds of information out there, don't have any desire, like, just be neutral. It can't be done. So like, it's a waste of time. Same thing I just showed you. Basically, I wanted to reiterate that, to find yourself in here. So let's just talk a little bit about key feelings, and then we can do questions. So there's like insane power of understanding anticipated regret. And if you choose to like take me on and try to be asking yourself, what feeling am I expecting to get? Start with anticipated regret. What you're going to find is it's everywhere. Like, well, if I don't get in now, I'm going to miss the trade. If I don't get out now, I'm going to give money back. Like, and I miss the trade. Okay, I'll feel bad. I'll feel stupid. I give money back. I'll be mad at myself. Like, if I get bigger, I'm going to risk too much, and then it's going to be scary. Like, anticipated regret. I said on Squawk Box in 2012, which led to the whole Billions debacle, by the way, that I said this: fear of future regret is the thing. Like, there's lots of nuances, but if you do nothing else, what feeling am I supposed to get? What am I predicting I'm going to have? And then be looking for variations of future regret. Embarrassed, mad at myself, like all the things. Because it's that feeling that causes you to do the things in your trading you don't want, that caused you to smack yourself and why did I do that again? It was driven by that unconscious expectation. So the reach of but I knew better. So if you do something that you're then mad at yourself for, the typical way to handle that is like, say, okay, put it behind me, there's another trade, like it's another day. But you're mad at yourself. And mad at yourself makes you scared. Like, can you trust yourself? And, can you trust yourself makes you hesitant because you think something bad's going to happen and there's going to be future regret. So if you are in a slump now, or when you do get in some sort of slump, go back to the beginning of that slump period and find the emotions. At their core, if we make a mistake, the emotions of like regret and mad at ourselves, disappointed, etc., are meant to turn our attention to what do we need to do to avoid this in the future. But there's so much information that says, oh, don't have any or negative feelings, and negative feelings are bad, and suppress them. So then go back to Jennifer Lerner, and they're just going to get worse. And then eventually you're going to act them out, and then like you're going to have meltdown day. Negative feelings, and I think I might have this slide. Do I? No. Negative feelings in their pure form are really meant to help us. They're meant to keep us safe and give us information about what we need to do differently the next time. So this is a quote from a paper I read when I very first started talking about this. This paper was in the Journal of Economic Literature that I come to find out back then is like the preeminent journal in economics, because my husband was a former Federal Reserve economist. He's like, JEL. Anyway, this was a summary paper on all the neuroscience on risk decision making. And this was, as you can see, printed in 2005. Anyone who's been around me or heard me talking for a long time has heard this quote 1,000 times. It's not enough to know what should be done. One must also feel it. So if you're not doing as much of what you know you should be doing, the answer is in dealing with your feelings in a different way, so that you can create the feelings you need to get into the trade at the right time, to get bigger at the right time, to take the loss like before it gets too big. Here's me. That's our website. And oh, by the way, we did actually, I forgot all about this. We are announcing a new e-training course, so you can look for that on our website. And with that, let's do some questions.
Fantastic, Denise. And I think I'm going to have to watch that back a few times to really, wrap my head around everything. And I'm seeing a bunch of similar messages in the chat. So thank you so much for that. I want to first ask you about the most important skill that you think traders need to make, the predictions of future emotions. what can traders do to work on that skill and build it up and improve in that regard?
That's a perfect question. So the first is start with that interoception. Can you identify like what's going on just in your body? Then can you identify like a basic feeling? Does this feel good or bad? Then as it feels good or bad, does it feel what is good? Like you're happy, you're pleased. Like try to get more granular. There's actually two things called emotion differentiation and emotion granularity. So differentiation is knowing the difference between like fear, frustration, disappointment, happiness, excitement. Like you can tell those differences. But then granularity is knowing degrees of fear, degrees of frustration, degrees of disappointment, degrees of happy.
Mm-hmm.
So like literally try to find them. Try to find them, when you're going to Home Depot, like outside of exceptionally stressful. Going to Home Depot and a lot of traffic is really annoying. But like try to find them in just life circumstances. You want to get better at what am I feeling and why. And then as you start to gain skill, use a thesaurus. In the 2018 Olympics, when Lindsay went, and I spent a week with her before she went, and she came that close to winning, literally 0.45 seconds from gold and 0.06 from bronze. But in any event, we did this thesaurus. Like now, she had this crazy story. For those of you who don't know, in 2006, she was about to win the gold medal. She flipped her board up, did a method grab, she fell, and the Swiss or German girl passed her, and that created a mental block. And never mind, like sponsors threatening her and whatnot. So every time the Olympics came, she would win all these medals, World Cup and all this stuff, but she couldn't deal with the Olympics. And so when I was hired to help her in 16, it was to get her ready for the 18 Olympics. So as she was about to go, we used a thesaurus. Now, she's a high school graduate. I don't mean it, she's very smart, but she's a high school graduate who's a snowboarder. She used a thesaurus and she came up with the word trepidation. What the research shows is if you get the word for the feeling right, the feeling loses a lot of its power. That is learning to be emotionally granular. Being able to say, you know what? I'm worried that this trade is going to turn bad. And if it turns bad, I'm going to be mad at myself. And whatever else regrets. Like, there's an assumption that if you acknowledge those feelings, actually feel them, the chances that you act them out go up. That's the assumption. That's what basically everybody thinks. I have to avoid that feeling because if I don't avoid it, I'll act it out. That is 180 degrees incorrect. The avoiding it raises the chances you act it out. Maybe not immediately, but sooner or later. Or you transfer it into another realm and eat too much, drink too much, kick your dog, fight with your spouse, whatever. The feeling will win.
Mm-hmm.
If you do the exact opposite, practice knowing what you're feeling. You don't have to, at this level, you asked me what to do, you don't have to necessarily why. It's just being able to differentiate. Like, is it I'm afraid of my spouse being mad at me because I didn't make money this week? And then, by the way, you can do the next level, like, well, why was it matter if your spouse is mad at you? Well, that's like an unpleasant situation to be in. Well, maybe they'll divorce me. Like, what'll happen is you go down the road. Humans catastrophize, by the way. And when you do the why side of it, you'll find that you catastrophize because basically everybody does. So it's practice. It's basically practice knowing what you're feeling at levels, like physical, good, bad, more nuance and good, bad, and then really more nuance, like trepidation versus fear.
Perfect. And basically to kind of, to get that level of granularity, would you recommend traders like take a whole bunch of notes during the trading day about how they're feeling, when they're making a trade and all that? What would you recommend for capturing that data?
What I've always done, what I've always recommended, and I used to do, by the way, is I kept OneNote open, which I loved because you can tag and you can create custom tags. And I just random thoughts, which, by the way, typing your feelings out, also just as you're doing it, it reduces you from acting them out, right? You're sending that energy of the feeling onto the paper. And you're articulating. Like, probably everybody has had an experience somewhere, somehow in their life, where if they just said how they feel about something, they felt better. Like nothing had to change, or some circumstance in any realm of life, where if you just go, you know what, I really feel this way. Nothing's changed in the circumstance, but you feel better because you said it. Now, there isn't any real science yet about why this works. Lisa Feldman Barrett is starting to show that like neurons are maybe really infused through all of our organs, and that's somehow the path that, but like no one really knows why putting your feelings into words works.
Very interesting.
So put them into words in a journal. And it really does. You know, you're like really frustrated. You just lost money. You know, you just did something stupid. It wrecked your day or your week or your month or whatever. Like, right, type. There's actual research with athletes that say that if they do that, you know, with a contest in which they failed, their performance in the next contest is better. Now, ultimately, you want to get information. Like, as I said before, the painful feelings are like meant to turn your attention to, okay, what do I need to do differently?
Perfect. And given that you consult with so many high-level clients, I was wondering what are kind of the common difficulties and issues you see over and over again, and how do you help your clients kind of address those? That's a big question, I know.
Well, the real thing, you know, the real fulcrum of all of this is that we all are reacting to the market out of our self-image and out of what we expect to get out of the world and how we expect the world to treat us. So this is the fractal piece. And this is we're predicting the future based on our past experience. So it's different past experience client to client, right? And I always say it's like a fingerprint. You know, people can grow up, let's just say off the top of my head, neglected by their parents. And that makes them feel a certain way and have like a certain sort of reaction to uncertainty. But one client's way they deal with a feeling of neglect, which might be the market's never going to give them what they want or should get, right? And so then if you feel like the market's never going to give you what you want or should get, behaviorally, you're going to get out of the trade early, or you're not going to get in. Because like, it doesn't matter. I'm never going to, you know, my mother's never going to pay any attention to me. Market's not going to give me what I want. So I help people understand what that personal history, how it's playing into their expectations of future feelings, and then how that's driving market decisions. So like I have one client, this person, besides being the nicest guy I've ever met, is a brilliant investment manager. And I mean brilliant. And he has no problem taking huge positions. He was last year long 30% of his fund energy. And in the hedge fund land, to be 30% anything is jaw-dropping. But he simultaneously doesn't really trust himself, because he grew up in a family on a farm in rural America where it didn't matter what he did, you know, mow the grass, chop the wood, shovel the snow. His father was like, well, son, you could have done such and such. It could have done such and such. Now, to some degree, so that's resulted in him second guessing himself, always looking for more information to make sure that he can avoid the thing that he didn't do, which was never going to happen because that was dead. Now, on one hand, that's contributed to him being a brilliant investment manager, right? Because he turns over every rock. On the other hand, he doesn't always get big enough. He doesn't always stay long enough, because sometimes the second guessing gets to him. Now, in his particular case, he hasn't fully resolved that emotionally. I like to get my clients to the point where it never completely, whatever our childhood thing is, never completely goes away. But people can get to the point where it's mostly resolved and mostly detached from the market for all practical purposes. In his case, we haven't completely done that, but he's learned the skill, and this is a skill everybody, of just tolerating feeling that way. Like he can feel like, oh my God, I must be missing something. Oh my God, I must be missing something. What am I missing? And not get out of the trade, which is what he was doing before he hired me.
Right.
So as anyone who's ever heard me speak before in any depth knows, I have 1,000 stories of, people's personal history and how it plays out in that pyramid of future expected feelings. Like my own case, I was given up for adoption. I was kind of the bad kid in a way. Like I was rebellious vis-a-vis my mother. My mother was always telling me what a bad kid I was. Well, my response to that was like to be the good girl, show up on time, do my homework, be responsible, tell the truth, all these things. So when I started trading, it was like, take my stop losses. That's the right thing to do. Have a stop loss. Take it. No problem taking a stop loss. Well, except in that micron trade. But finally, the guy that I was working for at ETG called me up one day and he said, buy 5,000 shares of Kmart, which was dropping, by the way, which was not my style. And I'm like, what? I don't have enough money. Buy 5,000 shares of Kmart. I said, okay, buy 5,000 more. I'm like, what? I don't have the capital for this. He goes, I own the firm. Like, he was trying to get me to like be super aggressive and get over my need to be like the good girl who shows up and does what she says she's going to do and does her homework and all that kind of stuff. I didn't learn it that day. I did eventually learn it, that there were times that I could use my intuition and throw my plan out the window because I had enough experience to know this is like what's going on here. Anyway, I think I got off on a tangent. Oh, you asked me what I did to help my clients. We do all this stuff, help them work through their what are they predicting? But when someone works with me one-on-one, I want them to know what they're predicting vis-a-vis their life experience and help them untangle that from their market decisions.
Perfect. And specifically about, I don't know how much you advise kind of newer traders. It seems like mostly you focus on hedge fund clients and that sort. But you kind of have a recent example of a client that you think is, a good example for what generally newer traders go through and how they can overcome their issues.
Well, I have been, I ran a trading desk that we were bringing in new traders. It was back in the .com, day trading era. And when I first started this, I started it really through a futures broker and the Board of Trade and Chicago Mercantile Exchange. So, a lot of my early clients, and still, the Rethink group as a whole, by the way, has the whole gamut because we have a team of coaches now. Let me just think, So you're relatively new to trading. You have learned some method. The first thing you got to do is ask yourself, do you really trust it or not?
Mm-hmm.
And if you don't really trust it, you got to find a method that you trust. That you have the feeling that if you interpret the market through this method, you can make money. Like a lot of retail people don't do that, right? They learn from you and then maybe things don't go well and then they go try to learn from somebody else or and they flip. The other thing you do at that stage is you add things to your charts.
Mm-hmm.
Here's the thing that will help everybody. Scan all your charts, count the number of pieces of information you have, and then do some sort of, kind of basic, like you have all the information, and then you have all the combinations of information. Like, am I paying attention to the, 14-day moving average or 13-day moving average and the tick today? Like, you will find that you have thousands of pieces of information that you are putting on there to make yourself feel more safe.
Mm-hmm.
And it's having the exact opposite effect because it's adding permutations. And it's adding, today you can focus on this, but maybe that's not the right thing to focus on. Today I can focus on that. So do you believe the method? Simplify what you're looking at. And then realize you're going to be predicting, like if I take a trade, you're going to predict what's going to happen. But in what's going to happen is really, am I going to be safe? Am I going to feel good or not? Like, and you want to sort that out, like, so that you're behaving out of what you've learned about the market, and you're behaving out of that feeling, that subjective probability feeling, that is some confidence in this lens tells me, the S&Ps are going to drop from here. I mean, just using that because I was a futures trader. As opposed to this feeling tells me I'm going to lose money on this trade, and that's going to be bad, and I'm going to be at a very minimum mad at myself, disappointed in myself, and I want to avoid that. Like, you can start to say, is this feeling about the market, intuition, unconscious pattern recognition, or is it about what's going to happen to me? Because if it's about what's going to happen to you, like, you want to act on the feelings that are about the market. And so that moment, you can use your emotion differentiation granularity. I'm afraid, and people do this, I'm afraid I'm going to lose on this trade, and that's going to prove I'm an idiot and I can never learn to trade. And then this trading thing is going to, and my wife is going to have been right because she says I couldn't do it, or, and then I'm going to have to go find a stupid job. Like you're doing that. Everybody does it. I mean, I have guys that make, millions, hundreds of millions, they do it. Like, not every single one of them, but they do it on some level. So step through that. Now, the feeling that you can be looking for is that fear of some kind of regret, because that's the one. I mean, fear of missing out isn't even really a thing. If you analyze, okay, I'm afraid I'm going to miss out. Okay, what happens if you miss out? Well, I won't have gotten the trade. Okay, what happens if you didn't get the trade? Well, you'll feel bad. Fear of future regret. I'll be embarrassed. I'll be mad at myself. I mean, I had a hedge fund guy who totally lived in fear of missing out. Why? Because he was the youngest of four brothers, and his four brothers always tortured him, and he was always trying to be good as his. Now he managed to work through that and it'd be less of a factor. I think that's a series of steps that anyone can use.
Yeah, I think that's perfect. And going back to, the complicated chart with all these indicators, in some class during my engineering degree, somebody quoted Edward Tufte that was like, above all else, show the data. And if your data isn't clean and you've got all these different signals contradicting each other, it's just going to add complexity that isn't needed. So 100% agree. And
I want people to realize they add a thing to assuage the fear that they're not safe. They add a thing. The irony is we add a thing to create clarity. And it does the opposite.
Right.
And, oh, by the way, let me say something that I haven't talked about because I didn't have time. But now I have time. The research shows that the mental facility that makes a great trader is called theory of mind. We all have theory of mind, the theory of another person's mind. It's like an innate human ability. It's the thing in poker, right? You have a theory of what that guy's card did, is how he's playing them. It's a natural skill. We all have it. Like, it's predicting other people. Try to use it. This is a game of predicting other people. How other people are going to react to what's on the chart, to some news event. Like, it's a natural skill. You can use it. You can practice it. And the analytical method you're using is actually should be running through your theory of mind skills. And then a feeling of confidence or lack thereof drops out. Which actually reminds me to say something else. Over the years, the very, very, very best trades I've seen over and over and over and over again from retail traders and professional traders are like, they have an intuition that they're right. Like, this is what the market's doing. And they simultaneously are worried they're wrong. Feels too easy. I must be missing something. But they tolerate that and make their buy and sell decisions based on the feeling, the intuitive feeling, and tolerate the second guessing feeling, if you will. If you're 100% sure you're right, of course you're not, right? And if you're like so sure you're wrong, you're maybe right? Like we have multiple feelings at one time. So the ability to tolerate anxiety, like particularly anxiety that you then can, attach to, wait a minute, I had super critical parents and they, made me always get A's or harangued me if I didn't. Like you can know what you're feeling and why and attach it to the part that's about you, not the market. It gives you greater ability to tolerate it and make decisions on your confidence in what you're seeing in the market.
Perfect. And there's a question in the chat about visualization. So I'd love to hear your thoughts about, the process of visualization. Is it helpful, first of all, and how traders can use it if it is to improve their performance?
If you do the right kind, and what that mean by that is it has to be visualization where you feel it.
Right.
Now, the value of, and by the way, very few people do visualization so they feel it because they don't know that they're supposed to. So the sequence that you can use is try to do standard visualization. I, see myself trading my plan today. I see myself, honoring my stops. I see myself that's really like a cognitive, like you're kind of trying to imagine a movie there.
Mm-hmm.
What you want is the feeling that comes up while you try to imagine it.
Perfect.
And then you want to go off and work with that feeling, figure out what you have to do to neutralize the ones that are getting in your way and capitalize. At that moment, you're going to be feeling the ones that are going to get in your way. You're going to be some version of, I don't really believe it. I say I'll follow my plan, but there's that little voice. So you can use it primarily to get to the feelings you don't know you have. And then work with those feelings in a different way.
Perfect. And there's a question, I forget who asked it, about the process of dealing with a large loss or a period of time where they're not trading well. What kind of emotions come into play there, and how can traders come back there and keep a strong mindset?
Go back to when it started. Write out what happened. Be honest, as honest you can possibly be, with how mad you are yourself for whenever it started. Grieve whenever it started. Like go through a process of being sad about the trade that got away or the huge trade you screwed up. You were long Bitcoin and you were going to get out at 40 and you didn't. That was your plan. And now you're like sick and it's influencing every other decision you make. You got to grieve the first mistake. And you can forget everything that happened after the first mistake because it's just like your predictions about your future safety are so driven by this mistake that you try to put behind you because that's what everybody told you to do. If I've solved one slump this way, I've solved 1,000. Like it works.
Mm-hmm.
But it's painful because you got to go back to like whatever the first mistake was, which is something you're mad at yourself for. Like, I had a client, I've told this story a million times. Again, this was 10 years ago, called me in January of whatever, maybe 2013. I don't know. And said he'd been in a slump for 10 years. He's a professional, but he'd managed, because his previous career, he was a really successful hedge fund guy. He managed to kind of go to a bank for 3 years and then go to a hedge fund and then come back to a bank. And he was about to go to a bank or hedge fund, I don't remember. He's like, I've kind of survived, but I've been in this slump and I've tried this and that and everything. And so I did what I always do, which is ask somebody tell me about your life, blah, 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 blah. Well, it turns out his wife had been kidnapped and she ended up safe. She was kidnapped for her father's money. She ended up safe. But in the process of her being, he felt responsible. He felt essentially impotent that he didn't protect his wife. And then when she came back, they were fighting and he had an affair and, and he had all and it just went back to, he felt like he was like this useless guy because this horrible thing happened to his wife. And it was really painful to go back there. But once we did, he like started making money like in a month.
Perfect.
That's a pretty rare story.
Yeah, that's good. That's good. And you say this all the time, you know, in videos that I've watched, and also you said it earlier today about asking why and why that's so important. So could you talk a little bit more about, you know, the process about how we can ask why, and, you know, how that's useful, and why is it a thing that we should do?
I mean, the whys, these emotions are always layered. You know, so there's the one you can get to, like the fear of missing out, that really is fear of future regret. That it's like, okay, then what's underneath the regrets? Then you start to get to the personal, fractal, repetitive things. Well, number one, there's just that phenomenon of when you admit to a feeling, it loses some of its power. So if the real reason, like I had a client, well, I still have this client, but we did this a couple of years ago. They had a pattern of making a bunch of money, and then just all of a sudden feeling completely confused. Like, and having to shut down, like close all their positions and go flat. And this hedge fund person. And they'd done an analysis with Essentia Analytics, which does like really detailed portfolio analysis. And they'd shown like over 3 years that like every time they did this, they're doing well, take their book to zero. Like if they'd not done that, they would have made more money. Well, so I just like, what's your life story? Because I always know there's some formative experience that's going to drive that kind of thing. Which, by the way, I take people through in market mind games. And I won't. There's this new introduction to the trader brain. That's not going to go to, I'm like the anti-salesperson. That's going to be the follow-on course to Introduction to Trader Brain that we have on the website now. It's going to be a lot about today. And then the follow-on will be more how to do, but in market mind games, I take you through how to do this for yourself. Like basically this person had had a nanny who died, who they loved desperately and not much of a family, who died suddenly. So they had like happy, everything's going well. And all of a sudden the world became, and no one explained that the nanny died. The nanny was just gone. So like everything's going well. And then the world goes dark and confusing with and they're trying to work out that experience in the market. Like so everything's going well, positions are making money. And like, because they had this really traumatic experience, like that brings on those feelings. Current experience that looks like past experience, predicting. So they were trying to avoid the pain they suffered. So what happens is if you end up knowing like what your thing is, like your core sort of personality structure, and like how safe you feel and vis-a-vis the authority of the market, you're able to then like put it into words, and just like, you know, I'm annoyed with the dog, it neutralizes it somewhat. And this is where like your cognitive capacity, I mean, obviously it's not like our cognitive capacity is useless. Like your cognitive capacity can sort out these different feelings, and you can use what you know about feelings to greater be able to tolerate the irrelevant, impulsive ones and behave out of the intuitive ones, which by the way, intuition is calm, impulse is agitated. Impulse, you generally want to do something. Intuition is calm. Now, you can sometimes look at the market and go, oh my God, I can see this is happening. And it has like an intensity to it that may not jive with me saying intuition is calm. It's an intensity of knowing versus an intensity of you have to do something. If it feels like you have to do it, you don't. I mean, that may not be completely true. You could see something that's turning and you know you should get out of it. So that might be a little slightly misleading, but generally speaking, like if it feels urgent, it's impulse. And if it's just like a sense of knowing, even it can be a really strong sense of knowing. It's unconscious pattern recognition based on your expertise, education and expertise. So another thing retail traders can do, you can set yourself up a day where your job is, you're not trying to make money. You're trying to look at the market and know what you're feeling.
Mm-hmm.
Or an hour or 2 hours. Set up 2 hours at a time the market's likely to be active. And maybe you'll take a trade and maybe you won't. But you're trying to do that deliberate practice of what do I really think? What am I feeling? What feeling am I predicting? That's another thing traders don't do generally. I mean, you learn any other field, like you learn the cognitive part, you go through internships, you practice, you do labs. We don't do that. But we can set it up ourselves. It's hard because trading's really fun and you want to make money and but if you want to be really good at it and be at it long term and actually really make money, create yourself a practice structure for the stuff we've talked about today.
Perfect. And you kind of touched on this a little bit, but is there a way to mindfully build intuition, or is it just something that comes out of your experience going through different situations, your education, building that knowledge base, or is there a way to kind of accelerate that a little bit? I'm not looking for shortcuts here, but just is there like a specific practices that you can do?
I honestly think if you're cognizant of what we've talked about today, and you're actively trying to track your body and then the senses, feelings, and emotions it's giving you, it's going to accelerate it. I mean, can you walk away from a trade setup and come back X amount of time later, and before you come back, ask yourself where it is? Yeah. Can you, write down what your intuitive? I mean, I can tell you this: the pros, they say I knew it and didn't do it a lot. They do.
Mm-hmm.
I mean, my best clients do it less. My best clients do the opposite. I'd listen to myself. I'd listen to that feeling. Which in some, there have been days that I've gotten off the phone with 6 or 8 people managing lots and lots of money. And I thought, what did I do today? I helped them listen to their intuition. I helped them make choices based on their unconscious pattern recognition, based on their expertise, and help them avoid the thing where they were trying to look smart or, kill it at the end of the half or whatever.
Perfect. And we're coming down to time here, but I just want to kind of ask you in general, what are some, to bring all of this, everything we've talked about together, what are some key things that you want people to walk away from, this discussion, this presentation, and remember? What are the most important concepts?
The first is, chances are a big percentage of the mistakes you've made is because someone else gave you the wrong advice about your brain versus the market. Well-meaning, and I don't mean this pejoratively in any way, shape, or form, but Mark Douglas was the wellest meaning person ever, but he didn't have the brain science about emotion. So don't feel guilty that you've been making mental mistakes because you were trying to follow a strategy that was a flat earth strategy. So just recognize that and give yourself a break. And second of all, just say, I am going to learn to predict. No, be conscious of the future feeling I'm expecting. Now, you probably got to put a lot of steps in place to do that. But that's it. Because when you know that you're predicting, let's say, irritated with yourself or embarrassed,
mm-hmm.
you can neutralize it. And in neutralizing it, you can hear the intuition and hold on to the trade until it works. So you're not going, God damn it, I did it again. I knew it was going to work. I got out early. The S&Ps have moved 14 points, and you just want to shoot yourself. And you think it's because you didn't use your cognition to follow your plan, and there's something wrong with you. Why you can't? No, it's not. You were told the Earth is flat and it's round. So learn to work with the round Earth, which is learn to know what you're feeling, what feeling you're predicting.
Perfect. And I know you had a slide on this, Denise, but where else can people learn more about, what you teach, and what other resources would you recommend to learn more about what you've talked about today?
Yeah. So our website is therethink.net. There's, podcasts galore. There's a blog that's been, written to some degree for 15 years. There is information about coaching and whatnot, and there is information about this. What we're doing is we're releasing this e-course, I hope October 1st, but it's probably more like November 1st, to be honest. And I'm going to put like today's presentation in workshop format. It's a really pretty good price, I think. And so we're starting pre-sale, sort of pre-release sales today. And I'm on Twitter, Denise Shull. And Rethink Group is on Twitter. I have a brilliant young person who runs a Rethink Group Twitter and Instagram. God forbid, I think we're even on TikTok. What do I know? But yeah, I mean, Twitter is easy, right? And our website's easy. And
Perfect. Well, Denise, thank you so much for your time today. I think, like I said before, I'm going to watch this back a few times and take some more notes. But thank you so much for your time. I think everybody watching enjoyed it immensely. And to everybody watching, if you did enjoy it, please go ahead and leave a like. And as we said before, this conference is completely free. But if you're finding value in it, please go ahead and donate to St. Jude's. We'd really appreciate it. And with that, Denise, thank you once again for your time and for being here.
Me.
Yeah,
great.
perfect.
Thanks for having me, Richard. Okay. See you soon. Bye.
Yep, perfect. We'll be right back. Take care. Everyone, welcome back. It's my pleasure to announce our next speaker for the TraderLion Conference, Mark Ritchie II, who is a managing partner and portfolio manager over at RTM3. He was also featured in Momentum Masters alongside Mark Minervini, David Ryan, and Dan Zanger, and he's also an analyst for Minervini Private Access. Mark, thank you so much for being here and welcome.
Thanks for having me, Richard. Good to see you again.
Yeah, good to see you as always, and really looking forward to this presentation, diving a little bit into your background and also the lessons you've learned along the way. So yeah, the floor is all yours.
Sure. So yeah, so the title of this talk is What I Learned Working with a Market Wizard. And this was something that Mark Minervini and I actually put together this presentation together in a little bit of sort of a retread of what have I learned under his tutelage at sort of essential lessons in the last 10 years. And he was asking me the questions. We were going to do this together, but due to some of his schedule constraints, he couldn't. So we just sort of put this together and thought, yeah, I'd walk you guys through it. Before getting into it, just a real quick disclaimer. Nothing that I'm saying should be construed as investment advice. Obviously, do your own due diligence. This is, not, it's for education only and not an offer or enticement to buy or sell anything. Please, adhere to good risk management principles. So yeah, that being said, Richard, you mentioned, I was fortunate enough to be featured in Momentum Masters sorry, here, having trouble going to my next slide. Yeah. With Mark, David Ryan, Dan Zanger, a number of traders who have a breadth of more experience than I do, and now I have the privilege, of course, of working side by side with Mark. This year is really kind of one of those things coming full circle for me personally. This is a little bit of a soft plug, if you will, for the Master Trader program. But the irony is, I didn't know Mark from Adam. He didn't know me. I went to the first one in 2010 with almost no money and a little bit of, I'd been trading on my own for a little bit and trading in general for a few years, but just eager to learn like anybody else. And this was sort of really one of the major catalysts for my success and helped me put a lot of things together, the timeless principles that we talk about. The program is better than ever. I know, because I've been to almost all of them. I believe you've attended as well, Richard. The nice thing about this year is that there's going to be a full second day of Q&A. So it's 4 days of content, 2 days of Q&A, and a day of live trading. So it's a real honor to go from a student to a co-instructor. Very appreciative, obviously, Mark for doing that. But just so people know as well, I was a student and a client of Mark's MPA, those type of programs. So I wouldn't put my name behind anything any course that I haven't been through and haven't learned a lot from. This some quick stats about myself. I've been trading for 15 years. As I said, went to the original Master Trader program, was fortunate enough. In those days, there was no, trading derby or a U.S. investing championship like it's currently going now. So Mark sort of did his own. I was fortunate enough to win. That's actually how we got to know each other a little bit better. The winner in those days, Mark said, hey, if somebody wins this contest, sends me their trading record, I'll fly out here. You can sit side by side with me in my office for a day. So I said, well, that seems like, a worthy endeavor. So yeah, really just studied the strategy, become a student of it like anybody else. And, took 100,000 into over 20 million. The other person who I should give a lot of credit to is my co-portfolio manager and one of my best friends, Brandon Hedgepath. He went with me as well, was even probably poorer than I was in 2010. We both were just trying to figure this business out and decided to go together. And we've been in the trenches together ever since. Now we're both analysts at MPA. And as I said, because it's just a product we really believe in, and trying to keep people at the very least adhering to really good, risk management principles, trying to keep people on the right side of the equity market. And and just doing much better than I think they would be otherwise on their own, and providing education. Look, guys, it's an education thing. That's what I know, Richard. That's what you're trying to do here. How do you educate people and help them be better traders and investors? The reality is markets charge tuition. So would you rather pay it to someone who knows what they're doing, or just sort of slog it out, trial and error and those types of things? So, and you know, it's just there's no shortage of experts. I do think, though, there are probably a shortage of experts who really have really solid track records. So, speaking of which, this is, you know, just sort of annuals of our track record. Not saying it's the best out there, but something we're pretty proud of. What I really want to get into, though, and the good stuff, as I like to say, is the vacuum-packed, insulated process that this style of research and trading really offers you. And what I was skeptical of early on, and a question I often get a lot of the time, is how did you make this good market call? How did you know when to be in cash? How did you know when to start investing again, and those types of things? And what I normally always tell people is you have to have a process. And your process has to keep you insulated. And what I mean by that is where you are playing your game and not somebody else's. Or, for example, your process has led you to a position or opinion on the market, and you're not going to let an economic data point, somebody else's opinion, influence that. And I think one of the biggest advantages that's also an extreme disadvantage is the fact that everybody now has the ability to trade any market, anywhere, anytime, on your phone, on computers like we're on right now. I mean, you can get up in the middle of the night and trade, you know, currencies, other global stock markets, cryptocurrency, all this kind of stuff. That's an incredible advantage, but the noise factor is the incredible disadvantage. And I think you and I have talked about this in the past, Richard, but the reality is your process should automatically keep you insulated in a way that you're focused on what you're doing. So, meaning that it doesn't matter how scary things look or the headlines are or those types of things. You're simply following the market. And probably this is one of the biggest lessons I can remember early on, being very skeptical. I had the good fortune of at the very first Master Trader program I went to, there weren't a lot of us there. And I was sitting next to a guy who was a former institutional client of Mark's, I think from the 90s. I won't mention his name. He's a very private guy, but he's a very successful trader and somebody I want to becoming pretty good friends with. And I said to him, so you're telling me if I just screen stocks and sort of go through this routine and this process, that they will guide me? I don't need to look at all this eco-fundamental data, and I don't need to watch news and all these other things. And he goes, yes, that's exactly what I'm telling you. And he had been, again, he was a client of I think Mark's back when he was selling institutional research on Wall Street in the 90s, but then had been an independent trader himself for over a decade and had been very successful. And like anybody, I just thought that seems a little overly simplistic. The reality, though, Richard, is nothing could be closer to the truth in terms of how simple it is. Simple in theory, hard in practice sometimes. And especially now, because now not only do you have instant news at your fingertips, you've got financial Twitter and a zillion opinions. And of course, everybody's an expert on everything all the time. Where if you have to have a process that allows you to ignore all that. One of the things, though, I remember Mark said was that in his old shop, he wouldn't even let people bring in newspapers. He wouldn't let them bring in other firms' research. He wouldn't let them, nothing else was allowed. because he didn't want anything causing, any type of a distraction from, again, their vacuum packed process and how they were doing things. And I can't underestimate how much that has helped me in the long run. And really one of the best examples is, after COVID, there was an extreme amount of fear and pessimism, as I'm sure you remember, and anybody who has been doing this for longer than a few years will remember. We had this enormous break in the market, but the headlines were rightfully so pretty scary. And there were sort of twofold, if you remember. It was global depression or people calling for 1929 in terms of the economy all over again, those types of things. And then, of course, there was is this going to be the Spanish flu where 5% of the population dies because of, multiple waves? And of course, everybody was convinced there was going to be this massive second wave. And lo and behold, we had, I think, a risk model buy signal in early April, and then stocks started setting up around May. And it was, if you weren't sticking to your process, you wouldn't have been buying them. And I know lots of people said, I'm gonna follow the news and not the process. And they just missed out on what was an incredible opportunity. And there were actually multiple incredible opportunities. So, one of the biggest things I learned, and I'd been doing this for a while. It wasn't like I was brand new. I've seen many iterations of this, but this was one of those scarier ones, where you're sitting there going, I'm not so sure. And this really, I think, translates to maybe even the environment we're in now. We're in a bear market. Pessimism, based on a number of the sentiment measures, is very high, meaning that people are extremely skeptical and negative. And I have a feeling, I don't know, that we may see that even get worse, or specifically, you're going to see calls for global recessions increasing, or that sort of that narrative that the economy is really going to sail off the cliff because the Fed's over tightened and all those types of things. And I'm saying this is a perfect time to adopt an insulated type process. What is going to have you buying regardless of what anybody says? And that's the power of a really good process. Specifically, what we're doing at, Minervini Private Access, the types of things Mark and I teach, is follow stocks. It's a market of stocks. If you want to follow news, go to journalism school and or figure out how to be a reporter, because if those people were good at trading, that's what they'd be doing. Their job is to, push out headlines. A lot of these headlines are stale or old. Same with economic data. I'm not saying, you completely ignore 100%, of all news, but the price action, and specifically how stocks are acting. You can read those headlines, but you cannot let that into your decision making when it comes to trading. So that's sort of, paramount commandment number one, if you will. The second thing I would say, that has really been paramount to my success, but one of the things, that I've tried to teach, and it just becomes axiomatic, is the idea of always thinking risk first. And, almost every successful trader I think I've known, if they either do this intuitively well, whether they would use this kind of language or whether they think about it, but that they're always calculating or trying to get odds on their money, if you're using gambling terminology, or they're trying to make good risk adjusted bets. And what I mean by that is, on average over time, their expectation is to be way ahead, because they're thinking about the relationship between risk reward, and specifically then creating that asymmetric relationship. So whereby they can be wrong 1, 2, 3, 4 times in a row, but very quickly, once they're right, make all of that money back and a lot more. People are often surprised when I tell them, I'm usually wrong a little more than I'm right. And they're, well, how could that be? Well, because I'm I'm structuring in asymmetry. I'm layering in asymmetric reward to every decision I make. And this plays out in a few different ways, but I think one of the most important is this idea of if I like an idea, or let's say it's, in most cases it's a stock. I want to buy a stock, but I can't find a good low risk way to get in, then I have to either wait or just pass on the situation because I want to get multiples of my risk. So, and this is one of the reasons why stocks or markets that are wildly volatile, and the way I would define that, or we would define that, is that they are carving back and forth in huge swaths. A mistake people often make is they think a momentum situation is very volatile. Not necessarily. Usually that, if that momentum is moving one way, that's, we would define that as alpha, not volatility. It's that knife that's cutting back and forth that can really cut a sort of low risk directional trader to shreds. And so, yeah, I am trying to find a way to get on board something that I think has a potential asymmetric payout. I can't understate this. This may seem remedial to some folks, but that is ultimately what is driving a lot of my decisions. So maybe I love a certain story, a certain stock, a sector, or I really find it interesting. But if I can't find an asymmetric way to put it on, meaning that where I'm right, I'm going to get multiples of my average risk, then I either have to pass or wait. The next point, which is something that I've always been a believer of and was doing even before coming to, something like, Mark's seminar or under his tutelage, is the idea of tracking your trades. He calls us knowing the truth about your trading, but it's the idea of rolling up your sleeves and really getting in the trenches within your own results. So I am blown away both as a trader at the number of supposed professionals who don't either do this or know this. And what I mean by do this is track this stuff. And then if they do track it, really getting in and studying the results. And there are some successful professionals who I know that don't, but it's only either because they've done it so long where they know where their average metrics are that they don't really track them anymore, or it's become so axiomatic that they cut their losses so quickly that they haven't really sort of geeked out on the stats and the numbers. But if you are new, and specifically if you're having trouble, this is probably the most underrated portion of a trader's arsenal. And the reason is because when you actually take a step back, stick everything you've done on a spreadsheet, it's staring you right in the face in terms of what you've actually done. So it's real easy. You and me could throw up a bunch of charts, a bunch of ideas, and I could give you these ideal buy and sells, and everyone could then go home and say, oh, I'm going to do this perfectly. The reality is the real world, it does not work that way. We have emotions, we have feelings. Sometimes we don't get enough sleep. We wake up in certain moods and do things what seem like for bizarre reasons. This is why putting all this stuff down, tracking it and looking at it, it's staring you right in the face. So when someone is having a rough go and they go, I just don't know what's going wrong, this is where you need to start. What is your average win? What's your average loss? What's your win rate? That's where you should start. And I would encourage people to know those things sort of in their head, because what will happen sort of axiomatically is you'll know that, hey, on average, this is where I tend to have an average loss. That tells you then, if you want to my previous point, always be asymmetric in your risk reward relationship, that you need to be going for multiples of your average loss, say for your average gain. And then of course your batting average. At what percentage of the time in a normal market is my expectation to be right? The reason I say, hey, I'm often wrong more than I'm right is because I've done thousands of trades and my win rate is right around 40%. So I, even emotionally speaking, know that on average, when I place a trade, 6 times out of 10, it's going to be a loser. Well, that has a little bit of an emotional advantage as well, because I'm not going to get too wrapped up in any one trade. If I know, Richard, on average, that all things being equal, losses are a regular part of my game. It also helps you spot tendencies. And I think this is also really underrated. So, and I would encourage people to track this, put the trades in as you execute them. So some people do it, say when they close a trade and they go back and they put the, where did I buy it? Where did I sell it? Win, loss, what were my percentages? That's fine. Some people do it in real time where they just put down the buy and then they put down the sell. But I would revisit it then in a month or two, and then really take a hard look at the trade. Once you're sort of, removed enough to say, was this a good buy? Was it a good sell? What was I doing here? Did I follow my plan? That would be the other thing you could also do. And if you're new at it, I would encourage people to do that. To even, especially if you have a hard time in the trenches, in the moment of battle, actually doing what you said you were going to do. Well, you can put that down too. I bought XYZ position and I was going to do, A, B, and C. I'm going to stop out at this point. I'm going to you make the plan even as detailed as you want. Maybe you've got a couple of different spots or multiples of risk, or I'm going to set an alarm at a multiple of my risk and see how the stock is acting and take off a portion and hold the piece for a bigger. However you predefine that plan, you could even put that down and follow it, and then come back and see and reevaluate. Was my plan good? Did I follow it? What are my tendencies? And often though, what people find is they have some strengths and weaknesses, and this will come out in the numbers because we are nothing but a reflection of the way that we trade. In terms of our trading is an expression of who we are. So generally what you'll find is that people have a strength in one area or the other in terms of buying and selling. So they're either they sell well, meaning they sell losses well. They're very diligent about taking their losses, but maybe they hold on to those profits too long. They're very good with their buys, not so good with, stopping out where they said they were going to stop out, all those kinds of things. And you'll just see repeated patterns, or sometimes people choke off trades too quick. Maybe you're better at holding, your winners, or you're better at holding on to positions, but you hold on to them too long. Right. So studying this stuff is the best way to really improve. And I'm speaking from personal experience. I have found over the years that I am definitely more prone to choke trades off, meaning that I am very diligent when it comes to loss cutting. I am extremely diligent when it comes to, if all things being equal, if it doesn't work right here, right now, I want to get out. Well, the downside of that is sometimes I'm often, especially early on, cutting positions just too quickly, or cutting positions on price action that was normal. And that's really what, I often say, you want to cut, ideally positions on abnormal price action, not normal price action. Of course, there's a lot of gray area and art in there in determining which is which, where, I know other traders that are basically, are just the opposite. They're the people that are hanging on to their winners and giving way too much back, off the upside. So it is a balancing act, but figuring out who you are and where those tendencies are really best done in rolling up your sleeves and digging into the truth about their trading. There was a season for a while where, this was before, I was asked to come on board as a consultant at MPA. So I want to be clear, I do not do this anymore, where occasionally people would, find me and say, hey, could you do a little coaching or helping for me? And I would often just say, well, sure, send me your trading, send me your metrics. And almost invariably, people either didn't know them or didn't want to do the work to do it. So it almost became this easy way to get rid of people who weren't serious about the business. It's saying, well, if you can't even do that and you're struggling, you probably don't have much of a chance, because you're treating trading and speculation much more like a hobby than a business. How many people, run a successful business and know nothing about the level of inventory in their store, know nothing about their profit margins, know nothing about, what items are selling versus what ones are not. I mean, if you and I, ran a department store and that's how, we ran our inventory book, we'd probably be out of business in short order. Trading is no different. And I think this is true regardless of time frame. If you're a short-term trader, long-term trader, even long-term investor, knowing this stuff, I think, is invaluable.
And a quick follow-up question, Mark, there. Once you noticed that tendency that you would choke off trades and not give them quite enough room, what kind of changes did you make about your trading? Maybe you introduced some trading rules. How did you address that tendency?
Great question. Well, the first thing I would say is, and maybe, so if the tendency is, in my situation, to choke it off too early, you could start by not selling all the position, which leads into this next point of being more incremental, or not treating every trade as completely on and off and trading around a position. Because there were plenty of times where I cut a position to what feels like early, and then it fails. But the other thing then is looking at where I would look at to ask myself, okay, why am I cutting this here? So let's say I for sake of argument, I had a stop, it was at 5%, but I decided to choke it off at 4%. Does that make a lot of sense if the stock isn't really doing much more wrong to hold it for that 1 more percent versus just choking it off early? And then some of it really is trade by trade. So then there were certain setups or high momentum type situations where I choked a trade off and then saw the stock turn around and just make a gargantuan move. Well, to save 1 or 2% in a situation like that doesn't make mathematical sense. So let's say you choke off a trade to save yourself 1 or 2%, but based upon the type of situation, it has the possibility of turning around and going up 20 or 30. So you took an inverse relation. I saved 2 and missed out on 20. It doesn't take choking off too many of those to make a huge negative impact on your trading. So in terms of that asymmetry point from before, I just realized, holy smokes, just stick to the stop. Certainly, and I'm talking about, for those, who are more familiar with my style, that highest relative strength type situation, highest momentum type situations. So a little bit, it's case by case, but in some cases you might actually, dig into the numbers and while you think you're choking things off, if you study it, you might find out that you're not, that actually, you're doing things well. You won't know though, if you don't really, do some post-trade analysis. And the reality is it's not sexy work, so a lot of people don't like doing it. Where I find it comforting too, because even in bad periods, if look, in a good market, I make 2 to 3 times my average loss, and I'm right half the time, you can make an awful lot of money. So that keeps me emotionally in check. It's like letting the stats almost calm your emotions to say, look, you have an edge. Maybe you're not having a good edge right now, which, provides that feedback to either trade less and trade smaller, right, to keep you around and in the game and engaged for when things, really start to turn around. The other thing tracking trades has shown me is that wins and losses are not evenly distributed, meaning sometimes wins come in bunches as well as losses. So there's incredible information in that. Think about that for a second. If you know it's not always heads, tails, heads, tails, heads, tails, that gives you the opportunity to knock off that negative side of the distribution curve by trading smaller and increase the right side of, if you think of it in terms of a distribution, curve or bell curve. So, I would encourage people just to think through that. But as you study it, again, it's what we call, at MPA, letting the spreadsheet come into your trading. Well, if you don't have the spreadsheet, you don't do the work. It has no chance to get in there. So that's, like I said, it sort of leads into my next point in terms of just not treating trading as a complete on and off business. Mm-hmm. So everybody wants to think, well, I'm all in or I'm all out, and that's the way it is all the time. And this is true on a position basis as well as an entire portfolio basis. A lot of the times you're in betweens, or what we call jockeying for position. You're not all in and you're not all out, and you're sort of looking for that clear straightaway where you can really gas it. And this is where it's practice, but we call it, using, Mark sort of coined the term progressive exposure, which you sort of hear being thrown out, and that really is it's sort of the artistic side of the business, in my view, or of trading, where you're trying to expose the most capital when things are really working, and being able to lever yourself up in terms of exposure without just taking more abject risk. See, most people just think, well, if I take more risk, I just make more money. Well, that may be true, but you might also just take a lot more losses, where if you really learn how to do this, you can pyramid your exposure in such a way where you can put yourself in a really powerful situation where you can lever up without taking more risk. This is something we get into detail in the Master Trader program. It's something I get asked questions on all the time. And what I will say is, this is definitely an art, something I'm still working on, something I'm literally asking myself even right now as we're potentially, I'm looking for the next opportunity to really get aggressively long. Well, I'm not just going to wake up one day, get dressed, and decide I'm going limit long the market. That's not how it works. I mean, you can do that, but if your returns are even up, they're going to be extremely volatile, and most likely you're going to get yourself into a whole bunch of trouble. Where if you learn how to really build on success, and use the feedback of the market to put you in a good position, you can really you can take what feels like really small initial risk and then pyramid it into something where you can take just a giant step forward in a very short period of time. And this is really how, if you look at, say how Mark won the U.S. Investing Championship in some of my best years where I had really big returns, that's precisely how I did it. But just encouraging people, though, to start with the idea that you have to be incremental. And this is something that takes practice. It's the same with a lot of people don't like the simple concept of trading around a position. It's sort of like ground zero for this. Mm-hmm. Most people just I want to buy it all in one spot, and I want to sell it all at one spot, rather than learning to trade around a position, or get really, you buy a little bit of a position and often it improves. And so for me, I want to buy more. That is, I have learned anyway, very counterintuitive to most folks, but it can be learned. And it's a really powerful concept, because most people think, especially in our case, we're usually always buying more at higher prices. Most people don't like doing that. I can't, for the life of me, it feels counterintuitive to not do that for me personally, because it's sort of like saying, hey, do you want to bet on the guy who is the best player in the league or the worst player in the league? Right now we're nearly at the all-star break, say, of the baseball season. Who do you want to put your money on? The guy who has the best slugging percentage, the most RBIs, and most home runs, or the guy who's 0 for his last 40 because you think he's due. I want to put it on the guy at the All-Star game. And that's the equivalent in my mind of adding to winning positions or looking for those situations where you can do so optimally.
And Mark, could you give us kind of simplified example of what progressive exposure actually is? Like, say you're completely in cash in a correction, and then you try 3-4 stocks. What kind of feedback would you look for on those initial positions in order to size up for the next trades, and how do you manage that risk along the way?
Perfect. I am going to actually do that in a second. You're leading the witness, which is perfect.
Perfect.
Because after this last point, I'm going to give what I call the Minervini loop that we try and teach folks, and then talk you through sort of a real world example. Just the last point though, which again flows from what I was previously saying, is the idea of the chicken versus the pig. No one to be a chicken, no one to be a pig. And a little bit of this is, I think, the idea of being a pig, you hear people say, or quoting guys like George Soros and Stanley Druckenmiller, who said, if you want to make really big returns every now and again, you have to be a pig. And what he meant by that is, knowing really when to get aggressive. Most of the time, though, I'm in the chicken category, meaning I'm conservative. I don't want to risk a lot of money. I'm not looking to put a lot of, I'm not really much of a poker player. I don't want to put a lot of chips in every pot, or I don't want to play every hand, however you want to think about it. I want to sit back and wait. It's been even a number of many months since I've probably been even more than 50% invested. Really over, there was one point in the fall of last year. So we're looking at maybe 12 months, Richard. I haven't been more than 50% invested, just counting lots of cash, and on average, it'd be even less, doing very little trading. Why? I'm not seeing what I need to see. And it sounds overly simplistic. This is, again, one of those things easy to say, hard to do. And this is something I'm still trying to get to improve on, and something I think I would definitely say with practice, that if you put these things into practice, this is something you will get better at. Because what winds up happening is you continue to that first point, you go through this process, and then you see situations where you're like, I think I've seen this before, or you get a little bit of that, I don't like to even use the word sixth sense, but it's what feels like sixth sense, but what it really is mastery of something. Mark talks about this in his book, Think and Trade Like a Champion. The idea of mastery, I think he used the example of a violin. Like there were no masters of the instrument that didn't put in so many hours. So by the time you put in enough hours in anything, you are operating on a higher level than anybody else. It's the old, nothing replaces experience. I think Malcolm Gladwell calls this the 10,000 hour rule, that after you put in 10,000 hours in anything, you are operating on what almost feels like a sixth sense level. Well, this is where that, knowing really when to be aggressive, that kind of comes from. So to bring it to your question, this is labeled the Minervini loop, but the loop we try and teach people is, okay, stocks, tactics, and feedback. This is sort of wrapped around the strategy and the process, meaning the process doesn't change. The stocks certainly will change. In every cycle, there'll be a different group of stocks. And even right now, the stocks that are sort of, coming across our radar as potential leaders are much different than the ones that maybe we were even looking at a couple of months ago, or certainly a year ago. Anybody who's trying to bottom pick old leaders and all that kind of stuff, that's not what you want to be doing, in my opinion, at least if you're looking for new leaders, because, old leaders don't lead new bull markets, generally speaking. So it's stocks, tactics, and feedback. So, okay, it's as simple as, if I get some stock setups, the tactics am I seeing these proliferate in terms of low risk entry points, or potential breakouts? You buy a few, maybe it's just one. If you're dipping a toe, you only have to buy one name. You don't have to buy, maybe you see 5 stocks, there's nothing wrong with being a chicken, and you should be a chicken at first. But if you buy one and it starts to work, you got to buy another one. Or more specifically, if you see more, and maybe you see 5 stocks, you buy one, but you watch the other 4, and those are holding up on balance, you're getting good feedback. And then right back around the loop, I see more stocks, you express proper tactics in terms of buying good. This is assuming, of course, you're buying good setups and managing, risk reward relationship, but then the feedback is there. And it just becomes a quickly self-fulfilling part of the process where you go, okay, now I'm really starting to see what I need to see. And to the on and off part, most of the time you're operating between the extremes. You're sitting there going, okay, where are the balance? Where am I in the balance of this loop in terms of what types of setups are working? How long are they working for? This is where last year we had a lot of stocks and a lot of breakouts. They just didn't hold for more than 2 to 4 days tops, maybe. Yeah. And Richard, if you were watching any of this stuff, it was I think we sort of nicknamed it the pops and drops, after a couple of days. And so anytime, which, it was phenomenal for shorter term traders. This was something we were talking about on MPA, and actually, Mark won the U.S. Investing Championship, I think probably trading more trades, shorter term trading than maybe even he had in his career. I was sort of doing the opposite. I was saying, look, I'm gonna play like I normally would, more as a position trader for bigger moves. Well, I would take portions of positions and then wind up getting stopped out on an awful lot of those positions, giving back everything I gained, ideally at break even. So it was sort of, for me, it was a year of 2 steps forward, 1.5 steps back, and jockeying back and forth all year long. But I know if I play the game right, I'm going to put myself in a really good situation. So in terms of, for a practical example of how this works, taking it all the way back, from the beginning in my example in terms of being insulated through the process and what did this really look like in 2020, I just threw up, I tweeted this a couple of months ago. And actually I tweeted a number of sort of past precedents, all of which were ones I actually traded through. So that's sort of a big thing for me, and definitely one of the things I've always appreciated about Mark in terms of whether it's his books, workbooks. I know for a fact he traded a lot of those examples, and I traded a lot of the examples. We're not just cherry picking great ideas. These are 95 to 99% of the ones we certainly analyzed, and most of them we traded all of them. So this was the market after the COVID break, and for those who weren't trading, this was one of the worst slides, certainly one of the fastest waterfall type declines, in the history of the stock market, really going back almost 100 years. It was sort of 29 to 87 and then 2020. So to call it unprecedented, it was right on the money. And the reality is things just sort of as quickly started to come the other way. It was April 6th, with a large red hash mark there. You can see where there was a follow through day. And that's where sort of the risk model at MPA went on a buy signal. There weren't a ton of stock ideas yet. And for anybody who was trading this, a lot of V-shaped charts, because you had this huge break on the left-hand side and the market bounced kind of hard. And we came off those lows pretty aggressively. But, in this first shaded area, while the index was kind of marking time, this is where you started to see stocks setting up. This is where Netflix and Amazon and some of those even early institutional favorites broke out, but names like Zoom, Teladoc, there were a number that started to set up and work. And that's where I started taking positions. I got pretty long, and it wasn't really, I can't remember if it was there, but it was the second shaded area though, where it was in the summer. And this is really when the market had come back to new highs and the narrative was highly skeptical, negative, very bearish, as we talked about before. And there were just tons and tons of stocks setting up. Between, May and June, I had made a lot of money. So, the temptation was, hey, kick your feet up, maybe rest on your laurels, and don't take the added risk. But the process said, look at all these stocks. You trust the setups. And this is where, Mark and I have told this story a number of times, because I was just sort of been doing analyst work for him side by side. And I said, I haven't seen this many setups in a long time. But, these things may all fail. And he said, if they fail, they fail. We're buying them. Mm-hmm. You follow the stocks, trust the process. And it actually reminded me, there's a famous story from whatever Super Bowl it was that the Patriots had the largest halftime deficit in the history, or the largest come from behind victory in the history of the Super Bowl, Patriots-Falcons from a number of years ago. And they said that all Belichick said at halftime was, forget the score and trust the process. Well, it obviously worked out well for them. And again, something that sounds real easy, right? But when there's a lot of fear and anxiety and, people saying the world's coming to an end, it's not easy to buy a bunch of names just because they're set up in bases. Well, it's a lot easier when, again, you've got this regular process and there's so many ideas. One of the best signs, though, that I often tell people is when there are more stocks than you have money to buy. That's a great market. If there's one stock set up, Richard, everybody who's doing this has only got one idea, and it's going to be far more failure prone. Yeah. Not to mention the idea that, institutional support is what we really want, right? Institutions that are buying stocks for days, weeks, even months. And this is precisely the environment. What happened? The institutions got rinsed out of the market in March, and here they are just, marching all the way up that right-hand side. Well, when you get these low-risk entry points and consolidations in waves, it doesn't mean that you're necessarily going to make a lot of money, but it is it is really the primary indication for me to get really, really aggressive. And the longer you do this, the more it becomes a little bit of second nature. And this will happen again. The question is whether or not you will be trained, and be ready for it. Because just when you think things are never going to get better, this market, it's terrible, and you're starting to hear this even now, you'll get a rally, no one's going to believe it, and then you'll get either a bunch of setups or, what we call a wave of these opportunities. And the majority of people will ignore them, and those people who really practice progressive exposure, think risk first and putting themselves in asymmetric situations and aren't afraid to be insulated from the crowd, are going to do really, really well.
Perfect. And before we get into that, I do want to come back a little bit to the nuts and bolts of progressive exposure. And if you could just kind of talk about, when you're first coming out of cash, what's kind of your starter position size, and how quickly, based on feedback, will you kind of ramp that up to full positions when you see all the stocks following through, the market's improving, there's more and more setups? What do you kind of do?
It's different a little bit every time. So it depends on, normally, every time we get some type of valid accumulation day, and this is something that I learned from David Ryan at one of the Master Trader programs. He has what he calls a mental health buy, mm-hmm. or that he termed, meaning if you get an accumulation day, you have to buy something. I put that in my notes because sometimes I would wait, and then, none of us know, Richard, like people think you have this clairvoyance, or that like the market isn't going to tell you which one's the real low or what's the real follow through day. And sometimes you get a follow through day. And like I said in the prior example, and there aren't a lot of stocks, right. But if you buy something, and this is position relative, for some people that might be a really small position, a couple of percent. For others, they might take one bigger position, but they're not going to add any more if that one isn't working. I've done it in both ways. It depends. Sometimes if I think maybe there's a real, what looks like a key leader to me, on a follow through day that is, or right around an accumulation day in the market like that is breaking out, I might just take one position and take a little bit bigger position in that, where I'm saying, look, if this can't work, nothing's probably going to work here. So I'm going to put, for lack of a better word, all of my chips, at least for my first little foray into the market, into this one stock. I wouldn't normally do that. I would normally see how many setups are there. But usually I'll try and buy one or two names. And I have found, and if you look at this again on Twitter from some of those past precedents, and I think I tweeted 6 or 7 going all the way back to 2010, every one of which I traded, where I used sort of those shaded areas to say this is where I was getting really aggressive. Most of them were, days to weeks after those accumulation days. But what got me to getting really aggressive was whatever I had bought in that interim period was working.
Right.
So normally, though, I would not get beyond 20 to certainly no more than 50% invested within a couple of days. But I have gone from full cash to fully long in the span of probably 2 days before. But that wasn't usually right off the follow through day. I might have bought, a name or two, and then all of a sudden there was just a lot of setups. So let's say I buy that 1 or 2 names and they're working, I am going to lean on those profits. And what I mean by that is I'm going to say, so if initially I'm going into the market with maybe I'm going to risk 1% of principal on buying 1 or 2 names, and they start to work, rather than going, hey, great, I'm up 1 to 2%, I'm going to risk all that to put on that much more exposure. And this is where progressive exposure comes in, where I will potentially move either stops up, either in my head or I don't usually generally have resting stops in the market in such a way to say, okay, now if I've got more setups and is there open profits I can lean on, I'm going to use that to pyramid up my exposure the same way where I talked before about pyramiding a single position. I'm looking to pyramid my whole account.
And I think that's a question that's often asked, like those initial positions where you make progress. You talked about just moving up your stops, but some people kind of wonder, should I sell those initial positions and then transfer that money? Or it sounds like you just kind of move out the stops and that's how you manage that risk.
I've done it both ways. So early on, I was less of a position trader. And what I mean by that is I was more of once I got to a multiple of my average loss, I just kicked the trades out. And there was a variety of reasons for that. One being, big believer in never underestimate small gains compounded over time. That's the easiest way to compound returns. However, as the account grew and liquidity became more of an issue, and I learned more about how to identify potentially bigger winning stocks or play them for bigger moves, I adopted, a few more tactics, same entry points, but just saying, hey, if I can sell a portion of the position, finance the remaining shares and try and play them for a bigger move. And what I noticed though, is my win rate actually over time actually went down, but my average gain went up to compensate for that. And my number of in and out trading also went down a little bit. Well, as your account grows, it's not necessarily required, but it's a lot more difficult, when you're managing millions and millions in terms of an account versus when you're managing a few 100,000. This is a point though I would make, and that Mark always makes, like, the little guy doesn't have a disadvantage. He has an advantage.
Right.
You have a huge advantage over the institutions. You can get liquid. And this is true even if you're managing, 50 million, 100, even a few 100 million. The liquidity advantage you have over larger institutions is enormous. You want to put that on your side. So you don't want to have to hold through these, big downturns. We flashed a sell signal back in November of last year, telling people, hey, you should be holding lots of cash. You don't have to hold like a lot of these institutions do. And some of them are literally mandated to hold. think about that. You have to hold into a declining market. That's exactly opposite of what the individual investor and trader should be doing. The reality is they don't have the skill set to know how to do it properly. And that's, it's something that really can be learned. The idea is, you want to know when to use cash. You don't just use cash. It's the idea of the knowledge of when to use it, and cash is a position.
Absolutely. And getting back to kind of coming out of a large correction where you're completely in cash, and say there's 20, 30 setups, stock setups are everywhere. How do you narrow your focus on just a select few? Is it completely kind of price and volume based characteristics, looking for VCPs, or do fundamentals also come into play? The story, the theme, the earnings growth, all of that. What's kind of most important to you into finding 5 of the best stocks setting up?
It's everything you just mentioned. Ideally, relative strength, and then and earnings and sales. Mm-hmm. So yes, I have, and again, back to the point about tracking trades. My biggest winners have come. Call it ironic or not. Mark talks about this in his first book. We also talk about this in Master Trader program. My biggest winners have come from some of the classic growth areas or growth groups. Mm-hmm. So I tend to favor those, not favor, just because I like one stock or the other, because my results have said this is where I've made the most money. A good example of a group I don't traditionally favor has been one of the few groups that's been working this year, until recently, were the cyclicals and commodity names. Right. My record in commodity stocks is not very good. Even when they set up, I know some people might say, well, commodities haven't had a really good bull market. Well, we've had a good bull market. I have traded some of them. I've made a tiny bit, but even this year's been a good example. Been a lot of work for a little reward, at least for me, where I would much rather prefer something like in the consumer retail group with high earnings and sales, because that just, historically speaking, and this isn't the last 10 years, this is studying the biggest winning stocks in history going back to 1900, the power and momentum behind those stocks, if they're timed right, is much better than, say, something that's a deep cyclical.
Absolutely. And we've talked a little bit about progressive exposure to the long side, but can you talk about, when we're a little bit long in the tooth in an uptrend and leaders start breaking down, how do you kind of use feedback in your statistics, your average gain, average win, average loss, in order to tell you to kind of size down and kind of naturally become pushed to more and more cash?
Well, the biggest thing is back to the trading loop, in terms of just feedback. Mm-hmm. If I'm getting bad feedback at any time, think of it this way, if the wind is pushing against me, and that is, I'm getting stopped on trades, or trades that were working are giving back more than I think they should, or starting to act abnormally, I am taking that as an immediate caution flag. Mm-hmm. And this is where, again, we used the example before, hey, you're coming from cash looking to get more aggressive. Well, the same thing comes if I'm fully invested, or even more so, say I'm really aggressive and on margin and feeling pressure, I am going to heed that pressure even quicker. Mm-hmm. I'm quicker to protect myself than I am to get aggressive on the long side, if you follow me. Yeah. And this is something I've definitely learned. Some of my biggest drawdowns have come from not heeding that quick enough, meaning the feedback the market is giving me is telling me that the winds are changing, and sometimes people sit there, they're trading at bigger size, they take 2, 3, 4, 5 stop outs in a row before they start reducing their size. That's not how I'm doing things. I'm looking to aggressively pull back just as fast. The other thing I would add, though, is that it's sort of the same principle when, if you're, like you were saying, hey, maybe you're in a good period and things are really working. Mm-hmm. If in terms of back to stocks, if there's very few setups and everything's now extended, hey, they're working, but they're extended. Right. That's telling me I either stocks then can be acting normal, but if I'm very long, they're going to put me under a bunch of pressure. And if that's more pressure than I want to take, I've only got one choice. That's to start reducing. Not because I, and this is the way professionals think, people, they fall in love with stocks. And I don't want to sell this one or that one. Well, I don't want to give back too much money. So you got to ask yourself a series of questions, meaning if all these stocks I'm long act normal, and that's going to and you just run some basic math, that's going to cause too big of a drawdown that I'm not comfortable with. You got to move, you either trim positions, move up stops, or both. And that's exactly, I usually do both.
Yeah. Perfect. And we talked a little bit about how 2021 was very, it really favored short-term trading almost, a few days. The breakouts, barely lasted. But also back in 2020, position traders and longer-term investors were really rewarded because there are long trends that really lasted above the 50-day moving average. How do you kind of stay in tune with, the tactics and themes that are really working in a certain market? And do you kind of alter your style to kind of reflect and kind of favor that tactic versus, just sticking with one thing and trying to force your will in the market almost instead of kind of listening to what's working?
Well, I would never try and, force my will on the market. That's for sure. But generally now, I'm more of a position trader than I am a shorter term trader. So if that's not working, you have to be willing to sacrifice one for the other. So right now is a good example. I'm trying to key in on where do I think the key leaders may be. I know I'm not going to catch every one, but I don't need to catch everyone. That's not my goal. My goal is, to make good risk-adjusted returns and to generate real alpha over time. So I'm sitting here going, okay, what are the stocks that I think are showing really good relative strength, good potential fundamentals in a market that's been very difficult? So if the pressure comes off the general market, those stocks will potentially soar even higher. And, that's now I will still potentially sell portions of those positions when they get extended to finance a larger hold. I'm not just going to plow in to the full on off, that trading's not an on off business. I'm going to try and smoothen my equity curve if or when possible. But I'm sort of a hybrid, where if I trade out of a scale of a position, it's so that I'm using that to finance that bigger hold between sort of your longer term, or maybe more of your classic can slim investor that's really just trying to catch that key leader and ride that baby all the way. And someone that's a much shorter term trader, I'm a little bit of a hybrid between the two.
Perfect. And getting into, tracking your trades, obviously your average gain, average loss, your batting average, those are kind of the most important metrics. But I was wondering if there's anything else that you really track that you find really valuable and traders you think should really keep track of it. And also if you kind of take notes along with that trade about kind of the market conditions at that time, what the kind of situation is. I'd love to hear more details about, what do you actually put in when you track your trades?
Sure. Well, what you said is obviously, really important. The other thing I would encourage people to do is average days held, for your wins and your losses. And then the other thing you can do is actually put in, either in the notes, or some people like to just have maybe have a name for the different setups. Because that either tells, one, it can tell a couple things. One, if there's sort of a technical theme in certain periods of the market where maybe you see, hey, there's a lot of handles forming, or handles are what's been working, versus, in other periods, maybe it's cheat areas or, those types of things. But you can also then see, do you actually trade certain setups better than others?
Right.
Some people, just are more comfortable with certain setups, and that's fine. Again, that's just a reflection of your personality.
Perfect. And at the time of a trade, do you kind of take a screenshot of the chart or print it out or anything for reference later? Or is that more when you go back and look at your trade, then you'll kind of pull up a chart, mark your buy and sell, and look to see if there's any improvements to be made?
You know, that's not something we do in terms of taking screenshots in real time, but that is definitely a good idea. And it's something we should do in terms of, and there's a good reason for this. One, it's an easy way to sort of build model books of your own trading.
Right.
We have started to go through after and create them for some of our bigger winning trades or trades that really look like textbook, so that you can really, again, create your own model book, of knowing what it is you want to see, knowing what you've done in the past, so that when you see it again in the future, you're ready. But what I was going to say is that there's nothing there's nothing more frustrating than going back through and looking at trades and the symbols don't exist anymore. Because what will happen is if you do this long enough, eventually some of these stocks, well, either the symbols change or
they get acquired.
They get acquired, they go out of business or whatever, and then you don't have, it's actually really tough to find delisted symbol stock charts. And so I started noticing like, oh, what happened to that? I used to have this great example, now it's gone. So it's nice to have those, and screenshots are a really simple way to do that. So no, that's something that we will be incorporating.
Perfect. And do you actually kind of print out the charts, physically mark them up, or do you keep everything digital and in your charting software?
In the past, I've just kept everything in Excel. And like I was saying, starting really, I want to say in 2019 or 2020, we started going back through and creating a model book where we sort of took some of our big winners and then we printed them off. So yes, to the point earlier, where if those stocks go away or don't exist anymore, similarly, if you look at some of O'Neill's old books or even some of Mark's trades in his books or in say the seminar manual, some of those stocks aren't around anymore, but you've got these picture perfect entry points, buys and sells that you'll always have.
Perfect. And I've asked you in previous interviews and presentations about this, but I think, going to the fact that process is so important, I'd love to hear you talk a little bit about kind of your weekend routine and also your daily routine afterwards that kind of sets you up for success, that keeps you in the know about, are stocks setting up, are stocks following through, or are we kind of seeing, movements to the downside as well? So first, kind of talking about your weekend routine, could you kind of talk through the steps you take and any, screens that you run and how do you basically find and determine whether stocks are setting up?
Sure. It's very simple. And I've pretty much been running the same screens since 2010. I've changed almost nothing. I run a basic relative strength screen, composite screen, and an IPO screen every day. And then I run over the weekends a few additional screens with some fundamentals. And you and I think have talked about this in the past. There's no magic about the screens. Depending on, what type of market we're in, it's usually between 500 and 1,000 stocks that you run through. And then it's just simply looking, for potential viable candidates. And then normally it's developing a series of watch lists. Mm-hmm. Mark uses the language sort of like in baseball, like ones that are on deck or high on deck, or, if you think of it in terms of names that are, close or really close. And, we've always just used, primary and secondary watch list. And that's all of our ideas. Anything I'm going to trade is going to come from those watch lists. So it's been on the watch list first. And then that's something, we go through every single day. And then Brandon and myself we run those screens every day. Again, a little more screening over the weekend. And then we compare notes in terms of our lists to make sure, second set of eyes, right? Like, did I miss anything? Did you miss anything? What are we seeing? And then that's what we're working off for, any given day. And what you find is that running through that routine, while it may feel arduous or boring, it gives you an amazing feel for what the market's doing.
Right.
People may find this skeptical, or again, like I talked about in the beginning in terms of process, but that really is the process. I mean, I'll look at general index charts in terms of, like, did we have accumulation distribution, but I'm not studying those. I'm studying, what is the market telling me? Think of this in terms of, I'm trying to stay agnostic and let the stocks pick me. If you do that, you're going to put yourself in a really powerful situation eventually. Might not be today, might not be tomorrow, but if you continue to run through that process, eventually you find yourself in these periods where you just go, oh my goodness, look at all these great ideas, or you find these themes where people love to have, I want to be long this group of stocks. For whatever reason, they come up with some fundamental narrative. Well, that's all great, but I'll get long that group of stocks when they set up and meet the criteria. And sometimes there are names I've never even heard of. Like, well, who are these guys? Oh, they're in this group, and but they're setting up. And then sure enough, you buy them, and the stock just takes off. While some other group that maybe you thought you wanted to own never ever sets up. So again, letting the market guide me rather than digging in and having some type of macro fundamental opinion on why some group or some stock should be working.
Perfect. And also, going along with your daily routine, what do you kind of do from the moment you wake up to, set yourself up for success? So you're focused, you're ready, you're confident, you've got all your alerts set. What do you kind of do to, prepare for the market open?
So for me, I actually usually I start work about an hour and a half before the open. In terms of, if you want, like, when I get out of bed, I usually get out of bed about an hour before that. I spend the first 30 to anywhere between 50 to 60 minutes in personal, like, quiet devotional time. Usually some type of, Christian scriptural reading and prayer, meditation, that kind of thing. I do exercise sometimes in the morning. Normally, though, I do that in the afternoon after the market closes. I'd rather work off any of the negative or positive, emotions from the trading day in terms of exercise later. But sometimes we'll in the morning as well. And then, we generally then start at, 7 a.m. Central, just going over what are our lists look like for the day. What's the battle plan, running any sizes, putting in any alarms, and those types of things.
Perfect. I've got some more questions here that people kind of submitted in advance. So the first one I think is a pretty interesting one. If you had to start all over right now and you had kind of $200 to spend on resources that would kind of inform you, what would you kind of spend and invest that money on?
I wouldn't do anything any differently. I often joke or say, that there was less, and I'm not that old, right? But there was less when I was getting started than there is now. That's for sure, because the amount of, of things on, just online in general, was far less. Now, I know there's a lot of things online that I think are probably not worth much, but, for me, even prior to, look, the way I found somebody like Mark was reading Market Wizards. I probably read some of those Market Wizards interviews 30, 40 times.
Yeah.
Those were the Bible as far as I was concerned, because these were people who had done what I wanted to do.
Right.
And, which is why even I didn't have much money. The first seminar I went to, I'd made, I don't know, 10 grand or something like that trading stocks the first half of 2010. And I think I used most of that and those profits to pay for a subscription to Intervening Private Access and then to come to the seminar. I mean, so I'm a big believer in, markets are going to charge tuition. And there's nothing wrong with knowledge is invaluable, meaning you can't put a price tag on, learning priceless truths about anything. By the way, this is the same way I've approached anything I was interested in. I was a student of philosophy, at university. You had to do nothing but read, write, and regurgitate whoever it was you were studying. If you want to be, good at anything, you're going to have to commit yourself. It was the same thing, even whether it's podcasts. I was in the MPA training room for a decade, every single week, asking questions. So when I'm amazed at the number of people who even sign up. There's a slide here on just the service and the value. And like I said before, I'm amazed at the number of people who don't even come to the weekly Q&A sessions. They pay for something and don't get the real value of the education. There's no shortage of amount of reinforcing good things. Reinforcing the good habits and these timeless principles. That's the real value. That's what's going to be around long after Mark's dead and gone. I'm dead and gone. There'll be other people preaching, teaching the same stuff. If you read what Livermore was talking about, 80 to 100 years ago in How to Trade Stocks or reminiscences, these same principles are there. And they're not going to go away.
Perfect. And looking at your performance, I think what really stands out to me and what's really clear is you're able to keep your yearly drawdown really low. Like you're able to come back you don't stray too far off all-time highs. So can you talk about kind of why that's important in terms of compounding account and building your capital over time?
Sure. And this is something, I've learned in the trenches, is that the more you can control your drawdowns, the closer you can stay to new equity highs or new all-time highs, the easier it is, both financially and emotionally.
Right.
This is why when things aren't working, listen, you're going to have drawdowns. There were, one or two of those periods even where, I could have done a much better job managing that downside, which is even why in the period I've been in now, I'm in a small drawdown now. And I often say to people, you want things to feel worse than they are.
Right.
And I don't know if we've talked about this before, Richard, but when it comes to emotional capital, I want to feel like I'm bleeding out emotionally before I am financially, where it's like, man, I just cannot get any traction. And you're down a couple percent. That's perfect. Because then when things turn around, you're going to be just like a good stock. A good stock is making new highs very quickly. It might pull back 3, 4, 5, 6 days, and then boom, 1 or 2 good days, it's pressing new highs.
Right.
Same principle, if that is how you want to manage your portfolio. Again, easy to talk about in theory, but in practice, it's something, that can be done. Just to be clear, the track record is it's audited and presentation for skill only. We're not advertising outside money management. We don't do any of that. That's mine and Brandon's proprietary internal track record. But the other thing I would say is, I think, while we've grown quite a bit, we've gotten better. It's a skill. This is a skill game. No one's born with it. I'm not saying it may not suit better people's personalities more so than others, but if you've got the passion and the drive, it can really be done. And this is one of the reasons why why am I doing this? I decided really about a year and a half ago that instead of trying to make the most money, and even managing a slug of outside capital, I think I'd rather try and pay it forward, if you will. And for those skeptics, why are you guys charging money, all that kind of stuff? It's like the best coaches in the world find their best students because they're the ones who are really dedicated, and that comes with a price tag. The best universities are no different. So that's what I would say. In terms of the drawdowns, though, it's just they're a part of the business, but the more you learn to control them, and even if you sort of want to look at this, our own numbers, it's like our drawdowns have gotten smaller while we've still had some big years. I mean, in the last 2 years, we've had really good upside with very minimal downside in the middle, and that's to me, that's the measure of trading skill. It's not even total. Anybody can have a big year, And lots of people had big years in 2020, and they gave them all back, and in some cases a lot more right now. Where if you can make a lot of money in the good times and find a way to mark time or give minimal amounts of it back, and that's really how you can make a life-changing amount of money.
Right. And talking a little bit about your equity curve, do you kind of analyze it similar to a stock in terms of, looking at the spots where you've got a spike in your equity curve or a dramatic pullback, and kind of think about what were you doing during that time? Do you kind of look at it that way in terms of post analysis and try to obviously do more of what caused the spikes and do less of what caused the drawdowns?
I don't get too
Granular.
well, I don't get that granular about it. And even when it comes to the numbers, like there are times and normally this is in the better months, in good periods. Sometimes I don't know how good they are. And I don't mean that like I know intuitively when things are working, but there've been times where when it's a good market, our heads are down and we're focused on the trading. I'm not even checking, I know guys that, they check their NAV every day. I don't generally do that. But then there are times where in a really good period, I'm checking like, holy smokes, look, we've had a better month than I thought, or, because you're playing the game, you know what I mean? Rather than obsessing over every point or every play or how, whatever, if you have a sports background, that kind of thing. Yeah. I think Mark describes it like in pool, you're just running racks. Yeah. You're in the zone, would be the way other people would put it. So yeah, I wouldn't get too obsessed with it, at least for me personally. The goal is, again, when things aren't working, I want to scale back as quickly as possible. The other benefit though, in terms of studying your results is knowing that, hey, if a good month for you is, double digit month, and you can keep your drawdowns, even your worst drawdowns to near double digits, you're only a month or 1 or 2 good months away from being right at new equity highs again. You can go a long period of time. And that's the question I have gotten is, well, how did you get through those periods? Well, you looked at the good periods. You said, well, my goodness, it's only going to take a little bit of time in a good period to make a substantial amount of money. But this plays into, people's emotions. That's hard to do. Some people want trading to be like a salary. Well, if that's what you want, you probably need to be more of a shorter term type trader, or you're just trying to grind out, maybe a certain amount of money every day or every week. There's nothing wrong with that. That's not my style. And there are plenty of people who can make a good living doing that. And I think you can use you definitely will use the same type of principles and even the same type of setups. You're going to have much tighter, much smaller losses and smaller average gains.
Perfect. And this is a little bit of a fluff question, but I'd be interested in your answer. What's your favorite trading quote and also why?
Well, I don't think that's fluff at all. I think that's a great question. Man.
I borrowed it from Alyssa Corum, so shout out to Ali Corum at IBD. So
I guess I would say well, it's a tie, maybe. Never underestimate small gains compounded over time. Would be one. I think that's from Gerald Loeb, but I heard it from Mark first, and I didn't fully understand it at first. The other would be probably from my dad. Pros take losses, everyone else loses.
Nice. Yeah, I think those are fantastic. And my last question for you, Mark, thank you so much for your time here, is what general advice you have for traders, during this time, during this corrective state? What kind of can you say to inspire them and make sure we're all ready for, the next batch of huge market leaders that are going to come out eventually of this bear market?
Well, back to the beginning, this is where you have a golden opportunity to really work on being insulated in your process. Yeah. Because if you're focused on, one, things have been terrible, or, this is garden variety bear market type action as far as I'm concerned. The difference has been maybe, some of the tails on some of these names, like in the NASDAQ, have been really bad. To me, that just gets me excited, because it just tells me that, the market is weeding out the undisciplined. And that should be music to your ears. But in the specific environment, let's say things get really bad economically, and or like I said before, maybe the headlines start to get really dire and all that type of thing. At some point, a bull market is going to be born, and you've got to be prepared. I don't know when. I'm the first one to admit that. That's the whole idea of having a process, but it is definitely going to be worth being ready for those who put in the work. So yeah, bull markets are born out of recessions. So don't be afraid. Ignore all the, everybody else who says, it's different this time. And, the only thing that's different this time is the fact is just the things that the reasons they're giving for why it's different this time. There will be another bull market, and it is going to allow a number of folks, probably a small group, to make a real meaningful difference in terms of their financial future.
Perfect. Well, Mark, thank you so much for taking the time and speaking with us today. I'm sure everybody watching is really enjoying it. Make sure you leave a like on the stream if you are. Mark, where else? Obviously, you mentioned minervini.com. Where else can people kind of ask you questions and connect with you? Also on Twitter as well, I'm sure you'd like to mention.
Sure. Obviously minervini.com. If you're interested in Minervini private access, fortraders.com for, the upcoming Master Trader program. That's going to be online. And then, I'm on Twitter at Mark Ritchie _ Roman numeral 2. And, look forward to hearing from anybody if they have any questions.
Perfect. So we'll leave it there. Thanks again for tuning in, and we'll be right back. Take care.
Thanks, Richard.
All right, welcome back, everybody. It's my pleasure to announce our next speaker, Anne-Marie Baiynd, who is a veteran trader and also the chief market strategist over at thetradingbook.com. Anne-Marie, thank you so much for your time and welcome.
It's my pleasure to be here. You know, folks, the great thing is that we have somebody like Richard and TraderLion, because 20 years ago when I started trading, there was nothing like this at all. We are living in the golden times of getting talent to come together and share. So I thank you for this opportunity, but also for everybody. We're really, really fortunate to have things like this. And so I'm going to hop right into things. I do I need to share this, or do we have it up there already?
Everything's already up and ready to go, it looks like.
Perfect. Okay, so if you don't know me, I've been around for almost 20 years, actively trading for about 18. I wrote a book that sold a lot of copies, and it's simply called The Trading Book. And you can find me on the Benzinga Pro platform. You can find me on the Money.net platform. You can find me on Twitter, StockTwits. And the big thing for me is trying to separate signal from noise, because there's a lot of information out there. And that information, we don't really know how to parse it. So I'm going to try and get us to a space where we can go, okay, quickly, I know what to look for in a trade. Important, hey, listen, this is education here that I'm sharing with you. I'm not a financial advisor. And so I do need to remind you that everything that we talk about is education. They're not recommendations to buy stock, and it involves risk of loss, and you can lose a lot. I should know I lost a lot of money before I started making it consistently. And so what I want to show you is one of the ways that I really find winners just using my eyeballs. And it helped me clean up a lot of what it is that I was looking at in the market space, because I hear a lot and we read a lot and we have no idea. Somebody saying the sky's falling and we're going to fall into massive depression. Somebody says we're going to make new highs next month. Everybody's talking about something that's important to their frame of reference. And so the big thing is, hey, can we have a visual approach? So what I want to show you is the first part. What we're going to really look at is number one, and that's the observe of this OODA loop. So the OODA loop is observe, orient, decide, and act. And it's used by all the US fighter pilots when they are in the cockpit and they are continually analyzing what they're seeing off of their horizon or through their visors. And so the number one thing that we sort of miss is this observe spot. And so we're really going to focus on observe today. And that's going to really help you as you move forward, taking a look at, okay, how do I orient? How do I decide? How do I act? Because there are so many fantastic instructors here that are really telling you, listen, here's how you can go about these things. And once you understand your framework, you can work with them individually and develop your skill overall as you move forward through understanding. And so the way we're going to do this is from the bottom up visual. And so we're going to use something called a heat map. And most of us know what a heat map is. It's something you see at the end of the day, and it's either very red, very green, or some sort of pale version. And a lot of times we look at it and we can go, oh, yeah, that was a risk off day, or oh, yeah, that was a risk on day. And we don't take anything away from that. Well, what I want to show you is how much you can take away from a visual strength heat map look. And I call it the bottom up visual event. And so what it does is send us through a number of spaces. So this was Friday. I just took this. Everything is very recent. And this gives us a day of performance. Now, a lot of times we look at these things and we go, yeah, all right. I can see that nobody was really up and nobody was really down. The most up was Tesla. And I'm not really sure if that's because folks knew that Elon was going to say, hey, listen, I'm withdrawing my bid for Twitter, which he did in the afternoon, or it could be whatever, right? But it's just one day that's a snapshot. So I need to see more than that. So I'm going to look at a week. And now notice this. We've got a lot of red over here, some very bright red down here in these edges, and everything's sort of pale in this space. But if we move to a week, we can see where big money has been moving, and it's been moving consistently day over day over day. And so when you compare a week to a day, you can go, oh yeah, that day was kind of muted, but I know overall everybody was buying consumer cyclicals, consumer communication services, technology, and they were still selling energy, right? Overall, the whole week. Down in basic materials, we start seeing a little bit of motion. But overall, from a week, we can see that money has flowed in to these spaces. And so you have to put that in your head and go, all right, I see where they're moving now, but what's it look like before that? And so now I'm going to look at a month. And what you'll notice is that a month ago, if we took the numbers to where we are today, in just a month, this is very red. Semiconductors, very red. Consumer defensive, very green overall in the big pieces, particularly discount stores, and then healthcare and manufacturing. So when you look at things like that and you go, what is that telling me? If you compare the month, the week, which looks very green in these spaces, and you look past, you know that in the last week, people have stopped selling consumer cyclical communication defenses, healthcare, technology, and financial. And just by looking at that, you can actually tell that the stock market has been running up. Just as simple as that. If you want to go how much it's been running up or what it's been actually doing, we go back and we look at something, say, 3 months ago. And we'll see here, if we look at a 3-month period, we can see that BABA, JD, and Pinduoduo were moving up. Well, what do we know about those guys? They're all Chinese. And so you can say, wait a second, people are buying up the Chinese stocks. And so you can look overall at these spaces and say, I can tell from a flow perspective what's going on with big money. So let's think about the takeaways that I've talked about here. And so the takeaways are this. Big money movement can be seen, and it can be seen more effectively over a week, a month, 3 months, 6 months. It can also be tracked. So you can look at something and go, okay, I'm going to circle this and I'm going to see if they buy it again next week, or if the whole group is getting bought. Once I can track that, I can say, all right, if I want the wind at my back and I want to go long, I'm going to go where I see the whole region is getting bought up, and then I'm going to look for strength. Or I'm going to go to the whole region where everything's getting sold, and I'm going to look for weakness. And so when you look at that, all of a sudden, any notes that you see, any streams that go, hey, this looks like a great stock, or this looks like a great stock, you can go right to that bottom up visual and go, you know what? That's an outlier. It's the only one running up. I don't have the wind at my back. And that wind at your back is what I call that Moneyball approach. And that is your on-base percentage for getting involved in that sector. If you find yourself in places where the wind is at your back, trend is going to be good to you. And if trend is going to be good to you, then half of the things that you need to think about from a risk perspective are totally gone. So let's take a look at this. This is all of them together. This is a 6-month one. This is 1 day, 7 days, 30 days, and 180 days. And again, here's what you see. 180 days, 6 months. So if you look from January to July, where we are right now, you'll still notice that energy is still an outperformer. And you'll still notice that technology is still an underperformer. And you'll still notice that even from last week, which we just finished, to 6 months ago, people are going into healthcare. So we've seen a lot of rotation back into cyclical. You can see it's really red here, and now it's green. So these things are lifting off of their bases. You can see that they're moving back into tech, but tech is still light on that space. And you can see that no matter what, everybody has still moved in to the healthcare space. What they're doing more of is biotech and that sort of thing. So now that we know this, take away the following for yourself. Again, for me, everything is about being simple. And simple can translate into a very deep level of knowledge about the market if you're just looking at the visuals and you're saying, wait, what does it mean if I go from green in my current week, whereas in the past, I've still looked at that red space. Now, what really it should tell you are things like, hey, I bet you if I look in healthcare, some of these guys are going to be making 52-week highs. Why? Because no, they haven't really dipped. It's been green through every single one of these. So you might think to yourself, well, do I really want to go someplace I've got 52-week highs? Maybe not. Maybe you want to buy a dip in energy if you don't believe that we are entering a very deep recession, or you think it's going to be a fade and then a bounce, or you feel really solid about tech and you want to move forward. So let's go to an actual chart. Let's do this, and let's go to a new share. Screen one. There we go. Oopsie. Let's move you and me out of here. All right. And so now this is the FinViz website. And what we are looking at here.
Hi, Anne-Marie. I'm still seeing the other visuals. So you might have to stop sharing.
Oops, sorry. There
no
we
worries.
go. How about that?
Yep. There we go.
Okay. Fantastic. All right. So this, we're looking at a week. And I have it on a full screen event so you can see it. But I am looking at the world. If you want to look at the S&P 500, it looks a little bit different. But you can still see, you can see a lot more charts from this perspective. But here's what this gives you. When you hover in a place like this, it'll give you the list of guys that are sitting in the box, right? So in the last week, we can see that everything's green from, say, NVIDIA and Texas Instruments and so on and so forth. So that might be a space where we go, hey, it was looking pretty bad. Now it's looking okay. And I can see that my chart is sort of flattening out. Maybe that's where I go if I'm looking for a long. So the first thing you want to think about when you're trading is the following. Do you want to go long or do you want to go short? And knowing which way you're slanted, is the market going to be a headwind or a tailwind? And that's really what your charts are going to start telling you. So what I really wanted to do is jump specifically into, I'm going to leave it on full because we can see a lot more choices. And we're going to look at some things like healthcare and biotech. Why? One, I think it's probably a safe bet for upward rotation because the chart is actually looking fairly good from a SPY perspective. So let's go here and let's first see, let's take a look at SPY. And so let's go through our checklist. Remember, you just go to your spaces and you say 1 day, 7 day, 30 days, and you see what the rotation looks like. Then you go, all right, do I want to be long? Do I want to be short? If you want to be short, go to one of those boxes that's mostly red and then start digging into those spaces. And you can use a lot of different techniques here. I'm going to use, Brian and I happen to use the same 5 simple moving average that is guilty until proven innocent, as it were. And we're going to look at the weekly chart in SPY, and we're going to see that we're just coming up over that crest of motion, but we could be a little bit landlocked. So why am I going to SPY? Well, I'm going to SPY to see if I have a headwind or a tailwind, depending on whether I'm long or short. And so that's really what I want to do here. And what I see from a weekly perspective is I'm a little bit sideways. So the strength of a stock is going to matter more if my chart is sideways. So if you're looking for something to go long, looking for something to go short, make sure you've got a steeper trend that's in your favor because the broad market is going to be a little bit sideways. However, if I go to a daily chart, does it work better if I'm in a light scale or a dark scale? What do we think about this? Yay, nay?
I think either works. I think whatever you prefer is good.
All right. So if we look at the daily chart, what we can see, and this is super important, folks, how do you know when you're picking a bottoming area that potentially will hold? You stop making new lows. And so this is what the SPY is doing. Since June 17th, we've stopped making lows. And so looking at that, you can take away from this space to say, hey, listen, I know that I'm not heading lower here, but I'm also not heading higher. So again, when we see the SPY not in a real upward rotation or not in a real downward rotation, we can say, all right, I need to look for strength in a formation. So let's take a look at a few of these that I've isolated from this chart formation. The first one I've isolated is C4 Therapeutics, and that's biotech, right? And here is something wonderful about this particular chart. Now, Joe Fahmy is going to be on after me, which he's amazing, just a tremendous wealth of knowledge. He and I have been both looking at this biotech and healthcare space for motion, and C4 also got noted on the IBD list. And so this could be very nice. So what is it? It's above the 5 simple moving average. That's my ribbon right here. I have a 5-9, and so the ribbon tells me what's going on before it turns green. And so I see that I'm at the top of resistance, but I also have a floor that's at about 752. Now, because here's my philosophy. My philosophy is if I have a downward sloping moving average and price rockets through it, who I really am bumping into are all the sellers that got, all the buyers, excuse me, that got trapped right around this $10 region where they said, nope, this is the buy zone. This is going to be awesome. 10's a nice round number. And they bought it and it continued to fade. Now, the wonderful thing about this is that it's been holding these ledges since about March. And so this is a nice early stage break that could really take us from 9 first all the way up to 21. How long that would take, I don't know, might be a while, but it's a lovely space that all the things are conspiring towards a very nice trade event. How would I trade this? I never like to buy the tops. I always want to look for where was the last time resistance was tested at support. And that is somewhere near 785 to 8. And so I'm going to create an alert on this line. And I'm going to give it a loose bit of I'm going to give it a loose bit, call it a support zone. And then I'm going to create. And that's going to send me an alert and let me know. No matter what platform you use, create alerts and realize that just because you want to jump in and trade today doesn't mean that the chart is ready for you to make the choice of putting your money at risk. The reason that I'm here after 20 years is that after the first year and a half, 2 years, I learned about risk. The first few years, I was absolutely an abomination to any kind of trader ever. I made terrible mistakes, and I was also extremely impatient. And really, if we want to trade in the market space, impatience is one of the things we deal with all the time. Listen, I still deal with it today when I'm looking for a price and I'm saying, I know it's going to come in there today. All right, I'm going to have to put an alert and wait. And so that allows me to keep more of my money out of harm's way. And if there's one thing that I could share with you about actual trading mechanics, it's that. And it's specifically when you put a stop, you have to look for a stop that says, if it comes into this area, then what I thought about this means that I'm potentially very wrong. So if this comes in to my 8 and it does not bounce above it, so I'm going to watch it, it's going to bounce, and I'm going to wait until the next candle closes, and I'm going to say, all right, what's it doing? Your thought might be, but Anne-Marie, it could move 3, 4, 5%. Yes, but we are looking for something that's about 100% return here over time based on this chart and its relative strength and how long it's been basing. And so give it a little room. If you don't catch it at the very bottom, it's okay, right? Let the chart stay guilty until proven innocent, as we steal from Baiynd. So that space would be, hey, listen, I know I'm crashing into sellers, and those sellers came in right at around that 10 zone, and so I'm going to have to watch it there. I expect it to fade. I want it to come in, and then you can begin with a position to the north. I really like this one because it's sitting on a base. Now, let's take a look at a short, okay? One of the biggest things that a lot of macro guys are talking about is what copper is doing right now. And so copper is in a free fall, and it's in a free fall because we anticipate that the rising dollar is going to put a tremendous squeeze on emerging markets and other markets, as well as dampening all the things that have to do with demand. So demand destruction is showing up inside of the copper charts. And Freeport-McMoRan, or however McMoRan says their name, Freeport, they have been in a very downward trend, and they had a doji event just at the end of this week. So what does that doji event sort of tell us? Remember, a doji is something that sort of spins in an axis that has a high and a low, but everybody converges on the same price overall. And so what a doji really means to me is indecision. And so if I were looking for a short, which I am looking for a short here in this copper space, I'm really much more keen on waiting for it to bounce into an old resistance area before I engage in the short trade. See, if I get it here and I'm at a swivel point where I'm going to run back up into my moving average, notice my ribbon here, right? It's downward sloping. I turn around, I run for 3 weeks up into this ribbon, and then it rotates right over. I would not be surprised to see the chart do the very same thing. So what are we looking for on Monday? Now, on Monday, if all goes as it should, I actually expect a bounce event in the chart. So what would my support ledge be? Well, for me, I'm going to look just below that line. That number is $27.71. If it happens to gap up, which it could, I don't think it will, but if it does, you want to look for that gap to actually hold this line in the sand, and that's 29.20. If it holds 29.20, 27.70 will be your stop, and you can actually trade it long up through the edges of these weekly candlesticks, with your first target being 30.97 and your second target being 32.34, right? So how do we remember that we've got an alert set here? I would move this fringe up just a wee bit into the close. And when I create alert, I'm going to give it a wider sensitivity event, right? And so I'm going to say, hey, if it comes down anywhere near here, let me know. I'm going to put it up on my screen, and then I'm going to be able to buy it. Notice it does not change the stop of 27.70. If it loses the open of the prior week, we've got trouble. It could go all the way back down to 26. Now, if you're saying, Anne-Marie, come on, it's $1. What is that? 4%. I can live with that. If you can live with that, that's okay. For you, you have to think about how long am I going to carry this? Probably only 1 to 2 weeks, because it's going to rotate down. And it could stop at any one of these things, 31, 32, and then rotate down, because you're trading counter trend. If you take a long at a base like this, you will have the market as a headwind, and that headwind could cause a little bit of difficulty for a nice run to the upside. All right, so that's for downward motion. Now, let's say that you actually believe that oil has been running too hot and it's due for a pullback, all right? And it's going to be a pullback over time. Now, again, this is sitting underneath my 5 simple moving average on the weekly. This is how I do it for everything. I started trading the market short on all my cycles for trending formation if I close the week under my 5 weekly. That's it for me. If it's above it, great, and trending, even better. I can buy the pullbacks. When I'm underneath that 5 on a weekly, I'm looking for shorts. I am not looking for long opportunities within that chart, because I know that within that chart, that is a headwind. Now, on the flip side, since the market has been running up for the last week, notice what happened to the Exxon chart. It came down into a deeper support area, lower than that 81, so it came into 80.90, and then it recovered. Oh, I want to share this with you. Listen, just because price breaks a level to the north or south doesn't mean that support level has been invalidated. Someone with no knowledge of market mechanics can come in and force price lower. There's a really great story about, I don't know who it is, some super famous trader that had a newbie that came to work for him because they were technical analysts, and they said, no, that's not going any lower. And the guy picked up the phone and said, sell 10,000 at 2 pennies below this number, and it went lower. So the thought process is that, sorry folks, the thought process is, hey, listen, I've got price action. It could go lower, but it could also recover off of those lows. So please redo that in your mind. If you go, oh no, it's broken resistance, that means it's going higher. Not even. Not even. Take a look at how many times, if you had said to yourself, hey, as soon as it breaks 92, I'm going back long. That's obviously resistance. Everybody here upside down in the trade. Everybody here upside down in the trade. Let the chart tell you what it does after it tests that level. Then you'll know what's going on. So what do we anticipate? This is 2 weeks of doji style action. These guys are flush with cash, but they are pulling back because of a demand destruction story that really is coming into the price of oil. If you trade the futures and you look at the oil markets right now, they are in something called backwardation. If I go into January's contracts, they're charging me $82. Of course, I have to pay the premium for the 104 that it closed at on Friday, but that forward contract is telling me the price is coming in. And so it's going to bring the oil complex with it. What do? You wait for the bounce, like another big wick. It's already under the 5. The 5 is downward sloping. And so you're going to look for something right around the area of 90 or so to get yourself something that looks like a short, right? So again, relative sensitivity. If it goes off, don't immediately go, I'm going to short, but you want to end up looking at, hey, what's my 4-hour chart say? What's the daily chart say? Or simply let it close the day when the alert goes off. And if it opens up lower the next day, you've got your short. And you can pull right back down into this 82 area. It's going to be a very pretty trade. And there are going to be a lot of people caught on the wrong side of this because we all know that in the end, oil's going to go back up. It's just not going back up now. It's going back up later. And so let's just follow the candlestick prices to tell us what's going on. All right, here is another one that is a kind of an easy long. Occidental Petroleum. Now, why am I saying, hey, listen, this might be an easy long, even though it's in the oil complex? Well, Warren Buffett is buying this hand over fist. Absolutely hand over fist. So we know that it's in a depressed area that is oil and the like right now in the short term. So do we rush right in and buy it? No. What we want to do is wait for this chart to come in on the floor, because what it's going to do is outperform. Notice, you see what Exxon's chart looks like? See this 1, 2, 3, 4 downward weeks, and Occidental's chart? It's got 4 weeks down, just like Exxon had, but the last 2 weeks have been up solidly. Are we above the 5? No. So what that means is it's got to make a floor and let the chart settle out. So where I would like, this would be my floor, 54.40. That would be my support ledge. If it loses that ledge, I'll have to look at all my longs and say, I probably should get out of here. Of course, I've been buying Occidental since it's had all kinds of trouble. So I've been in this one for a long time. And these are really great prices, but they could come in a little bit. And so if it hits this floor, I would put an alert on. But if it holds this region, confirmation candle, we'll leave it on the daily. If it holds this region and comes into this when everything else is failing and doesn't go through, going to be ideal for it to move $10. I mean, legitimately, there's going to be some very nice price action sitting in Occidental, right? Is it going to move $10 in one day? No. But it could move that way in 2 months. And so very important chart to have a look at because it's got more strength than everyone else, and energy in itself will continue to rise over time. So this is something that I have, of course, as an investment. It could be something that you could consider from that space. Hey, listen, I'm just going to buy the dips when it gets really high. I'll take some of it off. And so you're always trading around a position. All right. Here's the last one, and it's a short, and it probably is going to give a couple of people some heartache. And it's Sherwin-Williams. So let me give you the reason for why. One, the ISM numbers. And so let me show you what an ISM is. Oopsie. Search, economy. That's the PMI. Sorry. Sewer price CPI. We're getting some of those next week. Where in the world is my? There we go. All right. So what does this mean, right? Notice this thing has been falling since March. Okay. Now it's at 57. Everybody's saying, hey, listen, if it gets to 50, it's going to be really, really bad. This was 2020 savage deep motion. This 2018 area is where we had a little bit of debt trouble also. That's how we can always tell when we've got trouble. We'll see things happening in the debt markets. And because Powell continues to raise rates, he said, hey, listen, we're going to go another 75 basis points. It's going to continue to bring manufacturing in. And so this downward slope says we're going to have a little demand destruction. You can see that by the copper chart that I showed you. But how is the ISM built? It's built on the housing and the energy spaces and all the things that come into housing from manufacturing of goods. And so if interest rates go up, the first thing that gets hit are mortgages. When those mortgages get hit, less people buy homes. And when you buy less homes, you buy less stuff for homes. And that sort of rolls everything into all the things used for homes. One of the most solidly performing charts over a very long haul has been Sherwin-Williams. But what we're looking at now is a cyclical decline that I think also is going to be a downward spiral for Sherwin-Williams. And so right now we can see, just like the broad market, it's been lifting, but it's sitting underneath that 5. So where might it go? And so, oh, I thought that was my line. It is my line. So what we want to do is actually wait for this chart to try to bounce with the rest of the broad market in broad enthusiasm, because it's got quite a bit of institutional ownership. And so you might say, Anne-Marie, this is the worst idea you've ever had of a short. It's got tons of institutional ownership. Why would you want to do that? Well, I don't necessarily want to short right now, but what I do want to watch is the collapse of price and the collapse of interest once the price action gets back up into this 275 area. So you might say, how about I just trade it long into there? You can, but it's under this 5, and anytime it bounces off of that 5 area, it's going to find resistance and come back down. So these are a few things. They're all actionable for Monday morning when you get in there. One of the big things that you want to take away out as part of study is step away from trading what you think and let the market tell you through price what everybody is doing. And can I tell you, that's one of the hardest things to do ever. It's incredibly difficult to do, but I promise you, if you do that and you follow the price signals and you read and you understand what's happening inside of price action in the grand scheme, you're going to end up being totally in love with trading like I am, but also very in tune with what's in your portfolio. All right, that's all I have. Don't know if you'd like to ask some questions or if
Yeah,
anything.
we've got plenty.
Yeah.
And while I'm asking these first few questions, if anybody in the audience has any, leave them down below in the chat. First of all, I want to ask you, once you've identified some of these spots on the weekly, could you give an example about how you might actually execute the trade, looking at the daily chart, looking at the 4-hour chart that you mentioned, managing risk and all that, and doing the specific entry?
Wow. Okay, great. Let's do the one I believe that is most actionable. And we'll talk about what we're going to do on Monday. So, nice, solid movement up for 3 weeks. I still believe I have downside pressure here. So I'm going to go to the 4-hour chart. And I love the VWAP. I don't anchor it because there's a skill to anchoring and I don't have that skill. So I just use the regular VWAP and I use some ribbons. And so what I notice for my ribbons is that I'm sitting on the top edge of these secondary ribbons, but my VWAP is flat. And so I know this is my support zone. I'm going to have an alert set here for when it breaks through on the 4-hour formation. And what I'm going to be doing is waiting for this chart to rotate in. So I'm going to have it on my watch list for Monday. 2 things can happen. I can break out above 10. I'm going to go back to the daily. I can break out above 10, or I can gap down right into this noisy patch here where everything's just run. And so I could have here. Okay, now I looked at the option chains for this and they're very thin, or I would do something about that. So 2 choices we have when getting into a trade like this. I know my floor is down here. This is going to be, oh my goodness, the apple of my eye trade. If it comes down and hits the level, I'm going to wait for it and go, boom, I'm in. If, however, I come in and I don't dip, meaning, let's say I break out through 10, I'm never going to chase a breakout when my formation looks like this. Truth be told, it can leave you behind sometimes, but mostly not. Take a look at the last time. Watch this. How to know charts do the same thing over and over again. I might say to myself, back in the past, hey, I believe in this. Look at how many weeks this thing has moved sideways like this. And these guys report in just a couple of days. So how nice that looks. As soon as it pops up over here, I'm buying the breakout. That would have been the absolute worst thing for me. So what you want to do is pay attention to how the participants behave in a stock. And what I notice from here is that if I break out, I'm going to come back in. And so I'm definitely not, if it pops up and it pops up to 14, I am not getting in this stock until it fades, unless I'm buying 10 shares. And then, whatever. But I'm not going to expose myself to any kind of risk. So that's what I would do. And I would set it up right there. I would say, hey, I'm going to put an alert here at my 889. If it comes in, chops around, I'm going to go long stock. I don't like the option chains. They're too expensive and they're too thin. And I'm going to leave a little bit back that says, all right, let's say it does dip and you actually get your sweet spot. Do you want to have dry powder to pick up there? So if it comes in here, I'll go half size and I'll go in full size if it comes in here and bounces. And my stop is going to be right underneath that edge where all of my premises about the price action holding will evaporate if it loses that zone.
Perfect. And kind of flipping the script a little bit, I'd love to ask you about your kind of weekend and daily routines that, inform you about, the health and strength of the overall market, as well as how you actually go about finding these type of ideas.
Okay, great. Again, it's just like I showed you in the very beginning. That's the first thing that I'll do.
Mm-hmm.
Now, I'm a little bit wonky for a technical trader because I love the macro story. And I think people trade macro and forget that it moves at a glacial pace. And so I'm always looking at the macro. And then I'm saying, okay, these macro guys are saying this, but price is actually doing that. And so at the end of the day, I will listen to what somebody's saying, but then I'll go back to the charts and I'll say, do I have evidence of that?
Right.
If the answer is yes, I'll do a deeper dive. And then I'll start looking at, okay, who's got the most strength, whether I'm looking for an investment or a trade. If I'm looking for an investment, I'm always going to look for heavy institutional ownership because I know they're not going to pitch things out. So I'm always going to be looking for heavy institutional ownership. And then on top of that, I'm going to be looking for price reliability. How does it gap? Because what I don't want to do is wake up on a Monday after having a restful weekend and be in panic zone because something I'm really keen on is dropping, 10%. And I'm looking at something very nasty on the day. So I'm not the one that would chase memes. I'm not the one that would chase high flyers. Those sorts of things maybe break out in hives. And so I'm just a little bit more timid on that sort of thing. However, if you're into that, then you look at the Russell. RTY is the futures complex. You look at the Russell in the same way. You do a deep dive, you look at them, you see who's the most red, see who's the most green, and then you just pick one and you can ride the wave because all of these mechanics are set up to help us identify the speed and quality of order flow, right? And that's really all we care about because we're momentum traders. We want to buy low and sell high, or sell high to open and buy low to close. And that's the way that does that. So that's really what I do. I look at pictures because I want it simple. I'll read the dense stuff, but I always have to come back to, does it make sense to me to do this? And if it makes sense to me to do it, what is the time frame I'm looking at? Am I looking at to hold it for 3 days, 3 weeks, or 3 months?
Perfect. And being a trading coach, I'd love to ask you, what are the common mistakes that you see kind of beginner traders out there make over and over again? And what would you kind of recommend for anybody just kind of starting out over the past few months or even their year, 2 years into this?
The big thing that I notice is that there are a lot of us that think we want to learn, but what we really want to do is have someone validate what we already think. And that makes for very, very difficult coaching events. The second thing that folks do is that they build narratives about fear and don't really build systems that are robust enough that can survive an expected outcome event. For instance, they come to the trading space and I go, hey, you want to do this, 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 and this? And they'll go, okay, I want to do step 1 and step 4, but I don't want to wait on XYZ. And so folks really have problems putting themselves into consistent routines because there's nobody over their head going, hey, I'm going to make you justify the reason that you, like on a prop floor or on a trading desk, you've got a manager coming behind you going every week. He's like, what'd you make that trade for? Why'd you do that? And so you have to learn to defend that state and then realize that if you keep doing it wrong, you're going to lose your job. And that doesn't happen in the trading space. So that personal accountability is a big thing. And then the very last thing that I see traders do is that they start with a system that's not particularly robust. And when it doesn't work, they jump ship to other systems. I can assure you that the majority of folks that are listening that aren't brand new already have all the skills you need to excel, but you're fighting your own mental battles by second guessing and then moving from system to system. Because the simplest thing as, hey, I'm going to use a 5-9 moving average cross just so long as, I'm above my weekly floor on XYZ.
Right.
And you can make money time after time after time, but people want to be too active and want to move too quickly instead of just setting with something and going, how can I fix all the things in between sitting in the 5? They blame the system and then they go around looking for other systems because nobody wants to look in the mirror and go, yeah, you really ought to work on that personally. That's hard.
Yeah, perfect. And a quick follow-up to that, what kind of resources such as books, videos, what have you, would you recommend people use when they're first starting out? What was most impactful for you personally?
I'm going to tell you what's the most impactful thing of late, and that's Jared Tindler, who sits on TraderLion and has coaching a program there. I read his book over the July 4th weekend, and I'm literally, people are like, yeah, you're going to make them. I'm like, no, I can't. I'm busy. And his approach is so unique and straightforward that I found it one of the best things ever. Because, when I looked at me, I was very good technically. I just had a lot of things going on in my brain, right? So Denise's market mind games was a game changer for me. She really she's someone that I've consistently gone to over time and said, hey, what about this? What about this? What about this? Because she came from a floor, right? She knows that space, and she also is very wise about why we make the decisions we do. And I really had a lot of technical skill. I was just a train wreck in here, and I had to fix that sort of stuff. And it took a long road, but it's been a beautiful thing. It's been the best thing that's ever happened to me as a human being, is learning what things short circuit me that stop me from being a good trader, a good wife, a good friend, a good mother. All of those things end up being the exact same thing in the trading space, which is fascinating. It's alchemy.
Yeah. And I dropped the link to the masterclass if anybody's interested who's watching. Jared Tendler, I've learned an immense amount from him. I think he'll be speaking day 3, which I'm really looking forward to. And Anne-Marie, I wouldn't, if you don't mind, I'd love to hear a little bit more about those struggles that you were dealing with and how you overcame them as well, because I think I'm sure that would be helpful for everybody watching. Everybody goes through the same type of stuff, so yeah.
Okay, so one of the biggest things was I couldn't stop the internal dialogue of saying, you're an idiot. Why didn't you see that? And so from a trading perspective, it's so different to to being in life, right? So in life, we go, hey, listen, you make a decision, you stick to it,
Yeah.
right? And actually, that's what's helped me in the trading space because I've stuck with it for 20 years because I wasn't going to give up. But when I'm in the trade and something goes wrong, I always would think, well, I just got to stick it out. And then it would turn into this gigantic losing space. And I would go, I can't take a loss now. I mean, that's going to wipe out 30% of my balance. I can't do it. And so when I do it, it's like a it's a hatchet to the chest. It's gaping flesh wound. And so not only do I have physical capital destruction, I had emotional capital destruction. So the first thing I had to do was pump the brakes and go, wait, do I have a system that works over an expected outcome?
Mhm.
Yes, sometimes you lose, it happens. But if you do it over and over again, the probability and expectations run XYZ. And so I had built some beautiful systems. They were running 75, 85%. The problem is I was leaving myself zero room for being wrong.
Mhm.
And that is a gigantic fallacy. We have this idea that no matter how, if we work hard and hard and hard and really, really study, then our trade's going to go right when we take it. It's not. It's still not, because we have error, we have noise, we have our inability to capture everything in the landscape and take everything like it's supposed to be. We could just be flat out wrong, or the market could do something wacky. We can lose. And so the question I said to myself was, all right, do you accept that perfection is impossible? Yes, I understood it in words. I still had trouble understanding it in real live mechanics. And then I started with a pocket of cash on the side, and I would say, okay, you're going to trade like you're supposed to trade, but if you run into this much cash that you've lost, you're going to stop and you're going to go back through each of those trades and you're going to go, did you follow your rules every single time? Because you can't judge yourself on whether the trade is good or bad based on whether it wins or loses. It's a good trade if you followed rules that were good. And once I got to that space, I said, all right, now how do I do it so I don't get ahead of myself? And I started trading really small.
Mhm.
And I said, all right, I want to go from X to Y. Sometimes it would only be $100, but the mechanic was what I was replicating.
Mhm.
And here's the funny thing the market does to you. So you get the mechanic right, doing it over and over again. It's great. You see something and your brain goes, you know what? I have just hit it out of the park the last 6 times. I'm going to size up and I am going to give myself a big pat on the back because I want to make X today.
Right.
And I would outsize myself, over leverage. And when it started going against me, that prefrontal cortex shuts down and it's fight, flight, or freeze. And that's all you've got. And so that, for me, I mean, I would get really good, consistent. I take a big trade, I'll lose everything I'd made in the last 3, 4, 5 weeks, and I'd have to start over. Until I realized that I had to stop looking for that badge of honor so that I could go, hey, look at what I just did, which really is what it was all about.
Yeah.
It was about, so I could feel it and I could tell my husband and I could tell XYZ. And as soon as I realized, hey, listen, you're working with a battle of ego and it's winning and you're putting yourself further and further behind, you just got to stop it. And so really those were the stair steps. And even today now, Richard, I still struggle with it. I will still go, you know what? I'm going to size up. Now, what I'm smart about is realizing if it doesn't have the heat, I can get out quickly and then reset.
Right.
Whereas before, I would just wait and go, oh no, well, it's got to, and I'll cut it off at the knees. So that really, it sounds like a simple process, but it was very hard mentally because I had to turn it into new habits.
Yeah.
The habit of getting my ego out of the way, the habit of understanding I'm never always going to be right, the habit of the market is always going to be right, and you can be early/wrong, or you can be late/wrong.
Right.
So just roll with that and be comfortable with getting those small gains of consistency. It's like a guy that does a tightrope walk, right? He doesn't start it between two buildings. He starts it 2 feet from the ground. And so that's where we have to build continuity and that structural space that allows you to embrace all of your emotions and go, okay, I feel concern because, I feel fear because, and you're not short circuiting your brain because of the size of your position.
Yeah, I think that's something that a lot of people can relate to watching, and I think it's something every trader kind of experiences to an extent. So thank you so much for sharing that, Anne-Marie. And there was a question earlier about whether you could kind of define your style and also your time frame, because I think that kind of puts everything in perspective and is helpful for everybody watching this.
Great. Okay, so my time frames run the gamut because I am a futures day trader and I'm also an options day trader, and I have an investment leg. Now, from an investment perspective, I have really pulled a lot into a cash space. So I'm about 70% cash right now. Will I be missing out on some very nice moves? Sure, but I'm going to go in and come out because I do have a feeling we're going to have some sort of seismic event. I don't know what it is. And so from an investment perspective, I'm really pulled back. I have a lot of cash, liquid events, and I intend, when the Fed raises rates, I intend to buy some more CDs because I want my cash to do something, even though it's negative return overall. That's where I'm putting it because I have the sense that I feel I need to be safer. There's too much macro stuff going on that I want to care about. So everything that I make, and I trade to eat, everything I make is on these very short cycles right now. And so if I'm looking at, for instance, one of my favorites is RRC, that's Range Resources. It's starting to move very sideways, which I don't like, but they're very, very well run. For me, I'll be waiting for this chart to come back into a support zone, and then I'm either going to sell some puts because I don't mind owning the stock, or I'm just going to buy the stock outright, and I'm going to trade it using my 4-hour cycles to get itself to the top of the band again. And so my investments, I'm still waiting to deploy big chunks of money when I think there's going to be a much deeper fade. But right now, I think we're in a counter trend, short-term swing to the north for a lot of different places. And so I want to capitalize on that using my day and 4 hours. As far as the levels go, I will not take a trade at a level that I can't see on a weekly chart. That's my big line in the sand, no ifs, ands, or buts. If I don't see people holding a line definitively on a weekly space, I'm not going to touch it. And I'm going to get involved when they pull back into that area and they've bounced every time, or they've pulled back into that, they're pushed up into that area and they fade. So that's what I will do.
Yeah. So it sounds like those higher time frame levels, those are the most important thing for you. Yeah.
Even for intraday trading.
Right.
Even for intraday trading, I'm looking at those weekly levels.
Perfect.
Because that's where big money will participate, and I always want the wind at my back.
Perfect. And a follow up to that, I was wondering if you could kind of talk about, how much of your process is fundamental based versus technicals, because even though we're talking a lot of price action today, it seems like you weigh pretty heavily on what, the Fed is doing, other macro events. So I'd love to hear you talk about that as well.
So my thoughts are always economists and folks like the Federal Reserve and guys that do all that kind of stuff. They make their money by telling us what they believe economic theory should look like in the future. So what I will do is I, again, will listen because I want to know how they're coming to their ideas. But after I come to their ideas, I go to the charts and go, what's actually happening? So for instance, one macro guy that's in the news, he's done a great job. Listen, I've bought a number of his books, but he's done a great job at talking about the landscape because he wrote a book several years ago that said, hey, listen, Russia is going to invade Ukraine, only a matter of time. So, his name fell right out of my head. Peter Zeihan. So his newest book was coming out same time. And so he's talking about global famine and what's really going to happen in terms of the big picture. But his time horizon is 10, 15, 20 years. People just aren't seeing that. And so he's hitting these headlines talking about, listen, there's going to be trouble with food. Well, right now, the Danes, you see what's happening in the EU. All those Danish farmers have stood up and said, yeah, no, you're not even letting us allow. Wait, you care about 1 million people dying, no fertilizer, but if we don't produce food, 100 million people could die. What? So they're moving up, doing all that stuff. And so for Peter Zeihan, that sort of dovetails into his storyboard of there's going to be a problem. Except if you look at the commodity space, soft commodities in the last month have just had a nosedive. They're falling to the floorboards. And it could easily be because they were bought up too far too fast. But I'm not going to run in and buy the commodity space when all the big money is selling it off. I'm going to wait for the chart to stop heading lower on a weekly basis and then watch for traction to build. So I always want to hear what they're saying because everything takes so long from a macro space. I mean, listen, the housing crisis that we had in 2006, 2007, 2008 was started in 1986 with Ben Bernanke. And so that's a long time. And so I'm listening and I'm taking it with a grain of salt. I'm learning about macro events. And then I'm saying, all right, I hear you. I understand you're promoting a book, but what is the market telling me? And that's what I always go back to. Where is price? Where is price? And many times as traders, we get so caught up in a political narrative or an environmental narrative or something that gets us right in our solar plexus. And we go, no, this is it. When you trade like that, you're ignoring the most important triggers that you will need. And the most important trigger you'll need is price. And that's very hard for people to go, well, like some guy came in and went, hey, I don't even know what oil's behaving in a very unusual, terrible way. And if you were watching the oil complex and you read about the ISM and you saw what was happening across the pond, you could say, no, wait a second. China's totally shut down. Half of Europe is still essentially shut down. That's a demand destruction event. And if you go look at the WTI futures contracts, they're in the 80s. So you can't go, what's happening to oil? That's because you're not paying attention to the backdrop. But interestingly enough, if you just stare at the price and it breaks that 5 simple moving average on the weekly, you got to go, I got to pump the brakes here if I'm thinking about going long. It's the simple things that we stick to that are going to keep us in the best of spaces, and the wind will always be at our back. But it's hard to parse all of that out and then to take it in and then have to put it to the side. That takes practice, right? Because it's very hard to hold two conflicting ideas in your mind at the same time. You just have to say which one is closer to being true, nearer in time than farther off. And the way you can always tell that is what price is doing every time.
Perfect. I think that's a great answer. As Brian Shannon says, only price pays at the end of the day. So, yep.
It is. It is.
And there's a question from Steve Ferreira about, do you tend to use hard stops or mental stops when you're executing your trades?
Never hard stops. Never hard stops. Now, what I am is a very disciplined trader. Hard stops will work for the trader who is not disciplined, or the trader who has very accurately defined a chart that says, listen, my thesis is totally broken if it loses this level. You cannot use stops that are, hey, I'm just going to put a 2% stop. The market doesn't care whether you think a 2% stopper is good or not, right? You could have an average daily range of 7%, and if you're trading in there with a 2% stop, you're toast. Just go ahead, take your money out, and burn it in a pile. It's just gone. So you have to look at that and go, wait, if I'm right, it won't fall through this level. It could test it, but it will recover. And so that's why I always use that stop in that particular space. Now, where I will use a hard stop is if somehow I've run into something that's just blasting off into the moon, I'll have a stop that's hard that rides up with it. But that's very, very rare. Most of my stops are, okay, the alert comes, you better be paying attention. I have a note written on every single one that says, all right, what am I supposed to look for here? Because I will forget, because I look at hundreds of them. And so I'll look and I'll go, okay, they are supposed to hold this area. So, all right, let's take a look. But usually I am peeling profits off of highs and looking for those stops to get back in at either higher lows or to restart a new position because it's moving sideways. It's very rare that I'm in a trade that I don't take when things are moving up to new highs or old highs. I'm always going to peel some gains. And it's if you want to know what I believe my challenge is as a trader, where I sit today is putting on bigger size, because I have the ability to put on significant size, but I don't because I'm still somewhat timid. And that's, open kimono kind of conversation. It's really something that I work through. But again, I have so many of those, I'm going full, and then something will happen and, the wheels come off the bus. And so it's always, I'm always pushing myself. That's the one thing. Always push yourself just a little bit harder, a little bit more, so that you can stretch and grow, because that's what the business is made to do.
Perfect. And there's a question here. I'm not sure how to pronounce her name, but basically the question is, what is the best source for macro information in your opinion?
Wow. Okay. So I would say for macro information that doesn't have a narrative attached to it, you want to go to Fred, F-R-E-D. That is the federal, let me see what Fred actually means.
Yeah, it's slipping my mind as well at the moment.
It's the Federal Reserve Economic Data site. And so on there, you'll get everything. If you have TradingView, you can look for things like economy, and it'll give you the list of charts. Here's the problem. If you have trouble parsing through data, that might be a little hard, but if you go and listen to somebody, they're going to completely interpret it however it is that builds their narrative. If you've got a bond guy coming out, he's going to say XYZ. If you've got a stock guy coming out, he'll say ABC. And so your job is to just look and, you know, it's so, I feel truly my nickname should be Forrest Gump, because literally I go, okay, is that moving up or down? If it's moving up, then things are supposed to look okay. But if it's moving down, I need to be a little bit more comfortable, a little bit more careful with my capital. And it's those simple things. We don't have to think deep. We don't. It's actually thinking too much that gets us in trouble very often. Just sort of dovetail it into, how does that information actually help me trade better? If you can't figure out an answer, don't even just throw it out in the trash with nothing. Just go, all right, I'm not even thinking about that. If it gives you some insight, then yes, and make some good rules for yourself that you're able to follow. If you can't follow your own rules, then your word as your bond is completely inauthentic. And you know you can't hold yourself to anything. And if your word is inauthentic to yourself, you are going to have a lot of mental conflict, and it is going to show up in your trading. Start holding yourself accountable and let your word be your bond, of course, to yourself first and ultimately to everyone else. And it will build consistency and reliability in all facets of your life.
Yeah.
And it'll be amazing what you'll see it'll do in the trading space. It'll be phenomenal. How do I know? I had the same struggles, did not hold myself accountable, totally inconsistent, moving from one system to the next, instead of saying, what's causing me to make the inappropriate response here when this particular stimulus comes about?
Perfect. I think that's well said. And Marie, I also wanted to ask you about, obviously having traded for more than a decade, what have been kind of the risk management principles that have allowed you to, preserve your capital and protect it, during market downturns and also capitalize on those uptrends, on those bull markets? Yeah.
Okay, great. So always the same. I'll look at the SPX. Oops, not PX. I don't know what that is. SPX. Fat fingers here. All right. So I'll look at the SPX and I'll say, from a weekly perspective, am I above my 5 simple moving average or am I below it? And what is the slope of that line? I started doing this about 12 years ago, and it was the defining space for where I put a lot of money in what direction. So at the first pass, I had no risk parameters, and I lost millions of dollars. It was very hard. Those early days were very hard, and it was very lonely because they didn't have spaces like this where people could talk and learn from each other. It was a very secretive space. Very, very interesting. Not like that at all. We have a totally different shift in the culture of markets, which I think is fascinating because I love the sharing. So that's the first thing. Once I get under that 5 weekly moving average, I start watching and saying, hey, I got to trim back. When it gets under the 5 on the monthly, and we're still underneath there, Once those two things coincide, I'm under the 5 on the month, I'm under the 5 on the week, I start raising cash. And I keep raising cash until I get above my 5 on the monthly and my 5 on the weekly. And then I start putting cash to work. You might go, but Anne-Marie, you missed the bottoms. You know, I'm intraday trading there. I'm doing a lot of short cycle trading, but big money and my major investment events, I start clearing the decks once I lose that 5. And it's what's kept me on the right side of upward tracking portfolios for over a decade. And I heartily advise that is what you look at. Doesn't mean you don't get to participate in great things, but that is your litmus test. That's the one that goes, I better be a little careful here, right? If interest rates continue to go up, and they might, and the market continues to fade and, starts really compressing, that's why you get CDs. That's why there are all kinds of different vehicles that you can put money to work at. What the problem is, a lot of us are undercapitalized, and we are trying to go from 1,000 to 100,000, and that takes time, right? If you look at across the landscape of all the people who've been wealthy for a long time, they've got a lot of gray hair, and you just have to put in the time. But as far as managing the risk, that's exactly my sweet spot. So I'm still waiting to deploy cash. I'm looking at little things and small amounts, but, being probably 74% cash at this juncture, it's going to take quite a bit of market repair for me to get back in. And because I'm going to be getting back in a downward sloping formation, I'm still going to have to be watching it going, wow, I need to take some profit up here.
Yeah, just looking at the monthly chart, you can see, at least for that time frame, we haven't really changed the direction. The current monthly candle is just right in the body of the previous one.
Exactly. And last month we made another lower low. And so, Dow theory tells us, wait a second, if I keep making lower highs and lower lows, I'm still in negative trend. So, yeah, there's a lot that's got to get repaired. A lot.
Perfect. And we'll have to see what happens. And Anne-Marie, I'd love to hear, I've asked this question a few times today. What is your favorite, trading or market related quote that you think is really important for people to learn and has a lot of meaning for you personally?
It's a quote that everybody gives to Mark Twain, but I don't think he said it, but he gets credit for everything. Yeah. It's not what you know. No, it's not what you don't know that will hurt you. It's what you know that just ain't so. And that is one of the very biggest things for me. First time I heard it, I thought, wow, there's a lot that I thought was so that wasn't, and it made me really make the wrong decisions. And so just remember that price leads. It is the indicator, and the bigger the time frame, the more you understand about it. So that really, I don't know who said that quote, but whoever it was, it truly is. It truly might have been Tom Sawyer or something like that. So yeah, that is it. It's what you think that just ain't so.
Perfect. And my last question for you, Anne-Marie, thank you so much for your time, is what general advice do you have out there for traders just starting out? Maybe this is their first, extensive correction that they've experienced. What would you kind of say to them to, keep them optimistic, but also encourage them at the same time?
Don't beat yourself up. There are plenty enough people in the world to do that for us. That's number one. Step back and really look at the reasons why you're in the market. And if it's got to do with ego and driving a big car or living in a fancy house or traveling all over the world, those are great, but they're not going to help you make the right decisions. So separate ego from objective, and then learn to enjoy the work. If you enjoy the work, you're going to last. Because this is magnificent work, and it's so exciting. I literally run to my office every day, and it's a great place to be when you get excited about the work. And so focus on process, don't beat yourself up, and trade so that tomorrow you're able to trade again. And what I mean by that is manage that risk.
Yeah, I think that's wonderful. And yeah, of all the traders who I've interviewed and talked to, you know, passion is like the one thing that they all share. They might have completely different personalities, but they've all got passion for the markets, and that's what allows them, you know, to trade for decades. So yeah, I think that's perfect. Anne Marie, thank you so much for your time. Where can people reach out to you if they've got questions about your style or just want to learn more about you and your book as well?
You can find my book on Amazon, and you can find me on StockTwits or Twitter. It's Anne Marie Trades, ANNEMARIE Trades. And you know what? Reach out, send me a chart, ask questions. I absolutely love talking to traders and helping folks out. And thank you so much, Richard, for always being such a great host. I really appreciate it.
Yeah, it's a pleasure having you, Anne Marie. Thank you so much. And we'll be right back with our last presentation of the day, Joseph Fahmy, talking about 4 ways to improve your trading. And that'll be at 6:10 Eastern time. Hopefully you guys are enjoying this. If you are, please go ahead and leave a like down below and subscribe to the channel so you don't miss any of the future presentations. And as I mentioned before, we're trying to keep this completely free, but in return, if you're enjoying it and find value in it, please go ahead and make a donation to St. Jude's, a really great cause. We'd really appreciate it. And with that, we'll see you guys back at 6:10. And yeah, we'll be right back. All right, welcome back everybody to our last presentation of today. We thought we'd close out strong with Joe Fahmy, who's the managing director over at Zor Capital and the market comedian as well. Joe, always a pleasure talking markets with you, so welcome.
Thanks for having me, Richard, and a huge thanks again to your team for, Ray, Ross, and Nick and everybody. You guys just add so much value to the community, and the speakers before have been amazing, and tomorrow and next weekend. So kudos to you guys for putting together an amazing conference.
Thank you, and we couldn't do it without you guys. So I've got the easy job. I was telling Anne Marie, I just got to ask the questions, but you guys have to present and be in the hot seat. So thank you.
Yeah, just reminding people to keep their expectations low. That way they can only surprise them. So
perfect. Well, let's get right into it.
All right, let me share my screen with, I'm actually going to do 2 presentations. Let me just make sure everything's all good. Okay. So the main presentation is going to be 4 ways to improve your trading. And I'm also going to do a mini presentation after this on the Fed and current markets. So let's start with 4 ways to improve your trading. As always, all this information, as I know, as you have already mentioned, is for educational, informational purposes. So before I get into that, I want to talk about how to trade cryptocurrencies like Charlie Munger. It's a topic not too many people talk about, and I think it's very important. I'm kidding. I'm just trying to get a cheap laugh out of everybody. So I'm going to give you an outline where I'm going to do a quick introduction, talk about 4 ways to improve your trading. Number 1 is make sure the market direction is in your favor. Number 2, when the market is strong, to make sure you're hopefully in some of the stronger fundamental stocks. And then also entry point is very important. So we're going to touch a little bit on technicals. And the 4th one is mental toughness, because I think no matter how great your strategy is, 80-90% of trading is your mental strength and mental toughness. And I think it's an important thing to discuss. So just a quick introduction. As you mentioned, I'm a portfolio manager at Zor Capital. It's a New York-based investment advisory firm. I've been doing this 25 years. And I also run a blog at joefahmy.com where I also have an educational product. If anyone wants to reach out, you can just go to the website and reach out to me that way. So 4 ways to improve your trading. The first one is, it would kind of be nice to expose capital if the market is in your direction. I think that makes common sense. Clearly, this year, we've been in an ugly downtrend. We've been below key moving averages. And if you reduced your exposure or had less capital exposed to the market, you would have survived so far this year. So I personally have 4 signs of a healthy market, but I want to share one of them with the viewers. And by the way, I can't say this enough. I'm for the people tuning in live, or even if you watch this on a recording, I'm beyond grateful for the people tuning in, because one characteristic of successful people is their desire to improve themselves. So by you guys tuning in, you're instantly showing that you want to improve yourselves, and I have tremendous respect for that. And I'm going to try to give you my best, and I know we're going to open this up for questions as well. But the first thing, if you literally don't remember anything from anything I say, I just want you to remember one thing. Plot the 50-day moving average on the NASDAQ. If you want to use the S&P, that's fine, on any individual stock. And just remember, if we're above it, for the most part, the market is healthy or the stock is healthy. If we're below it, probably a sign to get defensive and things are not healthy. I'll look at any stock anyone tells me to look at. If they say, hey, Joe, pull up XYZ, of course, I'm open-minded. I'll look at anything. But the first thing I'm going to look at on the chart is, on a daily chart, is if we're above the 50-day or below the 50-day. In other words, if you were stranded on a desert island for like 10 years, and then you had no idea what was going on, no communication with the world, and you came back and somebody said, what do you think of the market? And you just pulled up a chart. The first thing I'm going to look at is, are we above or below the 50-day? Why? Because that is the area of institutional support. It roughly coincides with the 10-week moving average on weekly charts. And statistically, traditionally, historically, that's an area of institutional support. When I get into the market Smith charts, I'll show you some more. But bottom line is, you pull up any chart. Hey, I want to expose capital when the market's healthy. What's a great way to determine that? just again, blindly without having too much trading experience or knowledge is, are we above the 50-day moving average? That's why I put on this slide, it's for the most part, green lights to be in the market. Are we below it? It's a red light to get defensive and for mostly to stay out, mostly for traders. Now, as I said in the slide, it's not an exact science, but it can be used as a general red light or green light to stick with the trend. I like to use the NASDAQ composite because to me, that's the go-to index, the leadership index. You get over 3,000 stocks versus 500 in the S&P or 30 in the Dow. As I always say, you can do what works for you. People are obsessed with technicals on S&P. I really don't care. I like to use the NASDAQ. This is all about whatever works for you. So first sign, a way to improve your trading is look at where we are relative to the 50-day. If we're above that, that's usually a sign that the institutions are supporting the markets and probabilities are that breakouts are going to work. If we're below that, as we've been pretty much all this year, that's a sign to get defensive, reduce position size, raise cash. Breakouts are probably not going to work, and it's a time to have a little bit of sit-out power. So that's the first sign as far as a general sign to improve your trading is just instantly look at the 50-day. Even with an individual stock, if we're well below that 50-day, unless you're some longer-term value manager and you have a 5-10-year time horizon on something that's been beaten down that you've done fundamental work on, even if you just pull up a stock and say, hey, what do you think here? If it's above the 50-day, again, just trying to hammer that point for people who might have tuned in late. If we're above the 50-day, for the most part, it's a healthy sign. And if we're below it, it's a sign to get defensive. So that's one way to improve your trading. Now, I like to try to take people from start to finish. I've done webinars, I've done seminars and my educational product, all that stuff. So let's just go with the checkbox number one. Let's just say, hypothetically, we're above the 50-day and the market's healthy. Now, I want to take people to step two, a second way to improve your trading. It would be nice to try to find stocks that have characteristics of the biggest winners throughout history. That would be nice. It doesn't mean you have to do it that way. It's not the only way, but William O'Neill did these studies of the characteristics of the greatest stocks. Now, the key word here is before. I put it in bold, I put it in capitals, and I underlined it because the studies were, let's study stocks before they went on, not after they went on big runs. Let's study them, after they went on the big runs. Let's look at what they had in common prior to that. So before Microsoft and Cisco and Dell and Intel in the 90s became huge winners, before Walmart and Home Depot in the 80s and 90s became huge winners, going back to other stocks, the same patterns for the past 80 years have repeated themselves of let's study now, again, check mark number one, assuming the market's healthy. Number two, what stocks do we want to try to gravitate towards for people who are interested in individual stocks? You want to look at there's 18 characteristics in this study, and I'm going to share, the top 4 pretty much. But what causes a stock to go up? For the most part, assuming the market's healthy, if you're growing your business, for the most part, your stock is going to appreciate in value. And the dominant reason behind the success of the biggest winners throughout history, before this became that, and Chipotle went on to a huge gain, and Apple went on to a huge gain, and all the stocks that went on to huge gains, the main reason is earnings and sales growth. How much? At least 30% or greater. The greater, the better, but 30% or greater year over year is what we want to look at. And we want to compare the current quarter with the year over year prior year's quarter. For example, retail, for obvious reasons around the holiday shopping season, the fourth quarter is very strong. You want to compare the fourth quarter of retail to the prior year's fourth quarter. So that way you're comparing the proper seasonality. So the main reason behind the success of big winners is earnings growth, sales growth, preferably 30% or greater. The third point here is most of the winners, 80% of them, come from the same groups: consumer retail. By retail, that could be retail clothing, retail restaurants, fast casual. So it's not just shoes and apparel and the Lululemons and all that stuff, but it's also the Panera Breads, the fast casual, Taco Bell before they got bought out by Yum Brands. So it's not just retail and consumer clothing and apparel and shoes, it's also restaurants as well. Computer related is wide ranging software, hardware, semiconductors, and so forth. Anything computer related. Drug and medical has been huge, with huge advances in biotechnology and medicine and so forth. Financials, another one, and leisure and entertainment. Don't underestimate the power of fads. In the 60s, there was a huge bowling boom and pool and bowling, and that's what people did. And it was a big boom in Brunswick, which made a lot of the equipment, went on like a 1,200% run in the 60s. So no different than in more recent times with the yoga boom. Lululemon's done well, as I mentioned before. So don't underestimate fads or even shorter term booms in entertainment and in culture and so forth. And then the fourth one is technicals. 99% were above their 200-day. 99% is like Richard from the free throw line. It's just money. It's 99%. Or maybe with your archery, bullseye, like 96% above its 50-day. I got to put it more, in your terms. Anyway, you want to combine this with strong technicals, which is the next point, is that 99% of the biggest winners throughout history were already above their 200-day. And the point I made earlier about the 50-day, 96% were above the 50-day. MarketSmith has a proprietary rating of relative strength, 1 to 99. It's a software package. I'm not promoting it. I've just been using it over 20 years. You want to see an average relative strength of 92. That's before. Again, the key word is before, in bold, capital letters, and underlined. So technicals are very important. So those are two of the four ways for people who hopped on late. One way to improve your trading: make sure the market is in an uptrend above the 50-day and for the most part healthy. When it is healthy, try to get into companies that are growing their earnings and sales. It's not a guarantee. It's just to increase your probabilities of success. I want to pause here and say that a lot of people ask questions and they want to know, what's the right answer to this? What's the right answer to that? There is no right or wrong answer with a lot of things. There's a lot of gray area. The market is not always going to be, black or white. There's tons of gray area. So that's why I'm just talking in terms of probabilities to help increase your probabilities of success. So the second way to improve your trading is, after the market's healthy, try to gravitate towards companies that have strong earnings and sales growth, and for the most part are growing their businesses. Now, third way, now that we got the market healthy, we got some nice fundamental stocks that are growing their earnings and sales. Entry point is everything for me. The viewers out there, you all have different time frames. Some are day traders, some short term, even swing traders. Some trade a few days, few weeks, few months, few quarters. Some are position traders, some are longer term. I don't care what your time frame is. I think it's important to get a strong entry point, because it'd be nice if you bought a stock at 50. I'm trying to be patient here, but if it slowly moves 51, 52, 55 in your direction, that's going to help build your confidence. Okay. Nothing worse than buying a stock at 50 and 2 weeks later it's buried at 40 or 35. That's the worst feeling. So we want to, again, try to improve our probabilities of success by getting strong entry points. There's so many different technical patterns here. As I mentioned, bases are formed during market corrections. So we're in a correction now. That's when bases are formed. The top two that I mentioned here, cup with handle and double bottom, are the most popular ones. For sake of time, I'm just going to get into cup with handle, which is the next slide here. I assume a lot of people have heard the expression cup and handle, cup with handle, blah, blah, blah. It's not a stupid question to ask. I've heard of the phrase, I've heard of the technical pattern. What does it exactly look like? Because I was trading like 3 years, been doing it 25 years now. It's like 3-4 years into it. I'm like, I asked, someone, can you just show me what a cup with handle looks like? It's not a stupid question, because remember, there's no such thing as stupid questions, just stupid people. Anyways, just seeing if people are paying attention. So cup with handle at the top of this slide, and at the bottom, this is from William O'Neill's book, 24 Essential Lessons for Investment Success. At the top of the slide is just an outline of a cup with handle, and below it is an example of Microsoft on the weekly chart of what the cup with handle looks like. Cup with handles work on weekly charts, daily charts. You can use an intraday 5-minute. It's the same pattern where you usually have a prior uptrend. The market goes into a correction. In this case, we had a 90, 91 bear market. The first Gulf War happened. We had a correction then, and so forth. With the invasion with Kuwait, Iran, and all that stuff. Anyways, first Gulf War. And that's when we had a correction, a base was formed. Now, you have a prior uptrend, and people, in this case, Microsoft went from 40 to 75 or 80, and then some people bought it extended. They bought it incorrectly. Then a base is formed. That's why I mean entry point's so important, because if you bought it at point A at 75, it sucks when it drops to 55 several weeks later. But then what happens is it's building its base. They're growing their earnings and sales. The only reason it corrected is because the general market corrected. So then now you go build the base through point B. Now you get to point C and point D. What forms the handle, in my view, is people who bought incorrectly the first time, bought something when it was extended at point A. It gets back to even, and they're like, just get me the heck out of this thing. That's what forms the handle. People who said, okay, I bought it 75 or 80, it went down to 55, comes back to 75 or 80, and now they're like, get me out. The handle's usually formed 1 to 2 weeks, but now you want to wait for a dry up in the sellers, as you can see in all the chart, how it's marked up. You want to wait for all the sellers to get through that. All the people who said, yeah, 75, 80, I'm sick of the stock, get me out of it, get me out of it. And I really want to stress that this is the buy point before it went on to a huge move. So you might say, well, I don't want to buy it here because it's near its highs. No, it's a prior uptrend. The cup with handle usually forms over 12 to 26 weeks. The correction from top to bottom is about 12 to 33%. You want to look for improving relative strength. You want to look for tightness in the base. You want to look for big volume bars, higher closes on rising volume. You want to learn how to analyze the bases. It takes time to do that, but the more time you put in, the more it'll help. And then you want to wait for it to come back, form a rounded U bottom. Maybe sometimes you have a shakeout in the handle, and that's the buy point. So again, first way to improve your trading, make sure the market's healthy. Number 2, try to expose yourself to fundamentally strong stocks that have strong earnings and sales growth. And number 3, learn the technical patterns, study the technical patterns, get strong entry points. I completely respect that all the viewers have all different time frames. I don't care what your time frame is. It doesn't matter. It's just important, no matter what your time frame is, to get strong, safer entry points when the market's healthy. So that's the third way to help improve your trading. Now, the fourth way, there's other ways, of course. I use unusual option activity to try to help my success. I use seasonality. I use a lot of other things. For the sake of time, I think this is the most important one, because I don't care if you have the greatest strategy handed to you on a silver platter. If your head's not straight, you're going to screw it up. 2017 was one of those rare years of X equals Y, meaning the S&P was up 20-something% and we didn't have a correction of greater than 3%. It was sit back in your rocking chair and the market went straight up. A friend of mine was down like 30-35% that year because he was going through a brutal divorce. He was shorting the market. His mind wasn't straight. His head was all screwed up. 2017, just as a reminder, the average intra-year correction's 14.5%. That was the first time since 95 we didn't have more than a 3% correction in the market. It's very rare. It was straight up. You literally, you could have sat back in your rocking chair and made money with minimal drawdowns. Why he had a difficult year is because his head wasn't straight. I really want to stress the importance of, you need to be mentally tough. You need to be able to make decisions. You need to be mentally strong. It's like a muscle. Before you can lift 25 pounds, you got to learn how to lift 5 pounds. Before you can buy, 100 shares, you got to learn how to trade with 10 shares. You got to work and build your decision-making ability. Because I tweeted this out before that, and I'm sure Richard and Ray, you guys would say the same thing, like 90% of the questions you get, there's no right or wrong answer. It's, what do I do with position size? Where do I buy? Where do I stop myself out? It really depends on so many factors, but the best way to deal with this is to just get mentally tough and learn how to make a decision. That's it. If I ever wrote a book, I don't have a book. I know Anne-Marie does, and some other speakers have great books. If I ever wrote a book on the stock market, the title would be Stop Being a Little Bitch and Learn How to Make a Decision. I know that probably wouldn't sell well. Maybe it would be. But my whole point is, I'm trying to impress upon people, learn how to make decisions. Be mentally tough. As I said, you could have the greatest strategy. I could give you a stock that's a perfect setup. If your head's not straight, you're going to screw it up. Okay, Joe, that's great. I agree with you. How do you get mentally tougher? A lot of it's just learning how to make decisions, but gratitude is one way. Because what are the two emotions that screw us up in our life, that screw up our trading, screw up our business, screw up our relationships, screw up everything, is anger and fear. Okay. And one way to overcome that is to focus on gratitude, meaning that if you can focus on things you can be grateful for, then you will eliminate the anger and the fear, because the human mind is incapable of being grateful and angry at the same time. It's just physiologically impossible. You can't be grateful and fearful at the same time. Okay, Joe, well, what can I be grateful for? I don't know any of the viewers out there, or the majority of them, but you can be grateful you have a roof over your head. You have a little bit of food in your fridge. You got a family or friends that love you. You have a little bit of money. You're watching this online right now. There's a million things you can be grateful for. And when you focus on gratitude, your breathing calms down. You become a lot more relaxed. You become a lot more mentally sound. And those emotions of fear and anger that screw us up in everything in life, especially in our trading, those tend to go away. So you got to focus on gratitude. Physical strength. So a lot of people know this, that Tony Robbins coaches Paul Tudor Jones, who's one of the greatest traders of all times, one of the greatest money managers of all times. Why? Because of consistency, consistently profitable for whatever, 28, whatever the number is, years. Okay. And he pays Tony Robbins seven figures a year. I don't know the exact amount. Who cares? But he pays him every morning to make sure he's mentally strong and mentally tough. Tony Robbins says that people pay him 7 figures a year to coach them. I'm going to tell you for free, the first thing I tell them all, get your ass in shape. I'm going to tell you for free, when people pay me 7 figures for personal coaching, the first thing I tell people, whether you're a trader, even if you're an athlete, a business person, running a family, whatever the reason is you go for personal coaching, the first thing he says is get your ass in shape, because physical strength will lead to mental strength. So I know people who do triathlons, who are in incredible shape and go and run like crazy and do all sorts of physical activity and hike and everything. They're in way better shape than I am. There are other people who are struggling with it. At least walk, especially on the weekends. Get off of Twitter, get off of social media. It's toxic, except to watch this conference, then it's okay. But other than that, just go out for a walk, spend some time outside, work on your physical strength, because that'll help your mental strength. Reading, feeding your mind. There's a great book called The Magic of Believing by Claude Bristol. And he talks about feeding your mind with good ideas. You want to feed your mind with strong, I'm going to get into the reading list for trading in a minute, but reading and feeding your mind will also help with that strength. Surrounding yourself with like-minded people. If you're determined to improve something in your life, you got to make sure there's an expression, you become like the 5 closest people you hang out with. So if your significant other smokes, you're probably going to be a smoker. If your significant other goes out for a workout, you'll probably go out for a workout. If they're a crackhead, you'll probably be a crackhead. You get my point, is that surround yourself with like-minded people. And all of this will help you build confidence by making decisions. As I said earlier, the best way to lift 25 pounds, start with 5. The best way to trade 100 shares. For example, I've given some people a stock and I say, I like this stock. And then it takes off and they're like, I was going to buy it. Well, what were you going to buy? I was going to buy 100 shares and I hesitated and blah, 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 blah. I'm not criticizing. We all go through this. And I say to the person, well, why don't you just start with 10 shares? I wanted to lift the 25 pounds, but I couldn't. We'll start with the 5 pounds. I mean, I wanted to buy the 100 shares and I hesitated. Well, then buy 10. What does buying 10 do? Is, let's say you make that decision and you're right. The next time around, it builds that muscle and becomes easier to buy the 10 shares, maybe even the 20 shares. When you get your confidence reinforced, you can work your way up. So for newer traders, or if you're struggling with your confidence, build your confidence slowly by making decisions. Start with a smaller amount. That'll help build. I don't like paper trading because your gut, your hard-earned money, your emotions are not involved in paper trading. I don't care if you're starting with $500. Start whatever it is. And people say, how much should I start with? Again, there's no right or wrong answer. I'd like to start with like, I don't know, 200 million. That'd be a nice number to start with. But since I don't have 200 million, start with whatever works. I mean, some people say, is 500 enough, 1,000 enough, 5,000? Start with whatever works, build it small, and it'll help to build your confidence. What else do we got here? So feeding your mind with reading. I love the expression success leaves clues. So study success. Don't reinvent the wheel. find a strategy that fits for your personality. If you don't have a personality, go out and get one, come back, find a strategy that works with your personality. If you are fundamental, study Peter Lynch, study a lot of one of the greatest fundamental investors of all times. If you are value and that works for your personality, study Graham and Dodd, Warren Buffett, and all that stuff. If you're a trader, all the Market Wizards books, and I know Jack Swagger has more Market Wizards books, but the main ones, I love the OG one, the original one with Ed Sekoda and William O'Neill and Paul Tudor Jones and David Ryan, some great people in there. But my point is, find a strategy that fits your personality and try to study other successful people from the past that have done well, and then mimic their blueprint with your own style. I love the William O'Neill style. I love the Jesse Livermore style. Doing this 25 years, I've implemented unusual option activity. They never talk about any of that stuff. I'm not going to blindly follow somebody. It's just something over the past 5, 6, 7 years that I've implemented to help my style. So my point is, find a blueprint and continue to improve. As I said earlier, one characteristic of successful people is they're always looking to improve. One thing I love about this game, I'm literally learning stuff. After 25 years of doing this, I'm literally learning stuff every week, and I love it. Once someone says, yeah, I got it all figured out, they're screwed. They're done. The market will conveniently find a way to punch your arrogant attitude in your face. You always have to be humble. One thing I love about David Ryan, he says, what's a great characteristic of a successful trader? Humility. You need to have humility. You always got to be willing to learn. You're not smarter than the market. As we've said, the market doesn't care if you have to feed your kids, have to pay your bills, doesn't care about you, doesn't care about anything. You have to be humble, find a strategy that fits your blueprint, and look to grow from there. I have a recommended reading list. How to Make Money in Stocks. The greatest lesson you can learn for chart reading is How to Make Money in Stocks, 4th edition, William O'Neill, orange cover. Study the first 100 pages in that book. I will say this again. It's like $14.95 on Amazon. Get the paperback, get in your house. History doesn't always repeat itself, but it tends to rhyme. Maybe when you go to bed at night, you're trying to fall asleep. You can listen to a Fed speaker. That also knocks me right out. Who needs Ambien when you can listen to the Fed talk? But go through the charts. In all seriousness, study the 100 charts, the first 100 pages in that book. It's the greatest winners throughout history that the O'Neill team marked up, annotated where to buy, where to add to, a normal consolidation, where to cut your losses, where to sell. Study those charts. That's the greatest lesson you can learn in chart reading, in my humble opinion. How to Trade in Stocks by Jesse Livermore. That is cited by so many people, that and Reminiscences of a Stock Operator, not just stock traders, but like Bill Gross, for example, the great bond trader, from PIMCO and Janus and so forth. His favorite book is Reminiscences of a Stock Operator. That's a great book. Talk about mental toughness. Mark Douglas, Disciplined Trader, Trading in the Zone, explains this shit way better than I can. Amazing, amazing on mental toughness. Victor Sparandeo has great books on, and by the way, there's a million great books, and I know there are, Anne-Marie, Brian Shannon, so many of my colleagues and speakers here have written great books. I'm just trying to pick some that might help. Victor Sparandeo with Trend Following is great. Nicholas Darvis, How I Made $2 Million in the Stock Market. A funny title, but it's a great book. If you ever want to write a book on the stock market, title it How I Made $3 Million in the Stock Market, because people will probably buy that one. Like if you're at the bookstore, I don't care how the person made $2 million. I want to know how the person made $3 million. It's kind of like something about Mary with the 7-minute abs and the 8-minute abs. I don't have 8 minutes. I don't have time to do abs. I want to do the 7-minute abs. Anyways, Battle for Investment Survival was written in the 50s. You read that, it's literally like he's talking about the markets today, because a lot of things don't change. Even William O'Neill says that's one of his favorite books. I literally went through that like a month ago. I love that book as well. I talked about the Market Wizards books and confidence, self-help books, mental toughness. I think the greatest book on trading, which is not about trading, is Think and Grow Rich by Napoleon Hill. I think, bar none, that is the greatest book you can read to help with your mental toughness. Wayne Dyer, Norman Vincent Peale, so many, Tony Robbins stuff. Listen to David Goggins on YouTube, read his book, Can't Hurt Me. I mean, there's so much stuff that's for free with great resources. Tony Robbins, David Goggins, Joe Rogan, all of that stuff will really, really help if you're just going out for a walk, on the treadmill, whatever the heck you do for your exercise. Listen to that stuff to feed your mental strength. One other quick trading tip. when you read the Market Wizards books, you'll find a common theme. Just like in real estate, what are the top 3 rules in real estate? Location, location, location. When you read the Market Wizards books of all the amazing traders and investors and money managers throughout history, you will find a common theme. Top 3 rules: cut your losses, cut your losses, cut your losses. Play defense, play defense, play defense. Defense wins championships in sports. Defense also helps tremendously in the markets. Give me 1 second. Let me grab some water. So this is an actual chart. I've used this before in presentations. I think you already know the answer to this one, Richard, but this is an actual chart, a stock in 2000, 2001. A lot of people, unfortunately, had a lot of their retirement in this. Analysts had like $300-$400 price targets. It went from $30, $40 to $90. And then all of a sudden on this weekly chart, you can see all the huge bars that are marked up with the arrows there of distribution of institutions getting out of the stock, breaking below that 50-day, or in the weekly chart, the 10-week. And that was a warning sign that institutions were selling. And this is an actual chart. It just says company XYZ. I'll give you a second to guess. I know Richard already knows the answer. Next slide. This was a chart of Enron. As I showed you, went from 20, 30, 40 up to 90. That round arch at the top of the chart is all of the markups of all the key sell signals, with just huge institutions dumping huge volume. And by cutting your losses, it protects your confidence, because that will help. All it takes is one WorldCom, one CMGI, one Lehman Brothers, Bear Stearns. I did this talk once, and there was someone who used to work at Bear Stearns, and they went storming out of the room at a Traders Expo. Like, I offended them. I'm like, it has nothing to do with me. I'm just saying there's so many examples throughout history. Enron, the list is endless, of stocks that have completely fallen apart. And all it takes is one to ruin your year, ruin your portfolio. That's why we all have our conviction. We all like our names. We all like our stocks. We all have certain ideas. Let the market prove you right or wrong. But when it proves you wrong, going back to David Ryan's line about humility, you can't have an ego. You got to be humble. You got to say, you know what? I had a theory. The market proved me wrong. I got to eat it. At some point, no matter what your time frame is, you got to be able to cut your losses. And then one other slide here is another reason to cut your losses is a lot of people know the math. They just don't think about it. Meaning, we know if you have $100 and you lose 10%, you're at $90. But now to get from 90 to 100, it takes 11% to get it back. So the greater the loss, the harder the percentage return, the larger the percentage return it's going to take. If you have $100 and you lose 50%, you have $50. How are you going to get from $50 back to the 100? You need a double. You need a 100% rule, 100% gain. So the rule is, the greater the loss, the harder it is to come back. That's why you want to try to minimize your losses depending on your time frame. Try to cut your losses. That's another reason to cut your losses. So these are that's the first part of the presentation. We can get into the second one whenever you want. Richard, I'll stop the share for now. Just to review, 4 ways to improve your trading. Number 1, try to identify when the market's healthy using the 50-day when we're in an uptrend. Number 2, try to expose yourself to strong fundamental names. Number 3, get those strong entry points. Learn the technical patterns. Number 4, it doesn't matter if all this is lined up. Get your head straight no matter what. This isn't just helping your trading, because I truly believe 80% of trading is psychology, if not 90%. This helps you in your general life. This helps you running your businesses. This helps you with your health, with your family, with your relationships, and all that stuff. Stay mentally strong, and there are a lot of ways to do that as well. So those are 4 ways I hope people help them with their trading in general.
Yeah, I think that's an excellent reminder. And before we get into the next section, we'll do a quick Q&A covering the topics on that first presentation. And to kick things off, Joe, I'd love to ask you, going back to those characteristics of big winning stocks, is there a certain kind of market cap, size that you look for as well? Do you focus more on the smaller caps, the mid caps, or do you also favor the large caps as well?
Yeah, that's a great question. I like to try to find the mid cap names. It's not to say, mid cap names would be, I would say, like 2 to 20 billion market cap. It's not to say that, obviously the smaller cap names can't work, and it's also, in recent markets, the FANG stocks have been all mega cap names that have done well.
Yeah.
So that's an awesome question. I just don't know what the right or wrong answer is I'm trying to find those mid-cap names that might go from 2 to 10 billion in market cap, or maybe 5 to 20 billion. Not to say that, you know, an Apple, when it crossed 1 trillion, didn't go to 2 or 3 trillion or whatever it went to. Not to say you can't get a big gain out of a monster name, you know, like Amazon and Google and all the FANG names. But the sweet spot for me is the sort of mid cap, trying to get from that 2 in that range, 2 to 5 to about 20 billion market cap.
Perfect. And along those lines, there's also a few questions about what you kind of look for in terms of that like N factor, you know, new and innovative product. You know, a lot of the people who follow Can Slam, that becomes really, really important. We always kind of want to see that theme going on. So I'd love to hear your thoughts on that and kind of what you look for.
Yeah, I like to, it's not necessarily new. It's themes of when I screen. And let's go through 100 stocks, let's say a couple years ago, or around the pandemic lows. I go through 100 stocks and like 20 of them are software related. So it's telling me there's maybe a huge boom in the cloud, obviously work from home, huge boom in software cloud and so forth. Or a little bit farther along the line from the bull market from 2020 up until, December of last year, I would screen and find a whole bunch of semiconductor names. They weren't necessarily new, but there was just a big boom in chips going into, as we know, not just PCs like years ago, going into smartphones, watches, appliances, cars. The list is endless going into everything. So it's trying to screen and find themes of stocks that are the majority, like a light bulb goes off when you go through 100 names and you say, wow, 20 or 25 came from this sector. That'll help me gravitate towards not necessarily sometimes what's new, but what might be ready for a new boom in growth.
Yeah. So to kind of use an example in current markets, biotech, that's kind of been the theme that's been working. So yeah, 100% agree. And there are a few questions about, why you pick that 50-day moving average. There are a few, why don't you use the 20-day, 8-day moving average? So I'd love to hear your answer on that and your thoughts overall.
Oh yeah. No, there's no right or wrong answer. Some people who are short-term I've heard some people say I use the 8-day, I use the 9-day, I use the 10-day. Yeah. I really don't care. I mean, my charts, I have the 10-day on there, the 21 EMA, because Mike Webster said that the studies they did at O'Neill throughout history, the 21 EMA tends to hug the charts a little bit better. So that's a great line. It depends on time frame. There are some people who are like, I don't care if you're a junkie, short-term crack day trader. I really don't care. There's some people, they're like, why would I use the 50-day? I'm just looking for super strong uptrends. God bless. Do what works for you. My charts have the 10-day, 21 EMA, 50-day, and 200-day. For longer-term people, the 200-day would be your for me, the hardcore line in the sand. No matter how much you love the company, 200-day would be the absolute line, hardcore line. But I digress. To directly answer your question, it depends on your time frame. So if you're trading shorter term, use the 10, use the 8, use the 21, whatever works for you. If I'm managing money and I want to try to stick with some positions for a few months, few quarters, I'm going to use that 50-day. That's why the 50-day and the 10-week for medium to longer term time frames is a guideline. Some people who are shorter term say I'm never going to own something below the 21-day. So the direct answer is it depends on your time frame.
Yeah, perfect. And there's a question here from Giovanni. He said he quoted a lot of O'Neill, and Giovanni would like to know if you have any kind of strategies to kind of track rotation, from one group to the next or from one area of the market to the next.
Yeah, no, O'Neill's just a great blueprint. I obviously have respect for him and the team tremendously. I do that through screening. As I said, I screen the market. I look at 500 to 1,000 stocks every night. One, because as you mentioned earlier, a lot of the speakers are very passionate about this. Two, because I have no life, so I have no problem admitting that. But seriously, I like to screen because that is the true way you get a feel for the markets. I know people wake up in the morning and there's several financial channels, and then there's all this noise on social media, and then there's 20 bloggers, 5 are bullish, 5 are bearish, 5 say buy gold, 5 say hide under your bed, 5 say go on margin. I know that's 25, but you get my point. There's a lot of noise out there. What helps me shut out the noise and to find the sectors that are being rotated into is by screening. To your point, I've been saying since May, June that biotech is likely to be a leader for the second half, and we'll get into that later. But my point is that where did I come up with that? I was screening. That's what screening helps shut out the noise, helps you focus on the phrase. Don't focus on what you think the market should be doing. Focus on what it's actually doing. And by screening, I don't really have an opinion on biotech, but I screen and I'm like, wow, like 30 of the 100 names on my first screen are biotech, biomedical, medical products, light bulb, something should go off. Common sense that the market is rotating to that. So again, the direct answer is screening helps you identify the sectors the market's rotating into.
Perfect. And kind of a follow up to that, once, a group has kind of been established and it's been the leading group, what are some signs that, that trend is kind of failing? Recently, we saw the oil and gas related names, the coal names that had been super strong, kind of break those 50-day moving averages on huge volume. So once you've got a trend in place right now, the biotech is super strong. What would be an indication that, the trend is kind of changing and there might be some rotation out of that group?
Yeah, that's a great question. Like XLE, XOP, OIH, those are three of the main oil services, exploration and production, all the main energy ETFs. 10-week moving average, 50-day. That's why I mentioned that in the slide. That's a great trend following, line. Again, it depends on your time frame, but once XLE, for example, and XOP had great support for a long time along that 10-week, once they sliced through it in June and didn't find support and broke through it on a heavy volume, done. I'm out. I'm not interested in the sector, because if that's an area of traditional institutional support and the big institutions control the markets, if they're no longer supporting the names, why am I going to get in the way of that?
Perfect. Yeah, I think that's good for now. If you've got any kind of follow-up questions, let us know down below in the chat. But for now, let's dive right in with part 2 of your presentation, Joe.
Yeah, I don't have all my slides here, but you wanted me to talk about maybe a current, let me go back and share my screen here. So yeah, you get a bonus. You get two
for one.
You get 2 for 1. So we did 4 ways to improve your trading. This is where I'm going to pull up Market Smith, and I'm happy to have a discussion with you, Richard. Maybe if you want to ask questions from here is, trading 25 years. I'm trying to help people speed up the process. We've always heard the phrase, don't fight the Fed, don't fight the Fed, don't fight the Fed. It comes from Marty Zweig, the late, great Marty Zweig, came up with 2 awesome expressions, don't fight the Fed and don't fight the tape. So trading 25 years, I kept hearing don't fight the Fed. It really didn't resonate with me. It really didn't leave a strong impression upon me until the last 5 years. I'm not a macroeconomist. Talking about macro, again, talk about knocking you out and boring the you-know-what out of you. Like, macro is way too boring. However, you need to know the general direction, the general tone, the general philosophy of the Fed. I've been saying since beginning of the year, and I especially hammered it in April. I wrote about it for free. I went on TV. I wrote about it for Yahoo Finance. I talked about it, tweeted about it all the time with the phrase of, we're not going to see a sustained uptrend until the Fed is done with this interest rate hiking cycle. And since April, we've seen some bounces, but everything's short-lived. Why? Because the Fed is raising rates, taking liquidity out of the system, and you don't want to fight that. And it really resonated, I think, for us to get, to get more into current markets and so forth. I think we need to get verbal confirmation or an announcement from the Fed that they've at least, I don't know about whether I use the word stop this current rate hiking cycle or pausing it, until they basically shift policy and say, we've raised rates enough, now we're going to pause and let the rates filter in and absorb into the system. That's when, in my view, for people who have a time frame for longer than 7 minutes, this is for people who are looking for a keyword. Sustained uptrend is when the Fed signals they're going to pause, in my opinion. Let me give you some examples. And I wrote about this recently and talked about this so many times, which is the reason I say this is because, again, it's really resonated with me. When we've been in past corrections, it wasn't until we got some sort of verbal announcement from the Fed chair that helped lead us out of this. 2010, we're in a 4-month correction. We had the flash crash of May 2010. we go through a 4-month correction, oscillating, complete garbage, 5 days up, 5 days down, nothing sustained. And then it wasn't until September 1st, 2010. I always joke, I don't even remember what I had for dinner last night, but I remember specific dates in the markets. Ben Bernanke, the Fed chair at the time, at the Jackson Hole Symposium in Wyoming, came out September 1st, and guess what? He announced QE2. Follow-through day, September 1. It gives the institutions confidence to come back in, because I can't repeat this enough. The institutions control the markets. The big pension funds, mutual funds, hedge funds, the guys and gals who are trading millions, if not more than that, shares. They control the market. So, common sense, it'd be nice to kind of follow what they do. Wait for signs of big volume coming into the markets. QE2 announced that liquidity, accommodation, and was an equity-friendly environment for a sustained uptrend into the fall, into the end of the year in 2010. Fast forward to 2018. This was another example. Current Fed chair, I almost forgot his name, Fed Chair Powell, Jerome Powell says, we're going to raise rates. They were raising rates slowly and steadily through 2018. And then he says, we're going to keep raising 3 or 4 more times in the following year. We went into a correction, about 20%. And then he came out in mid-December of 2018. We're going to raise rates again, maybe even reduce our balance sheet. The market clearly couldn't handle it. I don't care about the mechanics. I know there's a lot of leverage in the system. I'm not here to argue it. I'm just here to analyze it. We went into a correction, and then credit spreads widened. It got to a lot of things happened in the markets. The structure of the markets were in trouble. He came out January 4th of 2019. We will be patient. I don't know why I did the Dr. Evil finger quotes, but we will be patient with monetary policy. A Fed announcement, that verbal announcement that they're going to be patient with monetary policy. Follow through day on January 4th, 2019, sustained uptrend. Let me give you 2 quick examples. Let me move over, because I apologize I didn't get to finish all my slides. Let me pull up MarketSmith. Give me 1 second. This is live, MarketSmith. And can you see MarketSmith now?
Yep, just popped up.
Okay. So let's go back to 2020. So I talked about 2010, and let's go back to the pandemic correction. Pandemic hits. We had a follow-through day on April 2nd on the S&P 500. This is the NASDAQ. And on the NASDAQ, a big volume day, up whatever it was, 7.3%. Huge volume day. Follow through day on April 6th on the NASDAQ composite. What led to the institutions coming in was insane Fed liquidity and policy. Bond buying. They did more bond buying, as I mentioned, in these first 6 weeks following the pandemic than they did in 9 years combined. More treasury purchases in 6 weeks than in 9 years from 2009 to 2018. Insane amount of bond buying. Interest rates, zero. Liquidity, increasing the money supply, doing everything they can for a once-in-a-century pandemic to make sure the markets in the whole world and the economy doesn't collapse. So they provided insane liquidity. Those announcements of all the series of announcements of liquidity and accommodation, similar to 2010, similar to the end of 2018, these announcements helped us to a sustained uptrend. That's the third example. Now reset to today. What happened in December of 2021? We had a nice sustained uptrend, because when you look at the weekly chart here, since the pandemic lows, for the most part, we held that 10-week. You don't want to fight the Fed when they're providing liquidity, right? And then what is the main reason, in my opinion, we broke through the 10-week? When you go to the daily chart, it's because all of that liquidity, bond buying, the Fed said, we're going to stop our bond buying in 2022. Big distribution, market starts to break down. Interest rates at zero. The Fed says, we're going to probably raise rates in 2022. Another leg down with more distribution, showing signs of the big institutions getting out. Early to mid-January of this year, in their Fed minutes, we're going to start to reduce our balance sheet. More distribution, breaking below the 10-week and eventually the 200-day. So my point is, of this whole rant, soliloquy, TED Talk, whatever you want to call it, is that you don't want to fight the Fed. When they're providing liquidity, don't get in their way when they're providing an accommodative, equity-friendly environment. In my opinion, I can't put a percentage on this. Let's say 90% of this decline this year is because the Fed stopped their bond buying, stopped their accommodation, raised interest rates, reducing their balance sheet, and that's what leads to this downtrend. And in my humble opinion, we won't get a real sustained follow-through day and sustained uptrend until they pause their current rate hiking cycle. I can keep going. Unless
Perfect. That's awesome. And I just want to ask everybody watching, go ahead and leave a question down below in the chat box. We can cover, individual stocks as well as the rest of the market. But first things first, Joe, I want to kind of ask you, how do you combine this kind of macro analysis with, the analysis of the leading stocks? Because right now, as we mentioned previously, biotech has been pretty strong. So are you less aggressive? Are you lowering overall position size if you are taking trades? How do you kind of handle that when, the market's in a longer term downtrend? And of course, we've got kind of the Fed, being a headwind versus a tailwind.
Yeah, I try to just look at the overall picture. I'm not a macroeconomist and all that stuff. Coming into this year, and I mentioned to my educational members, we were still holding up here, and coming into January, when there's mixed signals, there are still a lot of semiconductors holding up well. I said, okay, I can make the argument that the Fed is taking away all this liquidity and we can fall apart here. I can also make the argument that the market at the time was incredibly resilient and some semiconductors were holding up well. So, and I, disclosed all this publicly in the sense of, I just said, well, why don't we meet halfway? It doesn't have to be margin. It doesn't have to be all cash. Let me be 50% invested. That way, if we break down, you have a big amount of cash, fairly large amount of cash to hopefully cushion the downside. And if we go higher, you still have exposure. That's what I mean by when someone's not sure and making the decision. Nothing wrong with meeting halfway or even a quarter of the way instead of 100 shares, buying 25 and seeing what happens. If it goes up, you still have some. If it goes down, you hopefully don't lose as much with a smaller position. And I said I'll give the market the benefit of the doubt because remember, it had been incredibly resilient for a long time. And then once we broke below the 50-day and all this distribution continued to come in, that's where I combine. I don't care because the stocks are breaking down, nothing's showing up. And that's when I pretty much went, for most of the year, 0 to 20% invested with huge heavy cash because there were no stocks setting up. So it was a combination of the Fed coming in combined with when I screened, not finding anything, and the few stocks that were holding up in semis were breaking down. And then when we had these follow-through days in January 31st, we had a follow-through day. I literally was like, that night, I sent out a note saying, BS, this is not going to be a valid follow-through day. There were no stocks setting up. When we came into April, we ran into the 200-day. We had that sort of end of the quarter short covering rally, portfolio adjustments. There were no stocks setting up. That's when I publicly came out and said, nothing sustained until the Fed changes their tune because you don't want to fight that. So I don't know if I answered your question, but I've been keeping things light because of no stock setting up. Now, to answer your question on biotech, let me show you something a few weeks ago that kind of the market tipped its hand a few weeks ago. The S&P 500 a few weeks ago was down 4 weeks ago, was down 5.79% on the S&P 500. NASDAQ Composite 4 weeks ago was down, or maybe it was the prior week. Let me see. Let me go to XBI. Give me 1 second.
Yeah,
this is live. I got to go to the week. Yeah, it was here. Sorry. Let me reset. S&P 500 4 weeks ago was down 5.9%. NASDAQ Composite 4 weeks ago was down 4.78%. Russell 2000 4 weeks ago was down 7.5%. That was 4 weeks ago. 3 major indexes down between 5 to 7.5%. Hopefully people are following. Look at the XBI 4 weeks ago. 4 weeks ago right here, up 0.87%. I can't think of anything as clear as day when the market averages are getting massacred and a lot of growth stocks are getting killed and biotech is green on the week. That is relative strength. Relative to the markets, a index showing strength. That was the main reason I said at this point, I'm going to start taking a position because if you survived a 5 to 7.5% week to be green, then that's the number one reason because of the relative strength, I started to get into XBI and started even saying and tweeting, I think, to my educational members, I went on TV and said, second half of the year, I think biotech is going to do well. That's reason number one. Reason number two is I start screening. A majority of the stocks showing up on my screens were biotech, medical, biomedical, medical products. That was part of the second reason it started to confirm my conviction, because a lot of stocks were approaching 52-week or near-term highs. That's the second reason. The third reason is that I personally feel that big pharma, your Mercks, your Pfizers, your AstraZenecas, and all of those huge Bristol Myers, Eli Lilly, all of these companies have insane cash on hand, pristine balance sheets. And I think the third reason is you're going to see more M&A in the second half of the year. This isn't investment advice, just trying to break down my thesis. For example, Biohaven, BHVN, if I can type. Pfizer bought them out for $12 billion in cash. Okay. TPTX was another one that Bristol Myers bought out for over $4 billion. Sierra's not on here. SRRA, that GlaxoSmithKline, another huge GSK, another big pharma, $100 billion pharma company, bought out Sierra. That deal closed at the end of June. That's why the symbol won't show up on MarketSmith. My point is that my reasoning for XBI is the relative strength, stock showing up, and my theory of if the first half of the year wasn't the greatest environment and the big pharma names were putting 4 to 12 billion in M&A activity, and now Merck is talking about buying Seattle Genetics, now called Seagen, for, this is a 33 billion market cap company, could be one of the largest big pharma biotech takeovers. If they're putting cash to work in a difficult market, that's telling me we're most likely going to see more M&A in the second half of the year.
Perfect. Yeah, the relative strength has been pretty clear, and you did your entire presentation last year on relative strength. So if people are curious about, how Joe actually goes about looking for those stocks bucking the overall trend, I think I'd highly recommend checking out that presentation.
Yeah, and I used a lot of the same jokes this year as I did last year, so I'm just apologizing.
Just warning in advance. Yeah, no problem. So keep the questions coming, guys, and I also wanted to ask you a little bit about, what's your kind of favorite screen? Because a lot of people are asking about, how do you look for stocks like the stocks in XBI that, are acting well? And you don't just kind of one screen, I think would be good. Just give them a sense. And if they can check out that other presentation if they really want the details.
Yeah, I have a simple screen is 30 for 30, which I talked about. And I have a lot of screens here. Some I don't run regularly. Some I've just built and never looked at. I want to stress something here, that there's no magic in the screens. There's a lot of people, and I have no problem sharing whatever. For all my educational members, I share my screens. But my point is, people think there's some mad scientist, complex derivatives, unbelievable, like crazy stuff behind the screens. It's pretty damn simple. Mike Webster always is coming up with screens and playing around. My main answer to this one is be resourceful, put in the time, play around with screens and putting in the time. The magic isn't in the screen to build, because I'm going to show you a screen that's pretty simple. The magic is in putting in the work and putting in the time. Unfortunately, a lot of people don't want to work and don't want to put in the time. We live in a very impatient world. They're just like, give me the stocks, give me the stocks. Learn and put in the time. If you're passionate about this, if you want to do this long term, if you want to have consistency, you want to build something longer term, not just, hey, monkey, give me a stock for Monday. If you want to build something over the long run, hopefully we're in this, as my friend Brian Lund says, 10, 20, 30 years. Learn and put in the work. Put in some screens. I talked about the greatest winners throughout history having 30% earnings and sales growth. So what's in the 30-30 screen? MarketSmith has a relative strength rating of 1 to 99. I picked 90. Why'd you pick 90, Joe? Because Harvard doesn't take people who scored in the SATs like in the 20th percentile. They pick the 99th percentile, unless you're really good at sports. But anyways, you want to be in the top 10 percentile, so 90 or greater relative strength. Sometimes O'Neill says 80. Some people say 95. Some people pick 82. I really don't care. I'm trying to impress upon people. It doesn't matter. Just put in a number and be resourceful and work with it. I picked 90 because I want the top 10 percentile of stocks. Last quarter, year-over-year change, earnings per share, 30% or greater. Why? It correlates to the studies throughout history. Sales, 30% or greater. Current price, this is where you can put in whatever you want. I believe you get what you pay for. I don't like to trade penny stocks. I don't care if you do. You can put in $20. You can put in $40. You can put in $10. It doesn't matter. The whole point is put in a number, play around with it, be resourceful. And then 50-day average volume, I like something that trades 200,000 shares or more on average a day. Some people want something more liquid with 500,000 or a million shares. Some people want less. Well, again, there's no right or wrong answer. This produces 53 stocks, and then I go through them. I have several other screens, but this is just a basic screen to get you some good technicals, good fundamentals, and some fairly liquid names.
Perfect. And there were a few people asking if you could also talk about the strength in the China-related names, and then also maybe touch on kind of how you're managing risk in these type of sectors where, we can't have a gap down on news. Biotechs are kind of known for that a little bit, and, there's been some experiences with China names in the past, like LK. So I'd love to hear your thoughts on that as well.
Yeah. As far as the China names, some of them have been showing up. I've been avoiding them because of regulatory risk. I just make a decision. Going back to earlier, I don't have FOMO. FOMO is fear of missing Oprah. I'm kidding. Fear of missing out. I don't have FOMO. FOMO is for the weak. Don't be weak. I'm trying to help people build calm, confident traders, build your confidence. Don't ever have FOMO. If you struggle with FOMO, fix your head and don't have it. Meaning that, sorry to digress, but there's some China stocks. They look good. I don't care. If they go higher, I don't care. There's always opportunities. I don't have FOMO. It took me time to improve my mental skills. I'm not ever saying I was born this way or I started off trading this way. I had weakness, I had fear, I had doubt until I made the decision enough is enough, and I'm not going to have FOMO. There are stocks that set up, they look good, they take off, I miss them, it's okay. So my point is with the China stocks, I just made a decision, I'm avoiding them because of regulatory risk. So if they go without me, I don't care. I'm trying to impress that upon people. Now with biotech, I mentioned XBI because it's equally weighted and it's weighted towards a lot of those small and mid cap that I talked about that I like. I like it better than IBB. How do you know the weighting? There's a website called Google, and you can search the components of XBI, and you can type in components of IBB. You can compare the two, put in a little bit of work. It'll give you a list of what everything is weighted. I like XBI because you don't have the individual stock risk, and it gives you a broad exposure to the sector. For me, for individual biotechs, this is where I try to be more resourceful. I put in the work. I can't tell people enough. You got to work at this. You got to not have fears. You got to work if you want to improve. Number one is I follow unusual option activity. And I do that through Options Hawk has an incredible service because people say, where do I find it? Wall Street Jesus also has a great service as well. I filter that information to help me increase my probabilities of finding some winners in biotech, especially when there's unusual option activity, and especially in biotech when there's put writing, because put writing is dangerous because you're willing to buy it if it drops. And if they're writing puts, again, what's the key word? It increases your probabilities of success. So I follow unusual option activity. I've been lucky and blessed that I have some friends on Wall Street. Some are biotech analysts at firms. Some know this stuff a million times. I don't ever claim to be an expert in biotech. These guys know what a p-value is in a phase 2 trial, where that's a different language to me. But I go to people that I've been around that have been good friends of mine, and I ask them for their opinion also to help with biotech. And if you don't have those resources, a general ETF works to give you broad exposure.
Perfect. And just in this general type of market, where we're still in a longer term downtrend below or right at that 50-day moving average, which is declining, and below a declining 200-day moving average, what are some key things that traders can do to manage risk and make sure, they're not getting ahead of themselves and diving in too fast, too quickly?
Yeah, lighter position sizes. I've been saying, my friend Tom Canfield, we talk about sit out power, and it's hard. A lot of people struggle with that. If you are inclined to trade, cut your position size. Higher volatility. Remember when the market was pretty much straight up here? Maybe the S&P would move 20 to 30 basis points a day. VIX was low. We're above the key moving averages, low volatility. All of a sudden, we go into correction. A lot of new traders have never seen 2, 3, 4% moves all over the place in the markets. Okay. So what is lowering your position size do? It helps you from getting chopped up. So instead of 100 shares, go for 10, go for 15, go for 25. Cut your position size because that can help you deal with higher volatility. So I've mentioned 4 ways to at least increase your chances if you're inclined to trade in this environment. Number 1, try to find some of the stronger stocks. There are stocks, while the market is significantly off of their highs, and a lot of the ARC names are 60 to 90% off of their highs, put in the work. There's some stocks that are near new highs that at least you're giving yourself a shot that they've survived relative strength wise. So far, they've survived this correction. Number 2, use lighter positions to help minimize that volatility. Number 3, get strong entry points. Do not chase extended stocks, especially in a difficult market. The market does not care about you and will punish you in a difficult market. In a stronger market, it forgives your mistakes. In a more difficult market, it is ruthless. So get strong entry points. And number 4 is you still got to cut losses and manage risk, because just because you're using a light position and it's holding up well, it can still turn on you. So you still have to have a loss cutting policy. But to directly answer that question of how traders can survive in this market, if you're inclined to trade smaller position size.
Perfect. I think that's key. And there's some great questions coming in. First of all, from Wingnut 586. Question: do you plan every entry ahead of time and wait for your buy point, or do you sometimes decide to buy a stock that was not on your buy list when you see favorable action?
Both. For the most part, though, when I screen, I have my watch list, and I try to plan around my entry point. And then there's some other ones that are on my watch list, and I kind of, go with the flow instincts. Maybe some unusual option activity comes in that'll help give me a little bit more confidence, conviction, or encouragement to get in. But for the most part, but I'm not like winging it. It's screening, preparing something on my watch list, and preparing my entry point around key moving averages, safer entry points, around consolidations. And then I might use some other factors to maybe get in. But for the most part, they're names that are already on my list.
Perfect. And there's a question here about sell rules. So the question is from Rohit. How do you nail down profits and look for selling points? And maybe you could answer this both in, the frame of a strong uptrend, as well as in a period more like, this choppy, more volatile action that we're seeing currently.
Yeah, I mean, examples like I was telling people with XLE, it came out of a primary base here and then ran up and held its 21-day, had a normal visit to the 50-day. When it starts to get extended and starts to get vertically extended, look, this sounds so dumb, but you have 2 choices in the markets. You either sell into strength or you sell into weakness. Those are your 2 choices. When something's going straight up, you sell into it, or when something's going down, you sell into weakness. So I prefer to sell into strength because at that time, that's when there's a lot of liquidity. And if someone says, well, what if it goes higher? What's the fear of missing out? If you bought this properly at 60 and it's closer to 90 and getting extended, what have you missed out on? Like, I'm not saying you have to take all your profits, but you can take partial profits when something's extended. NVIDIA is another one. Split adjusted went from 4 to 350. When it starts to get a little bit vertical, one of the sell rules from O'Neill is sell on the biggest up day on a 6 to 12-day run. It's in chapter 9 of how to make money in stocks, tons of sell rules. When something goes vertical, well, what if it goes higher? Stop whining. Take some profits off the table when things go vertical. And I'll teach this lesson to people or mention this lesson, which is when I first started trading, I would cheerlead and say, go baby, go baby. When things were going up, I'd get all excited. Now I reduce my emotions, and instead of getting excited, I say, this has gone a little bit vertical. Take a little bit, if not the whole thing, off the table. So one great sell rule is when things get extended. When you talk about this choppy market, you kind of have to, just trade. You have to shorten your time frame in a choppy market. So that that opens up a whole can of worms. It just depends on your time frame, maybe to take smaller positions in shorter term profits.
Perfect. I don't see too many more questions coming through, but Joe, I'd love to ask you, I've asked a few speakers today, what's your overall favorite quotes related to trading, or, I'm sure you've got some good ones related to just general life as well. So I'd love to hear your thoughts on that.
I mean, the best advice I could give anybody, if you said, hey, someone asked me, what would you give advice you give your 20-year-old self? I'm only 22, so I'm not that much older, but I would say protect your confidence, work on your mental strength. That's everything. That's everything. One of my favorite quotes is Jesse Livermore's, nothing changes in the markets. Human beings are the same. So the same, let me get off the share here. The same fear and greed that existed 100 years ago exists today and will exist 100 years from now. So I'm paraphrasing, but he basically says nothing new happens in the markets. The dot-coms of the late 90s were the railroad stocks of the late 1920s. So stocks come and go, but one thing that's consistent is human emotion, and the same fear and greed that existed will continue to exist. That kind of ties into, that's why it's important to work on your emotions, work on your mental toughness. And if I would tell anyone, not just younger traders, newer traders, experienced traders, continue to work on your mental toughness and protect your confidence.
Perfect. I think, I think that's a decent place to end it. Joe, any kind of last minute advice?
No more questions. Nice.
No more questions. Yeah. Any other piece of advice that you want to share with everybody before we close it out the first day?
No, I mean, one other question I was asked recently is when I've said just with recent markets of nothing sustained until the Fed is done with their or pauses their rate hiking cycle. It's just a guesstimate, maybe their upcoming meeting at the end of July or September at the latest, because I don't think they're going to want to look like they're messing or interfering with the midterm elections. So not only that, but I think they've also, you got to remember, they've come from 0 to 2, 2.5, maybe whatever they get to. That's a lot of interest rate hikes that you need to let absorb into the system. So I also know that statistically midterm election years bottom around August, September. So just stay positive. I know it's been a tough first half of the year. Protect your confidence, keep your head up. Hopefully you've protected capital, protect your confidence, but keep putting in the work. And I'm confident that we're going to get a fourth quarter rally. I'm not just saying that happy-go-lucky, but you're starting to see some things form and a little bit of subtle signs of improvement. But my advice now would just still be patient, still be defensive. And if this rally's for real and if the market's going to bottom, there will be plenty of time to make money. Just be patient and let the market prove itself for stronger conditions to show up.
Perfect. Well, Joe, thank you so much for your time and for your jokes as well. We always appreciate it. For everybody watching, I hope you enjoyed as well. Make sure you leave a like on this stream if you are and subscribe to the TraderLion channel. We've got 3 more days as a part of this trading conference that we're really looking forward to. Got some excellent speakers, and I'll pop right back on in just a few seconds to give some basically closing remarks. So with that, I'll see you in just a few seconds. All right. Thank you guys so much for tuning into the stream today. Just a quick reminder, we're doing a fundraiser for St. Jude's. So if you found today helpful, please go ahead and make a donation down below. We've already hit $3,000 out of our $10,000 goal. So that's awesome. And we look to, keep shooting for our goal later on with the last 3 days of this conference. It'd be awesome if you guys could move us a little bit closer later today. We really appreciate it. And as I said before, we're keeping this conference free. But if you're finding this valuable, feel free to give back using that donation. Also, if you're interested, we're doing a masterclass with Stan Weinstein himself, and I'll be pasting the link down below in the chat here. So if you're interested in checking that out, we'll be releasing it at the end of July. And it's going to be fantastic. A lot of educational material teaching his system thoroughly. So make sure you check that out if you haven't yet. And I just want to thank you guys for being an excellent audience today. You guys asked some tremendous questions, and I look forward to seeing you guys tomorrow at the same time, 8:45 a.m. And we've got Ray kicking things off tomorrow, then Jim Ropel, and some other fantastic guests, Matt Caruso, Ben Bennett, Amy Smith. So make sure you guys tune in for that. And with that, yeah, enjoy the rest of your evening, rest up, and be ready for another great educational day tomorrow. And yeah, I'll see you guys there. Take care, everybody.